All right, welcome everybody. Glad to be with you in this webinar. My name is Sol. Glad to have you here. Just thanks, Mo. Just before we get started, if you want for everyone to see what you type, just change your settings on your chat so all attendees and panelists see what you type. That way, everyone will see your messages and we can create a conversation. Edwin, thank you. Hi from the Netherlands. Okay, let's get started. We're gonna spend maybe half an hour, 40 minutes here together, and I want to tackle and discuss in depth a topic that comes very recurrently, and a lot of traders, forex traders, but I guess all traders suffer from. And more importantly, I'll try to give you some tools to try to fix those challenges. So with that in place, and for all of you we haven't met or we haven't spoke, my name is Sol. I'm the senior analyst at the 5ers fund. We are an online prop company where we fund forex traders so they can manage funds and capital from the fund, and then we split the profits. And we try very hard to deliver a lot of resources and a lot of tools and a lot of webinars and training rooms in order to help our traders to succeed. And here you can see the large list of resources you will get access once you are a trader with the fund. So nice to meet you all, and let's just start. And we will start with something that might seem a bit basic, but I will try to go deeper and deeper and deeper. So just hang with me a few minutes and we'll discover some things that might be useful for all of you. As part of what I do here at the fund, I get the opportunity to talk to many of our traders. I hold one-on-one calls and talks with our traders, and I get to hear what are their challenges, what they suffer the most from, and what are the challenges they're facing. And I've spoke to hundreds of traders, and I've heard a lot of traders, and I've tried to help a lot of traders. And there's two things that traders externalize the most. Okay, if you want to guess what are those two symptoms or what are those challenges that I just hear over and over and over again, that would be overtrading and over leverage. Now, the problem with traders thinking that these are their problems is that overtrading and over leverage, they are just the edge of a much larger problem. These are just the actions, okay? They are like the symptom of the illness that we need to identify. There's something behind this conduct causing traders to eventually get into overtrading or over leveraging. And that's what we want to understand, because they start the meeting with me and they externalize and they tell me, yeah, I overtraded or I over leveraged and I shouldn't have, or whatever. And then when we keep digging and trying to get deeper into what's causing that, then we discover what is really causing and triggering this conduct. Okay, so I'll try to give you a lot of perspective to this topic, and I'll give you some tools and some tips to try to overcome this symptom. Okay, because as we said, they are not the problem itself, they are just the final action. Okay, the final conduct of our deeper problem. So let's start with that. Okay, before we move on, I just want to show you some examples of charts from some of our traders, and every chart tells a story. Okay, so for example, I want my. Okay, so we have a chart here. Let's look at this one, for example, and this is a 80K account, meaning this is a trader who already passed successfully the first level. Okay, this is a level 2 account, and we can see very small profits, very small profit, very small profit, very small profits, and suddenly after a while, a huge stop that ends stopping out the account. Okay, so this is a clear over leverage or revenge trading or over trading that caused it to this. Okay, what is it? I don't know. Maybe lack of patience, and the trader was feeling impatient and wanted to profit quickly, or something that ended up taking big losses. Something similar here, okay, a level 2 account, a 10K account. You can see here the dot line is the equity line versus the balance line. So you can see over these little gains, there was a huge drawdown on the equity. Okay, even if after closing the trade, the balance was positive, this trader was taking a lot of drawdown in order to get small profits, and getting disciplined enough in order to maintain a strategy that it's giving you and taking so long in order to give you results. That might be frustrating, for example, that might trigger some emotions that ends up wanting the trader to get bigger results or bigger returns, opening up a trade that eventually was a big loss that you can see here. And then maybe, the rest is history. He wants to recover fast, or he wants to revenge trading or something, and he blows the account. Same here, we can see a nice balance, but you can see also the equity, how it's in drawdown a lot of time. And look how close was this trader to the target, to get to the target. He was just a few $100s away from the target. Maybe at this point, he or she felt overconfident, for example. Okay, he were overconfident. He wanted to get to the target as quickly as possible, and that was a big loss. He wanted to recover that big loss quickly, and you can see the rest of the chart. Something similar here. Okay, we can get our thoughts about it, but it's something similar. Something here, a trader who's in drawdown and recovers from drawdown, recovers from drawdown. He's doing fine. He wants to get quickly to the target. Opens up a bigger or increases lot size, and big loss. Okay, or same here. This looks to me like a martingale system or something, but many small profits, big loss. Many small profits, big loss. Big win. Okay, overconfidence. I want to get quickly to the target. Bigger trade, big loss, and stop out. Okay, so every chart has a story behind it, but you can see here different causes or different triggers. Might be an emotion, might be an expectation, might be lack of discipline, lack of consistency, lack of trust in the system, greed, maybe overconfidence, that they lately or eventually cause or trigger either over leverage or over trading that leads to losing the account. Okay, so let's move on with those thoughts. So let's talk about possible cause causing overtrading or over leverage, which is unrealistic expectations. And if we go to explore that a little bit more, let me just go back a little bit. Okay, unrealistic expectations, I think of those in three aspects. Okay, unrealistic expectations about success, about results, and about time. Okay, so let's start with success. First, as human, we think of success, or we might be entering the trading world thinking of success in a linear way, when we will just improve, and eventually we will get to the top of our career or our skill or our trading career. When in trading, success really looks like this. Okay, it's a very hard way and very long way, partially because we as humans are used to do some action and getting some result of that action. Okay, so if I don't know, if I like mathematics, so 2 + 2 is always 4. If I play an instrument, so every time I play the piano, certain note or something, it's always the same note, always same sound. And here in trading, sometimes we think we're doing the same action. Okay, we're following our system, our strategy. We have a signal in our strategy, and we don't get the same results. Sometimes those trades result in a win, sometimes results in a loss. So it's very hard to measure success or progress when we don't have that feedback or positive feedback from the market. Okay, so our expectation about what success should be in the market, it's very different from what we experience in life. Okay, we feel that we're not progressing. So here at the 5ers, and we speak a lot about that, and I agree with that. We speak about shades of success. Okay, when we talk about success, we really think success is a constant progress. Okay, it's a constant progress towards a better trading every time. Okay, and I would like to give you the first tool for this webinar. Of course, at the recording, you will have it on the YouTube channel. But here you have a quick blog post we wrote about it, where we need to auto-define what success for every one of us, and we need to be aware that we improve every time and constantly. Okay, the fact that we all have different backgrounds, different account sizes, different skills, different time availability. So it's a very different path that every trader has to go through, and you need to be and start measuring yourself against yourself. So you need to start comparing yourself to your past self, and then to see if you have made any progress or not. Okay, so you need to be your own benchmark. I think that's the thought, that you need to stop comparing yourself to others, and you need to start comparing yourself to your results from, I don't know, 100 trades ago, or 1 month ago, or 1 year ago. Are you a better trader or a worse trader? Okay, and you need to acknowledge that progress. So that's very, very important. When we think about success, it's very relative in trading. If you were a losing trader and now you're a break-even trading, so that's kind of success. Of course, if you're a break-even trader and then you get to consistent trader, that's better. And from consistency to profitability, that's even better, but that will take time. Okay. Now, when we think of results, of course, there's the money and there's the returns, and we need to think about what's realistic. Okay. What's our account size and what we can get from that. We cannot expect from a very small account to get a lot of money. Okay, that's something just not realistic. You already know that. So we need to think about our outcome results in a realistic way. Okay, and not thinking of trading as a profession that can give you millions of dollars very quickly, or with a small account, because that's just not realistic. And same thing with time. You might hear when we think of a career, university, a degree, we need to invest years of our life in order to get professional at something. Okay, and for some reason on trading, we want to get immediate returns and immediate success, and we need to remember that trading will require years of preparation. So you need to commit time. Okay, you might have heard of the 10,000 hours to get to master some skill. So maybe you need to get 10,000 trades in the market to get professional at it. And of course, you need to take into account your available time. You may have another job, so you have to trade off the larger time frames, and you will have less setups and less opportunities. And if you have time available to practice, so you will have more available time for practicing, and maybe your path will be shorter. Okay, but again, we need to understand what's our reality and then what's our available time for practicing to commit time into trading, and we cannot expect to get successful in trading in less than 6 months, 1 year, 2 years. Okay, anyone who offers that to you, it's very unrealistic. So let's go back to our presentation. So that might be one source, okay, causing over leverage or over trading, because suddenly what we thought about trading giving us a lot of money is not getting there, and we start over trading or over leveraging to get those big outcomes we thought trading would give us, and we start with this, okay, and we get disappointed. Another thing that we see and I talk to a lot of traders, they have the wrong focus. Okay, they focus a lot in the outcome instead of focusing in the process. They they cannot distinguish between lucky strikes they had and consistently. So they have a lot of weight, and they give a lot of weight to good trades or profitable trades that they had here and then, instead of trying to get consistent over time. And I don't know if you saw the Moneyball movie, guys. I don't know if you saw it, but if you haven't, just go and watch it. It's a very good movie, and you can see there how they are trying to recruit baseball athletes, baseball players, based on their statistics, on their consistency. Okay, so we need to really focus on our process instead of focusing on the outcome. Because if we focus on the outcome of trading, on the money, we will focus on over leverage. We want to take the one single trade that makes a lot of money, instead of trying to focus on the process, on developing the skills and the consistency that eventually will give us outcome. Okay, but the focus has to be in a good process, not on the outcome. And surrounded and all the way, okay, we have emotions involved. So at every stage, okay, we have a correlation of emotions being involved here. We fear frustration, so we might revenge trade. We fear greed, okay, so we might over leverage. We might fear fear. We might fear a lot of I don't know, we might fear fearless, okay? We might feel fearless, so we go and over leverage, over trade, and our emotions are involved during the whole process, and we need to acknowledge those ones as well. So for all that, let's try to find some solutions to that, okay? So what we need is to basically to get to an integral solution. We need to break this vicious cycle and start developing good habits. When we try to when we want to change bad habits, we have to have something in place in order to replace those ones. Okay, so unless we develop good habits, we will have no chance to just erase or delete our bad habits. So we have to have the good ones in place in order to replace the bad ones. Okay, so let's start with some ideas. There's no more important or less important here. The most important thing is to take one of these ideas and start today with one of those. Go back later and watch the recording, and once you have one of those checked, then you can take another one of these good habits and start developing as well. And once you have all these habits we're going to cover right now, you will be able to get rid of your bad habits, and you will have some progression, okay, a shade of success, some success, in order to become a better trader. So the most important thing is to choose one of the ideas I will throw you now and start with that one, okay? And then just continue picking a new one and continuing with that, okay? So let's just start. A good idea for improving your trading is to reduce your lot size. And I've told you in some webinars or talking to some traders, I have gone in depth to this idea. If you were risking just $1 single in every one of your trades, and you lose the trade, that $1, you wouldn't feel the need to revenge trade in order to make back that dollar. Okay, $1 would not be a painful loss for you. Okay, so that wouldn't trigger in you the need to overtrade or to over leverage in order to make that $1. Of course, this is just an analogy, but the best way in order to develop consistency and to not focus on the outcome, but focusing on the process, is to really reduce your lot size, to start to focus on improving your statistics, your ratios, your win ratio, your risk reward ratio. And once those are positive, then you can start increasing your lot size in order to get outcome, in order to get money of your good process. But you really need to reduce your lot size so you don't get emotionally attached to any one of your single trades. So that would be a good exercise to do. If you feel that many times you are over leveraging or over trading, that might help with that. Okay. Unrealistic expectations. Why not developing a trading plan? But a training plan is not, it's not only writing down your strategy. Okay, writing down your strategy is super important. It has to be like your map to follow. But a trading plan has to include what are your expectations, and what are your expectations based off your own situation. What's the time you have ability? What are your own life objectives and the lifestyle you want to live? What income you need? So for that income, what kind of large account size you need in order to make that in a consistent way. So you really need to have a real and a complete trading plan in place, and you have to have the discipline in order to follow it, so you don't go thinking of trading in an unrealistic way. So I'll give you another tool for that. If you don't have a trading plan in place, and you don't have one, let me give you one here. It's a short version of a very complete trading plan we have. So if you fill in your email in this link that I just gave you, you will get to your email a reduced version of a trading plan that will help you start with something. Okay, but it's very, very important. I think traders, and especially, I don't know if especially forex traders, but traders, they really think they can just get into the market, out the market, and they don't follow a plan. They don't follow something written down, and it's very, very, very important. I cannot stress that enough. So make yourself do yourself a favor and start writing down things and journalizing your training routines. Okay. We spoke about focusing on the process and not focusing on the outcome. You really need to be your own benchmark. You need to improve every day, every week, every month, every 10 trades, every 100 trades. You need to honestly put yourself in a starting line, and after 1 month to compare yourself, compare your ratios, compare your results, and then look at what you have to tune in your strategy, on in yourself, your emotions. And if you had break-even month after a losing month, that's progress, correct? And if afterwards you have a slightly better risk-reward ratio than the previous month, that's also progress. You need to acknowledge that, and you need to stop comparing your results against other traders, because we are all different worlds with different skills, different time, different I don't know, family, whatever. Okay, depths or not depths. So we all have different lives, and we need to compare. We need to compare to ourselves all the time. Of course, doing that slowly will achieve. You will slowly achieve consistently. That's like the goal, and the money will follow. Okay, and just focus on the process, on taking good trades, following your trading plan, following your strategy. Remember that even when you follow your strategy, you will have good trades that will end up losing money. But that's fine, because you're focusing on the process and not the outcome of the trade. So as long as you did your job and took the trade you needed, the outcome, it's something that the market will decide. Okay, you have no control over that. So focus on taking good process, taking good trades. Backtest. Okay, maybe you're just starting now. I don't know, the background of all of you guys, but you need to be able to trust your strategy. And in order for do that, you need to first backtest it to see if there's some potential in that strategy, then adapt it, tune it to yourself, and then forward test, okay, or real test that strategy, not to make money, but to get trust in your strategy, to know that in the long run your strategy makes money. So if your strategy is working, it has a potential of, it's a profitable strategy, then you only have to work on the other side of the system, which is the trader, which is you. Okay, so we have in a system, we have a trader, and we have the trader, and we have the strategy. So back testing and forward testing, we can have no emotions in place in order to make sure our strategy works for us. And once we know that, then we can trust it, and the trader part of the equation of the system can feel more comfortable taking those trades and those signals, and it will be easier. So back testing, demo trade, and then forward trade, and get trust in your strategy. Okay, build confidence in your strategy. Find a mentor or a community to stay accountable to. Okay, the key, from all these talks and meetings I have to with these traders, with all the traders, hundreds of traders, the most valuable thing here is to externalize their thoughts. Okay, once you hear yourself thinking or saying what you think, or saying what you think is your problem, and you stay accountable to someone, okay, because we many times have follow-up meetings to someone, so they know right now they have to stay accountable to me. Okay, but when you go to the gym, or when you go to a nutrition or something, and you know you will meet your coach or your mentor or your group or whatever the next week or in 2 weeks, you know you have a compromise. Okay, so you need to find a mentor or a community to stay accountable. There are plenty of forums. We have a trade ideas page where you can try to find a match or a friend or something to be your mate. And the key message here is to stay accountable to someone that will help you with the discipline. Okay, once you have to take a trade or not to take a trade, and you know you should not take the trade, once you think you will have to explain that to someone else in the future, you won't take the trade you shouldn't. Okay, so it's very, very important you find a community or a mentor to stay accountable to. That will help you with the discipline. Meditate. I don't know if you connect with that. You don't have to go to mindfulness or any specific thing, but just breathe. Okay, that's the key. Relax your mind. Breathe before your trading session. Breathe during your trading session. Breathe after the trading session. Okay, keep your mind relaxed so you don't have so you don't have to. That will help you with the emotions. Okay, trying to trigger in. That will help you a lot. I was very skeptical of this until I tried it. You know, I heard of Ray Dalio saying that he started meditating. So if Warren Buffett and Ray Dalio and all of those big traders, they meditate constantly, so why shouldn't I? So I started and I really connected to this. I don't do long meditations, but just a few minutes of breathe, okay, exercises before my trading has really helped me out. Maybe last, it's hard. I know it's hard. It's part of our lives, but you need to drop social media. Especially you need to stop social media when you see, flash fancy cars and traders showing profit months of $100,000. That's something that's, again, unrealistic. Most of those are fake. Most of YouTube videos or TikTok videos or whatever, they're just looking for SEO, and they're looking for traffic into the channels to get revenues from YouTube or TikTok or wherever. And those really cause you to think you can get those same results. And again, we don't know, even if they're real, their strategy or their system might not be the one you need. So you really need to, or you guys really need to stop creating or comparing yourself to what you see on social media. That only causes a lot of stress. And again, going back to compare yourself to yourself. You are your own benchmark. I'll take, if there's some question, guys, I will be glad to take that. Again, the message here is to start developing good habits in order to get rid of the bad habits. Sholani, does the 5ers have a trading community? We have a lot of channels when you can create community or a mate or something. We have a trade ideas page where you can find traders that maybe trade like you, and you can contact them. We have a Facebook page when you can throw ideas and get some feedback, or find someone who's willing to get into a Telegram or WhatsApp group or something. So we are trying all the time to get to create a community of traders, and we have some projects in mind that will be very disruptive to the industry. So we're really working hard to get that in place. So yes, I would like to think of the 5ers as a community of traders. Edwin Jansen, how do you handle emotions during a trading session? How do you detect them, and how do you cope with them? Are emotions always bad during trading or not? Those have a mentor coach we can talk to. Yeah, John, if you join the 5ers, you can get with a portfolio analyst. Sometimes it's me. There are other guys here that do those stocks, and you can have some help with that. The slide before, of course, let me go back one slide. Okay, so you have it. Handling emotions. Again, ideally, we do have that emotion, and we have to recognize them and acknowledge those, but we have to have a plan of what to do once we detect those emotions. So ideally, you have a trading strategy or a trading plan where you feel comfortable, so the emotions or the need to do something is not triggered. And once you, and in your trading plan you have to have that path, okay, or that plan. If I take a trade and I feel uncomfortable, then I will close. Or if I feel, if I'm feeling overconfident, I will stay out of my computer. Or okay, you have like a map to follow once you identify those strategies, those emotions. It's not something, we cannot erase our emotions. We're humans and we have the emotions, but certain circumstances in the market trigger certain emotions, which are different in all of us. So I don't have a clear answer to give to you because my emotions are different to yours. But once you feel that emotions, write it down, and for the next time, decide what are you going to do once you feel that same emotion in place. Okay, emotions, they are not always bad in trading, but again, we don't want our emotions to interfere to our trading. So we have to have a plan, an emotional plan for our trading routine and our trading session. Okay, it's realistic to reach the 6% target when I risk only half a percent per trade. Of course, we have many traders risking less than that, risking less than 0.5% per trade, and they get to the target. If you have a good risk reward ratio, then one trade would give you more than 1% of profit, and you would be on your way to the 6%. And if I was asking you to make that 6% in 2 weeks, maybe that was unrealistic. But that's why we have, we try to not pressure our traders. And when you have 6 months to get into the target, and if you need more time, just request it and we'll give you more. Okay, as long as you're profitable. We don't want to put pressure on our traders. Yeah, it really is an invitation to research your emotions. There are plenty of books, trading in the book, trading in the zone, markets, what's the name? Market games. So I'll throw that in the description. There's a lot of books on emotions. It's very helpful to read. Gulden, how can we understand we are over trading? Backwards, you can see your chart. Okay, I show you the charts, how they look in real time. I guess you will. The problem is not realizing you are over trading. The problem is to stop. Many times it's too late to. Once you realize you're over trading and you stop, that's too late. The damage is done. So the first time that happens to you, that's fine. Just remember that and write that down and commit to not do that mistake again. Okay, all bike riders will fall off the bike at some times. All traders will blow accounts at some point. That has to be a lection and something you get message of and something you learn. Okay, you learn of. Mano, can I give features for a good entry point? No, it's not. It really depends on the strategy and the system you're following. It's not something I can give you. I know for my strategy what's a good or bad entry point, but it's something that will depend on your strategy. Okay. Yeah. Thank you, Leon. Market minds game in this show. That's the one I was looking for. Market wizards. Okay. Yeah. Great. Thank you. How do we access our progress chart to the 5ers? You have, if you go here, so you have the dashboard, and you go to your chart. Okay, guys, has been a pleasure. Almost 40 minutes here with you, spending this time with you. If you have any question, you know how to reach out to us. Send us an email. Samuel, what's your question? Maybe I missed it. Okay, just leave it here again. I guess I missed it. But if you retype it, I will. Time frame for consistent in trading. Again, Samuel, it's something very individual. There's no better or worse time frame. My advice is, if you have less time in front of the chart, go to the larger time frames. If you have a lot of time to spend in front of the charts, then you can go to lower time frames. But the market behavior is timeless. Okay, time frame is something we know from our trading platforms. the market does not respond to those timeframes. So the time frame is really not the issue here. Okay, you can get consistent at all timeframes. You need to find the one you feel comfortable with. Okay, and that suits your lifestyle. Audrey, yeah, you can feel free to email The5ers if you need more time on your evaluation. Just do that. Guys, thank you very much. We'll get the YouTube recording, and you'll have the resources there as well. As always, happy trading, and see you next week. Bye bye, guys. Thank you. Mark, welcome to the webinar. Glad to have you.
Thank you very much.
You've been around on YouTube channel UK spread betting for forever. I remember myself, I don't know, maybe 4 years ago or 5 years ago, I was trying to understand a little bit more in depth what leverage is. And I came across to your channel, and I learned from you what was leverage and how it's calculated and the relationship with margin. So I've been learning from you a few times. So, I mean, you are, one of the few reliable YouTubers out there. So I really appreciate the work you do out there. Just your work is so valuable. So thanks for
appreciate that. Thank you for those kind words. And has it really been for 4 years? I can't believe it. Must have been. There's a lot of videos out there, but yeah, appreciate that.
You used to do those. You used to use those, the papers to draw on them.
Yeah. Back in, I remember. I think I've done a full circle with my haircut as well. It was longer, it went short, it went really short, and now I'm kind of getting a bit longer again. I'm feeling a bit more of a length. So, yeah.
So yeah, very, very pleased to have you. So yeah, from now, just take over, introduce yourself, and I'll be here, and I'll be in the background. I'll be back.
Brilliant. Okay, thank you. Well, I'll share my screen because I've got one introductory slide because I know some of you don't know who I am. So let me get started with a quick screen share. I'll share that. I'll put that on slideshow. I'll move your face over there in that screen, and we should be good to go. I don't know what, every different country and jurisdiction has its own rules around risk and stuff. I just like to say, listen, if you're new to trading, just understand that it's high risk, right? Most of you here, I guess, know this by now, but I'd hate to see people coming into trading thinking, oh, this is so easy, I'm going to make money, and then don't understand there's a risk. There's good rewards, sure, but there's risk as well. So just make sure you understand that this is a serious game we're playing ultimately, and we're trying to be the best we can. So today, what time are we on? Yeah, so we're at 2 o'clock. So you guys are probably watching the CPI number. Markets all over the place. Nasdaq's back to where it was, a little bit higher. I know you guys are trading Forex. But yeah, we're going to 30, 40 minutes or so. I want to talk to you about something different today. And by the way, I hope you can hear me. Some genius has just started construction in the office above, just in time. But this microphone's pretty good, I hope. So hopefully you can guys hear me. Any questions, fire them in the Q&A section or in the chat. I'll pick them up at the end. Definitely have time for that, so we can look through that. So today I want to talk about 5 steps to building unwavering trader confidence. So, when I spoke to Sol, say, okay, what I want to talk about? I'd like to kind of talk and share something of value, something that's going to be really useful to you guys. And strategies are one thing, and sure, strategies are super valuable. Obviously, you have to have an edge to be able to trade. But I think that confidence is something that's so overlooked as a trader and something that's so important as a trader. So we're going to dig into it and give you 5 steps that I think are really, really valuable to help you build a confidence. Some of the traps, some of this, and some of the other things. So I'm really going to give you as much value as I possibly can in the next 30 to 40 minutes. So I appreciate your attention, especially when there's a big data number just sort of sitting there and chugging away in the background. I know you guys have all got one eye on the screen. Little quote from Mike Tyson there. I think he probably nicked it from Muhammad Ali. But anyway, you've got to believe you're a champion before you become one. I think that's a big ethos to have. Okay, so a very brief overview of who I am. I don't want to waste too much time on this, but I kind of want to show you my journey. Started trading in 2001. I was trading mining shares on the London Stock Exchange. There was a real kind of opportunity at some point as well when we switched from, I don't know if any of you guys are from the UK, but years ago, we switched from this thing called CQ to sets. Ultimately, it was just a fully automated trading venue rather than this market maker led model. And that was a real kind of opportunity for short-term traders to take advantage of it. So I guess without going too much depth about that, the point was edge can show up anywhere. And that opportunity really kind of, gave me a good kickstart in my trading career. I changed edge as conditions change. I became very much focused on reading a tape, supply and demand, and as kind of price action trader. When then we shifted to that fully automated type of trading on the London Stock Exchange, some of these algorithms back then were just so primitive that you could kind of spot them a lot easier. Obviously now algorithms are smart. But the concept of supply demand, of reading the tape, of kind of understanding these things still applied. And I kind of shifted my edge as that sort of edge diminished over time. I started putting on videos on YouTube literally to stop me over trading. That was the thing. I was like, right, I've got a position on, don't want to touch it. What can I do? So many trading books you can read. You can see I've got a few behind me there. So many trading books you can read, so much journaling you can do. I thought, okay, I want to do some videos. And I put them on YouTube, and here we are. I think we've got 370,000 subscribers later. So you guys like what I have to say. So I'll share what I think is of value. And I'm always honest with what I'm talking about. I don't sugarcoat things. This is a difficult game. It's a tricky game. It can be very, very rewarding if you get it right. It can be super challenging. It can be the hardest thing you'll ever do. But I think that with guidance and with structure, you can kind of make some progress. Quickly, I'm not promoting myself, but I created a Traders Mastermind community. There's also a podcast. You can search for that. At the moment, I'm building a new piece of software called Trading Plan Pro, which I'm absolutely super excited about. It's going to have discipline, kind of streaks. It's going to be, you better have your trading plans in there, strategies in there. That's really going to help me and building it for me. And I'm also going to be offering it out to people as well. So that's me. So that's me in a nutshell, very, very quickly, if you haven't seen me already. Okay, so I'm on the right slide. Okay, so building confidence. So most people think that it's like chicken and egg. Have you heard of that phrase? I can't get any confidence until I make money in trading, and I can't make money until I have confidence. You're like, well, what do I do? I need to make money first, but I can't make money because I'm not confident, so I can't move forward. And traders, especially early traders in the early start of their career, think that profits equal confidence, and that's I believe that's wrong. So let me tell you why. Let me ask you a question, right? If you'd never had a green year, right, but this year you made 700 grand, would you feel good? And I'm pretty sure that everyone say, yeah, absolutely. 700 grand would be a very nice year if I'd never had a green year. Now, if there's maybe some traders watching, and listening and tuning into this who have had 7-figure years and they might be upset with 700 grand. But I imagine if you had never had a green year, going from nothing to 700 would make you feel pretty good, right? Now, let me change the question slightly. What if you made that £700,000, but you'd also broken all your risk rules regularly, had a few close calls with a blow up, and just traded sloppily? Would you feel good and full of confidence? You wouldn't, right? You'd be like, yeah, I made some good money, and I wasn't making money before, now I am. But, I really got close to the wire. I nearly blew up an account. I got away with this. I did this and did that. You wouldn't feel full of confidence, right? So by that definition, profits do not equal confidence. Confidence comes from a separate area in trading. It's your actions, your process, and the standards you operate from. Now, sure, I'm not going to stand here and say that profits don't play a certain role. Of course they do. You have some experience, you have a kind of few years behind your belt, you have some profits, you go, hey, listen, I can do it. I've proven I can do it. But it's not the core, right? It's not the core. It's not necessary to move forward. And so we need to shake this belief of I must get profits, get confidence. It comes from this different area, and it's something you can control. That's the good news, right? You can control your actions, you can control your process, you can control the standards that you operate from. So with that in mind, let me share with you this 5-step system that I've got for kind of creating and cultivating confidence. And it's perfect if you are doing, an online prop firm challenge, because you are in that level where you're trying to get to a point where you're funded, you're trying to get to a certain goal. And by definition, you're starting from zero effectively to build that account to pass it, and then you're funding and you're trying to move on, you're trying to keep within the parameters. So it's important to have that level of confidence regardless of where your P&L is. I think that when we stake our identity as a trader on our P&L, that's a mistake. We need to stake our identity on our actions, process, and standards. Okay, so let's get straight into step number 1. Now, before I carry on with this, some of you are going to be like, this is really, really golden. I like the idea of this. Some of you are going to be like, oh, this doesn't, man, I'm not so sure, but just trust me on it and give it a little bit of time and think about it and think about what I'm saying here and really, because at the end of the day, right, look at it this way. I remember years ago looking at myself in the mirror and going, I have to change my behavior. Yeah, whatever year, 2002, 2003, something like that, first couple of years in, I need to change my behavior to get what I want from this market. I have to make a change, and I'm prepared to do anything within reason, of course. I'm not talking about insider trading or anything like this. I'm prepared to do anything internally to move forward, anything kind of from a mindset perspective. Because I knew that was my mindset, my discipline that was holding me back. So step number 1 is clarity. You need to become crystal clear on your vision of why you are trading. Crystal clear. You want to know, what are you trying to achieve in your trading? What's the goal for you? What are you doing it for? You doing it for money? Freedom? Do you want to change your career ultimately? Most traders come in and go, I want to make some money. I want to make some cash. That's not clear enough. You must have a crystal clear vision. You'll see why this fits into where we're headed in a moment. A crystal clear vision is I want to make £500,000 by 2024. I want to make 2 million by 2028. I want to pass my funded program by the end of 3 months. I want whatever it may be. There's a specificity to that that's required. It's not, I want to do this, I want to do that, because you'll end up just not treating it with the respect it deserves. So being crystal clear on the vision of what you're trying to create. And you can go and dream as big as you like and say, hey, 10 years time, I want to be that. That's out of reach now, but let me then reverse engineer it. First step is to become funded. Next step is to get the first payout. Then this, then that, then the other. Whatever the steps may be. We don't have to go crazy and start to analyze it yet. Having that clarity on where we're headed is so important, because here's something that many traders do, right? And you think of a big oil tanker kind of churning away through the sea. Put a little bit of rudder on. I'm not a nautical guy, but imagine you put a bit of rudder on, or whatever the terminology is, and it slowly kind of veers around to the right, doesn't it? Rears around, what's the terminology? Starboard, I think it's right. Someone can correct me. You kind of veer around. It takes a lot of time. You still think like you're going ahead, and you kind of think, yeah, I'm doing it right. And time goes by and fuel gets burnt. And imagine that in trading. It's like time goes by and equity and stuff and all these challenges. But actually, if you keep that rudder on to the right or to the starboard, eventually you're going to have a big circle, and it's going to take you all the way back to where you were. You've done a lot of energy, you've burnt a lot of fuel, spent a lot of time, but you're exactly back to where you were. Think of yourself in your trading. How many times, I don't know how many experience you guys have got, but you've had some experience. You listen to this, you find yourself going through the same process again and again and again and again. You feel like you're moving forward, but then you look at where you are, you go, I've just gone round in a circle. I have done absolutely nothing. So you need to lock your destination into your sat nav, into your satellite navigation. You go, right, I'm headed there. That's my vision. That's where I'm going. Chug, drive. Now, how long it takes me to get there, I do not know, but I'm heading that way. Just like if you were setting a heading on a plane, it's like you were setting a heading, in a boat. I did my private pilot's license a while ago, and one of the things you get taught is, listen, set your heading and just keep checking you're on that heading, because it's very, very easy to drift. It's a lot like life in trading, right? It's very easy to drift. You feel like you're getting in the right direction. You're distracted elsewhere. Your concentration's elsewhere, and you're not moving in the direction you want to direct move to. So be crystal clear on your vision. So important. So important. Step 2, visualize. That's the UK spelling. For you Americans, it's going to have a Z in there, or a Z. Visualize. Okay, so what does that person look like? And this is important too, okay? And you might be, this is the point where I might lose a few of you, like, oh man, this is a bit of a stretch, but just listen to it and just see what you think. So you've got that crystal clear vision of where you want to go. And maybe you sit down and write, no distractions, no market, no this, no that. Just get a pen and paper and write, get that vision. Then you're going, okay, what does that person look like? And I mean, physically, imagine them sitting, he or she, whatever you're looking at, on the desk, sitting in front of the trading screens. What does he look like? How does he act? How does she act? what trading habits they possess. Just imagine them there, sitting there, managing the account size that you have got in your vision, or whatever that is. How do they behave? What does their pre-market prep and journaling routine look like? How do they respond when they break rules? Are they so angry? Are they not bothering with their journaling routine? Are they not bothering pre-market prep? Are they breaking rules? Of course they're not. You know they're not. You know that they are adhering to the plan and the structure they've placed in for themselves. They have that pre-market prep. They're trading, they're taking a loss, they're shrugging it off, they're moving on, they're adding to winners, doing all the stuff that you know is right. They're cool, they're calm, they're relaxed. They're sitting there. You can see how they kind of interact with the market. And imagine, just picture it for a second. Just take a second to look and see how that person is sitting, how they're holding themselves, all that type of stuff. That's your future self. So we've got the crystal clear vision of where you're headed. You've now got the visual image of that trader. And this might sound like, oh, woo, woo, and all this kind of stuff. But honestly, it takes no time to do. It's free. And what have you got to lose by doing this type of stuff? If it changes how you behave in the markets and gives you more confidence and more structure and gives you more discipline and a better mindset and all this other stuff, then the ROI is going to be huge, right? So think about what that person looks like. I've always got that locked in. Just imagining that person sitting there in the desk, what they're doing, how they're acting. And when you come into certain scenarios, you've got the kind of North Star in your mind. All right, so step 3 is to build a plan. So we've got that crystal clear vision of where we're headed. That's locked in, done. We can see the behavior that we need to do to get to that point, because we've visualized and we've let ourselves kind of think and we've let ourselves dream and we let all that kind of stuff and done all that type of thing. Now we need to kind of lock it in. Now we need to go, right, I know where I'm headed. I kind of know how that person acts and how he does this and how he or she does that. I need to come up with an actual plan of action to turn myself into that person and put myself on that heading. So we need to construct a plan, or you need to construct a plan that encompasses all of the actions that you can see that person doing. This is a kind of handful of things, right? You know yourself how to act in a professional manner. You know yourself how to take this trading seriously. You know the actions you're taking, which aren't really going to be conducive to the long-term vision. They're not going to lock you into where you want to go. Waking up, checking the market on your phone, trading off that's probably not the way to do it, right? You don't imagine that serious trader of yours in the future doing that. So what time are you going to come to the screens? How are you going to prepare? What your rule's going to be, what your setup's going to be, journaling process, what's your plan look like? All those things that you had in your mind, you need to put them now down into action, because you're trying to create that person. Yeah, this is the way we're kind of shifting our thinking from, I want to make money, I want to make money, I want to make money. Like I want to create the person who I know has the ability to make the money that I want, or whatever that goal may be. So we're taking it slightly differently. Rather than saying, oh, imagine this, do that, we're going, okay, no, I need to develop the habits that are going to make me into the trader that I know is going to hit the goal, or has the best possible chance of hitting the goal that I've set for myself. So all these things that are worth doing. I'm not saying you have to spend hours on your prep. I'm not saying you have to spend hours on your journaling. Absolutely not. Many people spend very, very short amount of time just journaling the most important trades, the 80-20 rule, journal the most important trades, the worst trades, the best trades. That's fine. You don't have to have reams of rules either, some basic risk rules and structure. Your setups, again, you have to be super complicated, have as simple as complicated as you like, but it's creating and molding yourself into that trader, because this is how we're building confidence. We're building confidence, and we'll see in a moment, because we are creating the habits that we know that the professional trader in our mind has. And so when we do that, all of a sudden, confidence starts to build. The confidence starts to build. So we're putting these things into action. All right, so the next step 4, is alignment. And this is the important part. It's okay to sit here, and it's okay to come up with a plan, and it's okay to sit and visualize. And by the way, I do this regularly, right? I'm not just saying this. I do this regularly. I know where I'm headed. And very often after I've been to the gym, whatever, I'll sit in the sauna. I like a sauna after a gym session. And I've got that 15, 20 minutes. And, I'm sitting there and I'm thinking, I'm getting it crystal clear in my mind. So my mind knows exactly what I want to do. And the point is that when we are in front of the screen and we're about to break a rule, we're about to dive into a trade that we know we're a bit late, we're about to pull the trigger a bit early, we're about to break a risk rule, subconscious brain goes, whoa, 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 whoa. Just stop a second. That is not the trader you're becoming. You've locked this in so firm into my brain that I'm going to pause you. And that's what we're trying to do, because, breaking the rules is just so detrimental to our performance, right? We know this. You know this. You know that breaking the rules and screwing up your discipline is not serving you. And you know probably that if you fix that, your P&L would be a different scenario. Maybe you'd be at a funded status already. Maybe you'd have a couple of withdrawals. Maybe you'd be trading seven-figure account. Who knows? Who knows? So this is now where this separates, say, the men from the boys, the women from the girls, however you want to say it. This is the tough part, right? The easy part was that. It's easy to dream about where you're going to go. It's just locking the head in. Pretty easy to kind of come up with a plan and sit down and work out all the things and the process and habits that you want to create. So now you've got to act in alignment. This is the tough part. Sticking to that program, sticking to the rules. Now, I've highlighted this because this is a really key part. The test is doing what you said you were going to do, even when you don't want to. What I mean by this? So when you're in front of the screens and you have the urge to do something that's out of alignment with your future trader self, remember, you imagine them, you had them there, you know how they're acting. When you suddenly see a price spike, something's going on, and you've got that impulse and urge to trade it, I want to get involved in it, but you know it's not part of your setup. Just breaks, come on, hang on. How does that future trader self react to that price spike? Probably just goes, okay, it's information. What information do I get from that? Is it a rejection of a key level? Is it a continuation? Is it a momentum ignition? What is that? Is it something valuable, or is it just noise? Let me note it down. Let me think about it. How's it playing to the structure of my feel and bias I've got for the market already? Does that affect how I'm going to trade the next deal? Do I increase the size, decrease it? That's the information they'll gather from that, not, oh, I'm going to miss out. I need to get in. So again, you're kind of acting in alignment. That's tough. It's tough to do that. But the more you embed and ingrain in your mind how you want to behave and act and the habits you want, the easier it's going to be to do this. So example, right? Let's say you're late to the screen. You've got a valid excuse. Something happens, your family, blah, blah. You've got a valid excuse for being late. And it happens, okay? Happens. You come to the screen and you convince yourself that, you know what, I'll just skip my pre-market prep. Bell's going to go, let's get ready, get your trading gear on, get your mouse going right. And you skip your pre-market prep because you think you've got a valid excuse. That's when you go, stop. This is the test. This is the separator between me doing circles and circles and circles and circles and circles and going nowhere, and actually breaking out and becoming the trader that I've visualized and I've had in your mind forever. That's the difference. That's the test. These little tests you have every day are little tests to say, are you going to act in alignment with the future trader self? Are you going to act in alignment, or are you just going to default back to that, the mob, the crowd, everyone else who just messes around and just trades around with no real objective, and they're the ones that are in the ocean just going back and round in circles for time and time and time again. You're only the one that's breaking out, the one who's moving to the heading. Be strict with yourself. Does the vision of the trader you want to be act in that way? And you know this. Your subconscious knows this. So every time you are tested in the trading day, you're sitting in front of your screens and you want to break a rule, you want to not do your journaling, you want to not do your pre-market prep, you want to do something that's out of alignment, that's really removing from your confidence, right? This is why a lot of traders say, I don't feel very confident. It's got nothing to back it up with, because they don't trust themselves to be safe in the market. They don't even trust themselves to stick to the risk rules. But every time you're tested like this and you pass the test, you're building confidence. You're making a deposit in the confidence bank. You're going, hey, listen, I do stick to the rules. I do what I say I'm going to do. I've got a big streak now of this pre-market prep that I'm done. I'm doing my journaling. I'm sticking to my rules. All these things, and that's in alignment with the trader that I'm trying to become. That's what builds confidence. That's where you go at the end of the week. Hey, forget about P&L. Doesn't matter. I'm not measuring my P&L at the moment. I'm trying to get to this status and level. And P&L's nice. Sure, it's nice to have a green week, but more important is to stick to your rules, to stick to your processes, to build the habits that you know are going to cultivate P&L in the medium and long term. Not today, not tomorrow. There's always a lag, guys. There's always a lag. You kind of, what your habits are doing now, 30 days, 90 days, you start to see it kind of come through. So it's thinking, hey, it's like on just a great analogy with the tanker in the ocean, right? You can't just rack the rudder like a speedboat. You have to turn the dial, take some time. It's the same with training. Habits have to pick up. And something to add here is you're not going to be straight away disciplined and going with all the habits that you want to do. You'll make mistakes, you'll slip up. But the idea is just to get incrementally better to improve yourself into that trader. It's not going to be instant. Can't go, right, this weekend, I've thought about my habits. I've thought about this. I listened to what Mark said, and I'm going to do it. Yeah, that's great, but it's going to take time to cultivate. So don't kind of just give up when you don't end up slipping and not doing the things you say you're going to do. It's okay. Just do more. Just improve it. And the way that I like to think about things is every time you have an urge to break and deviate from the path that you know is going to get you where you want to be, you just go, no, I'm sticking to the rules. I'm sticking to doing this checklist. I'm not trading until I've done my checklist, my pre-market prep check. I'm not trading. I'm not doing this. I'm making sure the stuff you do and the stuff that you have the impulse to go, I don't need to do this. I'll just take a little bit more size on this trade. I'll move the stop, or I'll just trade this instrument I'm not really supposed to be trading. I'll just trade a trigger that's not really a trigger. I'll just kind of allow that market. Those stuff is the test. And that's what separates you from everybody else who's falling by the wayside and struggling, and the people who are moving forward. Because every time you have a test and you pass the test, confidence in the bank, confidence in the bank, confidence in the bank. And unlike the current interest rates that you get in a traditional bank, you actually get pretty decent interests from your confidence in your bank, because actually that grows and grows and grows and builds and builds and builds, and you end up with a decent foundation. So every time you make that decision, act in alignment, you make a deposit in the confidence bank. You can see how this is disconnected from your P&L. Of course, P&L. I really don't want to say, oh, it doesn't matter P&L. Of course it matters. That's ultimately how we measure ourselves. But to just disconnect it for a moment. If you're someone who's spinning the wheels, especially, and someone who's like, oh, spinning, just disconnect it and identify with someone who's acting in alignment with the trader they want to be. Then you do that for enough time, the P&L will catch up. You have that lag, it'll catch up. And you'll look around and you go, all right, good, it's caught up. So, say on the bottom part here, most weaker traders do fail here and fall, so say, because they don't see the results and they go, why is my P&L working? And just trust in the process. Say, I'm process focused. My confidence and my ability as a trader is my identity of my actions, because I know that if I do these actions, that is going to serve me. If I constantly break rules, just like the beginning slide where we said, hey, if you made 700 grand, but you got lucky and you blew up, you'd feel awful. You'd be like, well, nervous about going into the next year. You'd be like, damn it, this could be the year I blow up. But if you make it and you're confident and you've structured and you've got the right habits, that's going to be so much more of a powerful position to be in. You can weather drawdown. You can push some size in when you see the right trade setting up at the right time. You can do all those things that you can't do without confidence. Or if you do, you kind of, nervous, you're taking it off. You see that unrealized P&L, you take it off quickly, or you try to increase your size. You do it for a bit. You have a little losing streak. You get scared, or you blow up. That confidence is just the underlying thing that just underpins everything that's of value. So, the fifth and the final step is the 5Rs. It's not intentionally for 5ers, but it's 5Rs, right? This is a process that I like to do because it's not going to be plain sailing, right? I don't know why I'm doing all these nautical analogies. I don't even sail. I'm not a captain or anything. I don't know why I've got these nautical analogies. So anyway, you kind of want to go, right, this is a never-ending process for me, and commit to that. Say to yourself, hey, it's a never-ending process. When things aren't going my way, let me speak to you. When things aren't going your way and you're wavering from your plan and your program, you activate these 5Rs. The first one is to reset. Now, I will say almost with certainty that everybody here is too hard on themselves. And that's okay, because we need to be driven. We're all ambitious. We all want to push forward. Whatever level you're at now, we all want the next level, the next station. We want to move on. I get that. But sometimes we have to be a little bit relaxed about things. And I know this is not generally how we're going to operate, and it's not got us where you are now by being, oh, it's okay and everything. But in this instance, just look yourself in the mirror and you make a mistake, you fall off, you do something wrong, you break a rule, you kind of do something you shouldn't do. Most people just throw the whole thing under the bus and go, you know what? Yeah, I can't do this. I'm going back, and they fall off. When something like this happens and you do make an error, you make a mistake, you look yourself in the mirror and literally do this, and say, you know what? It happens. I'm trying to get to where I'm going to be. It's never going to be a straight line. I'm going to make mistakes. I'm human. Forgive yourself. Forgive yourself. Now, let's not, those who know me know that that's, I'm not saying you always go around going, forgive yourself for all these mistakes and you're beautiful and all this kind of stuff. No. Still be hard and tough on yourself, but start off on this foot, kind of wipe the slate clean and go, because what it does is, you know the score, right? You've done something, you've broken a rule, you're disgusted with yourself. You're like, I've broken this rule, I've done this, I've done that. Look at my P&L now. I nearly got to this funded state, so I nearly got to a payout, and now I've broken the rule, I'm back to where I want. I'm just so frustrated, and you can feel it hurts, right? And the trouble is, if you don't release that, that just builds and builds and builds and builds and builds, and it's just a bad place to be. So you've got to just go, right, forget about it. Let's just forgive myself, move on. What's next? Refocus. So the second part of this is to just refocus, get that vision back in your mind, because you've lost it. That's gone. It's dull. It's faded because you're so focused on there, and you kind of, you know what it's like. You're breaking a rule. You're like, this market goes up. I will never break a rule again. And all this stuff that you kind of go through in your mind and you talk about, and you're like, okay, just forgive yourself, refocus, get that vision back in, make it bright, see it there, see that future trader that we talked about, have him there, have him there, have him there, her, bang, bang, straight in there. It just resets your mind, refocuses your mind of where you're headed. And then recalibrate. And recalibrate to me is checking over your process, your actions. Can you simplify things? Have you got too many rules? Common mistake traders make, rules, all these rules. Like, how the heck are you ever going to stick to them when you've got to do this and this and this and this and this and this? Same with strategies, right? Excuse me. Same with strategies. You're pulling the trigger and you've got all these trigger rules, and that's got to line up, and this indicator's got to be here, and that's got to be above this bar, and that's got to do that, and that's got to have a wick after this, and we've got to be an uptrend on the daily, we've got the linear regression's got to be here. Stochastics, I'm over exaggerating, but you get the idea. Can you simplify stuff that makes it easier for you to stick to the rules that you've set for yourself and your habits? How do you need to change? And it's that recalibration process of going, okay, well, what caused me to break my rules this time? What caused me to dive into the trade? What caused me to have that FOMO? What caused me to take that substandard deal that I know I shouldn't be because the market's choppy and sloppy? What is it? And then reverse engineer it a little bit and go, okay, maybe I just need to be mindful because I'm making this mistake regularly. Maybe you're trading at the open if you're trading kind of an index, or you're trading a stock, or, even you're trading a currency pair, right? And you see that sort of spike after, maybe you're trading at a time you don't want to trade. So how do you kind of alleviate that? Do you make sure you're not on the screen to be tempted? What sort of tricks and hacks can you do to make you stick to the rules that you've set for yourself? Simplify, recalibrate. Okay, the fourth thing is to re-engage. And this is when you get back on it. You've reset yourself, you're recalibrated, you're like, right, focus on the process. Focus on the process. If I stick to the process and the plan, the market can't harm you. If you deviate from the process and you break the risk rules, the market can, of course, it can harm you. You can end up blowing up, all this kind of stuff. So you stick into the process. What's your process? Again, you visualize that trader, go back, you've simplified your plan. Now you're like, right, what's the plan? It's a simpler plan. It's more refined. What is the process? The process is I come in, I do this pre-market prep, I check this, I check that, I look for this, I scan, I screen, I set my alerts, whatever it may be, stick to the process. And the fifth and final thing is just to repeat. You're going to fall off. In other words, you're going to not be perfect. You're going to be imperfect. It's probably better terminology, right? You're going to be imperfect. You're going to make mistakes. You're going to slip up. You're going to miss something. You're not going to be a perfect 100% week. You're going to have mistakes. So you just constantly do this. You do the 5Rs. You refocus, you simplify, you get back on. And you repeat the process, you iterate, you improve. This is where most people fall by the wayside, right? They do all the good stuff, they get going, and the first sign of a mistake, they go, I can't do this. I can't do this. And they throw everything away. Good example, right? You've been on a diet. Let's say you want to lose some body fat. You're like, okay, I need to just be careful of my carbs and my sugar and all this type of stuff. And you go into the fridge and you eat a piece of cake, right? Or you eat a piece of chocolate. You go, well, I've eaten a piece of chocolate. I'll eat the whole thing. Before you know, you've eaten the whole bar of chocolate or the whole cake. Because you think, well, why not? I broke the rules. That's the separator, right? Between someone who goes, okay, I slipped up. I broke my rule once. That's fine. It's not going to be an issue, but it's catching it. And the same with trading. Breaking one rule once, probably not going to be an issue. Missing something you're supposed to do, not going to be an issue, but just don't let it become a habit. And again, don't beat yourself up about it and throw the whole thing and say, well, I've broken one rule. I might as well try any size I want, any strategy I want. I might as well just do stuff just to try and get it. But, that's just a mistake. It's still saying focus. And that's the test. The test is that if you do fail and you slip up, get yourself back on. Try not to. Try and get it better. Try and go trade in alignment with the future trader, future self you've got reminded in your brain and all that type of stuff. But it's okay if you have a process, again, for what happens if you do slip up. Get back on, iterate, improve, simplify. So final thing I want to say to you guys is this, is just keep moving forward. It's easy to fall back into old ways. It's easy to fall back into the default trader that you've always been and got the same results you're always going to get. Now, listen, if you're watching this and you're getting absolutely fantastic results, maybe this will improve your results. But if you're watching this and you're not really where you want to be as a trader, you feel like you've got the knowledge, you feel like you know a lot about trading, you've got some experience, but you're just sitting there, zoom, 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 the wheels are just spinning. This might be the thing that just gives you that traction. Just keep moving forward. Don't fall back into the old ways. State to yourself now, I'm going to become that trader that I know is the trader who can take me to the goal that I've set or the goals that I've set. If you make that commitment, then you can only keep moving forward. And the P&L doesn't matter. As long as your risk, again, why does the P&L matter? If your risk is so low and it's structured in a way that you're not going to blow it, not going to do some damage, then it's okay. You don't have to look at the P&L. You don't have to worry about the P&L. It's like, yeah, that'll take care of itself. The focus on the process. And remember, falling back into old ways and having that test, that emotional kind of decision, you've got impulse decision during the trading day is the separator. It is the test. So the summary for you, be crystal clear in your vision. What does that person look like in your vision? Construct a plan that encompasses all the actions of that trader. So we start to write stuff down. Then, tough part, acting in congruence with the way your future trader would be. And then the fifth one is lean on those 5 R's of reset, refocus, recalibrate, re-engage, and repeat. And that is when you just kind of improve, make mistakes, get back on, improve. So it's a never-ending process of constant improvement in your trading. And if you can do that, then just think what sort of trader you'll be in 30 days, 90 days, 120 days, 1 year, 2 years, 5 years. If you don't do that and you're spinning your wheels and you're going round and round and round, you might be in the same position. So it's something to consider. Right, I hope there's been some value to you guys. If you'd like to ask questions, I will look in the chat. Oh, there's a few in the chat. Let me have a look. We've got some time for questions. Okay.
Yeah, you want me to go over some of the questions, Mark?
Yeah, go on, Sol. If you found something that's really...
Rafael asked it before. Do you think wanting to open your own fund in 5 years is clear enough of a vision?
I think that's good. I think you can be more specific. What sort of fund? How much you want to be managing? You just want to start the ball rolling at that point in time. Be specific about it so that when you have that in your mind, you can imagine yourself. And where are you operating from as well? Are you operating from a fancy office? Have you got a team? Are you yourself? Is it a small fund? Are you building? How are you just going to be specific about that? Because those specific parameters and variables matter, because your brain goes, oh, this feels real. Like, I can smell that new carpet in the office. That view's amazing over the city, whatever it may be, right? And I'm kind of speculating here, but I think that's a good start. But if you can go deeper on that, then I think great.
Correct. Then Patrick asks how to draw the line between a dream and a vision.
How to draw the line between a dream and a vision. I think a dream is something that every human being has, right? Everyone has a dream of, I want to get rich, I want to do this, I want to do that, I want to do the other, whatever it may be. I think that, if we're defining a vision as kind of the goal, that's when you reverse engineer and saying, how the hell do I get there? Yes, I want. And this applies all areas in life, right? Not just trading. How do you want a good relationship? How do you want a good body? All this type of stuff. And it's, well, you reverse engineer back and go, hey, I need to do this, I need to do this, I need to do this. It's going to take time. But if I know that if I just keep chugging and keep moving forward, that's more of a vision than a dream. It's the pathway to get to that dream, if you like, I think is the vision.
Correct. Then we have, what do you trade and what times during the day you trade?
I like to trade YM. I like to trade NQ. During the trading day, I like the open sometimes. Sometimes the open can be a bit cruel to you. It can be a bit cruel. But I also like to look for kind of on the daily chart, reverse engineer, go back and see if I can preempt a 1 to 3 day move potentially sometimes on that type of thing. If there's a stock in play, I'll go to that. I don't trade FX that much, but those are kind of generally my go-to type of things. Anything there's a supply-demand imbalance, I kind of gravitate towards that. And if I can express the idea with a reasonable amount of risk, then, you know, I don't really mind.
Right, and there's a lot of compliments for you, of course. And then what was the last R in the 5Rs? So maybe you can
bring them back up for you guys.
Of course, if there's more questions, guys, just this is the time to ask those.
Last R was repeat, and so that what a repeat means is that you don't give up when something doesn't work. You go back to the start and you go, okay, I'm going to carry on. I'm going to repeat the process. I'm just going to iterate and improve. I'm going to simplify the things that I need to simplify. Does my strategy need simplifying? Do I need to maybe you need to go up the time frame a little bit? What is it that's causing you to break your rules? You know, a lot of guys are trading the 1 minute. That's fine, but if that 1 minute is causing you to get sucked into little spikes and stuff, then maybe go up to a 3 or a 5. You don't have to stay there forever. You're not tattooing on your skull the type of trader you are. You can change. So, you know, it's just that. It's improving and iterating and being objective. And one thing I want to mention, sorry, I knew another question there. There's something I only recently came across called the Stockdale paradox. I think that's right. And the Stockdale paradox is this. And this was a guy who was a POW, I believe he was in Vietnam. Someone can fact check me on this. But he basically said this. 2 things. One, you've got to be absolutely honest about the current situation you're in. But number 2, you also have to have belief that it's going to get better and you're going to get to where you want to go. So you have to have both. You can't just go, oh, I'm going to become a great trader and everything's great, without honesty of, hey, I'm messing up here. I'm not doing this. I'm not doing that. I think that's great. It's having that, not being negative, but being realistic about where you are, but at the same time knowing that you're headed to somewhere fresh.
Amazing. Now it's my question. If you mind sharing, Mark, what was your vision 10 years ago? What was your mission, your vision for you as a trader?
Do you know, I'll give you further back than that. My vision when I started trading was just to be able to trade, make enough money to have food and fuel for my motorbike. That was my vision, right? And it was, and honestly, it's a good question, because if I could go back, I'd have said, think bigger. And it was only until I started making money and doing well, then my vision started to get bigger. It started to get larger, and I started to realize what was possible. But when you're 21, all you want is like to be doing something you love, making some money, and be able to ride around. And, that was what my vision was. So that's a really good question. So I would say my vision was nowhere near big enough. Think big. By all means, then go back and go, well, actually, yes, I'd like to be a hedge fund manager managing a £100 million account, £20 million account, whatever it may be. But go back and go, well, first step is just to make my first 50 grand, just to make that, I think that's the better way of doing it.
Correct. Now, Matt, my Vice asked here, based on more than 20 years of experience, what would be a realistic target to be on a monthly basis? Percentage-ish. I heard the number 20% quite often. What's your opinion about such a figure, like realistic percentage return on a monthly basis?
Do you know what? I think obviously this is very subjective, right? Because the more risk you're taking, the more potential reward you've got, but the more chance you've got to blow up. And don't forget that, however strong your edge is, if you're leveraging yourself up way too much, just by the statistics and the numbers, you've got to be careful you don't blow up. So you can say, yeah, I want to hit 20% a month. And that's aggressive, right? That's aggressive. And maybe you need to do that because to make it worthwhile, you have to swing for the fences a little bit and kind of really move. But at the end of the day, I think the mistake, maybe it's not a mistake, but for me, capital is a tool. Right? We're not trading to make a percentage return. We're not money managers. It's a tool that we're using and we're leveraging up as we want to. And so thinking about capital as a tool and saying, right, how much prepared to risk of this? What's the maximum drawdown? And thinking of it like that, I think is a little bit better. And then you can just reverse engineer from that. I know that some guys, I know a guy who's got a £2 million trading account and he looks to double it every year. He says, if I can do 100% a year, then that's really good because I'm working hard, I'm putting effort in, I'm day trading the S&P 500, and I want to be rewarded for that. And $2 million for that seems legitimate for him. If you're trading a smaller account, you might go, hey, you know what? I need to be aggressive to make it work for me.
Right.
And there was another question: will you be at the Traders Day Live event in London?
I will.
So if I might take a minute here, and I will share just 1 minute about the event. Yeah, Mark will be there. So will be one of the featured speakers there. So for everyone wanted to meet Mark in person, so he'll be there, together with many other speakers, high-tier speakers in the industry. So yeah, go to Traders Day Live, guys. If you haven't got your ticket, make sure you do. Mark will be speaking about, if I recall right, strategy development and price action day trading strategies. And I just noticed he's at the same time as myself. So I'll make sure I move myself to another hour, because everyone would be going to Mark's presentation, and all the rest will be empty. So I'll move my hour.
Do you know, I've just noticed, Sol, that you've got Steve Ward there. Steve Ward is a top guy to listen to. He will drop some absolute knowledge bombs. If you like your psychology, you like your discipline, you like your mindset, yeah, Steve Ward is the man. We've had him as a guest a couple of times, and he is just super knowledgeable. So yeah, looking forward to. I'm not on the same time as him, am I? Because I want to watch him.
No, he's in the afternoon, so he'll be speaking to by himself. Yeah, of course, he coaches institutional traders. Yeah. But even Mark, yourself, and Simon. Simon is not very known out there because he is an institutional trader, and he manages 8-figure funds. And of course, Martin, he's an algo trader, and Charlie Burton, and very big names here. So very exciting for the event. So let's see if there's any other question out there. Let me check the chat. You joined the event, expecting nothing else. Thank you. I'm trying to cultivate my ambitions. For very nice input, Mark. So I think that's it, Mark. I really appreciate you, coming into the webinar and delivering the content. It's very, very, very valuable. I so relate to many things you talked about. And yeah, we'll be in contact, Mark, and we'll edit this, and someday next week we'll go to the channel. So
thank you,
guys,
thank you everyone who's turned up. I know you've got other things that you can potentially be doing, so I appreciate your time. I hope I've added some value to you, and maybe we're back again.
Yeah,
thank you, guys.
Yeah, I appreciate it, and thank you for the traders for coming, for staying, for the questions, and Mark, thanks again, and we'll be in touch.
Thank you, guys. Take care. Good trading. Bye-bye.
Bye-bye.
Okay, good day, everyone. This is Gil, and today we're having a public webinar about one of the things that is less spoken, but if you on the verge or aiming for being a professional trader, you should be considered. We are trading not just for fun. We want to make it to be a profession, and for that we need to adopt all sorts of skills and concepts that will help us overcome the unique features of what it is being a professional trader. So this webinar is all about these aspects, and it's based on my years of experience and the things that I've been learning throughout my course of being a trader, and through my course of educating traders along the years. I've collected a lot of insights that I gained for myself, and I was trying to create ways to deal with the unique challenges that trading is facing. So let's just start with this, and we'll see where we're going. Feel free to ask questions, and let's move on. Okay, so what is the attitude that we need to for becoming a good trader? What is it that we need to embrace in our thoughts, to change the way that we think in order to be a professional, successful trader? One thing is the things that we're going to discuss today is what is a professional trader and what are the unique features of this profession. I will talk about some paradox that are in the profession and some similarities to different professions, and and uh, I will try to map out things that we need to consider in the way that we develop ourselves as professional traders. And as much as we can reach out and the insights that we can collect and find solution for all these features that will help us to grow into for being a good and professional traders. So let's start by simulating what it is, what it takes to be Leonardo Messi, what it takes to be Jimmy, what it takes to be Serena Williams. You know, all these professional athletes that we're seeing, they are just um, exploding on the courts and they are highly professional, but we have something in common with them. The thing that is common with you and Serena and Jimmy and Leo is that when you are trading on a real life trading account, you are trading the major league. You are competing, Serena Williams. You are playing guitar with Jimi Hendrix, and you need to be at least as good as him in order to have the audience listening to you. You need to be as good as Leo Messi in order to take money from the same court that he's playing against you. So just imagine, and this is something that I say maybe to scare or to shock you, but this is how serious this business is. When you put your first real dollar in the market, you are playing the major league. You are playing the Premier League, and that only. There's only one league in the market. You don't have little league. You don't have amateur leagues. You have to excel on this major professional league from your very first dollar in the market. So just mind who are the players you're playing against, okay? And you cannot afford yourself to be an amateur because they will eat you alive. They will play tricks that works for years, for decades. The same tricks are being played on amateurs and they're taking their money all of the time. There's only one league you can join when you put your dollars in. This is what makes it different from almost any other profession. If you think of maybe, let's say, open a restaurant, you can be an average restaurant with good location and you'll have business and you can make a living. But in trading, you have to compete Serena Williams, right? You have to compete Leo Messi in order to make money on the market. There's only one league, okay? I hope you get my point. So the things that are challenging us in the thing that are challenging us in this profession are things that we need to resolve. And if we resolve them, then we will have the edge for succeeding. And one thing that puts a lot of people in stress is the definition of what is success. And if we are stick to this example of professional high-end athletes or very highly skilled guitar player like Mark Knopfler, David Gilmour, Jimi Hendrix, just name it. They are all being on the stage and we love what they're doing and we're just being so impressed with how professional they are. But just remember how many years are invested in practice, in exploring, and in try and error. All these things are mostly not available for us when we are being entertained by their master's skills. So in order for us to develop ourselves to be at that top level, it takes a lot of learning and self-development for us to do before we can actually being on that professional court. So I was mapping a little bit of things parameters that I think that if we resolve them, if we understand and if we acknowledge them as our challenges, and if we can resolve them, then we can start building step by step a success path toward absolute success. And one thing that I think that is the most insightful thing that I can tell you today is that when you define success, you should define it not just by a binary way, just let's say I'm earning money on the market or I'm losing money on the market. Success should have more shades to it. It really depends on what stage you are at the moment. Let's say you are now a losing trader. Your next goal, your next success will be to be a break-even trader. Okay, if you are a break-even trader, your next goal will be to be a profitable trader. When you are a profitable trader, your next goal, your next success will be to gain more pips, more money than pips. Okay, because you know there are some ways that you can just compensate for losing pips, but still winning money. So maybe your trading is not that efficient. You can be more efficient even when you're making money. So there's always a new horizon that is expanded from the hill that you're standing on. And these should be your shades of success. It's not just about making money or not. It's about progression. It's about what is the thing that you need to work on in order to achieve the ultimate success that will come within a few years. And you know, there is this saying that there's this rule of 10,000 hours. If you invest 10,000 hours of something, then you become a master of it. I think in trading, it's sometimes works and sometimes it don't, because it really depends on your personality and on the way that you perceive success and fail, and how stubborn you are, and how and if you were taking the good path. I can tell you that from my experience at the beginning, I had today I know, but back then I didn't know. I had at first not so good teachers that taught me the basics that I needed, and they were teaching me the wrong things. I don't know if these are the wrong things, but they were wrong for me until I've found the thing that that made me successful. It took me a few years to find that. So that was my goal. So for my success at the beginning should have been not making money, but finding the right strategy or the right method that it makes sense to me and that I can work with, and be creative and adaptive to whatever the market is challenging me with. So until then, it took me about 4 to 5 years to find the right thing that actually made sense for me. And then I needed another year or two to master this. And then, so just imagine and just plot this to yourself. There are many shades of success. And this is something that we're trying to do also in the 5ers. We're trying to define success with different shades. It's not just about if you make the challenge for the first time. This is why we're very tolerant and letting people competing once or twice or even a few times until they make it to PM, and then they make it to PM 1, 2, 3, and so on. It's because it's all about progression. We are humans, we are gaining skills, and this is the very essence of how we should consider ourselves as traders. Trading is not technical task. If you do this and that, you'll have success. It's not working like that. It's a skill. We all have the information. We all have the teachers that will teach us how to play tennis, how to play soccer. We all have the courts. We have available all these. We all can put our hands on a guitar, but we cannot play like Jimmy. Unless we've put the hours, we put the knowledge, we've learned everything, we have the right insights, we progress step by step. So same thing with trading. Trading is a performance skill profession. It's not about doing the right thing. You can do the same thing, the same algorithm, but it's not work. If you're not adaptive enough for things that are changing, you're not going to make it. If you if we both enter the market at the same price, and I'm greedy and I'll wait for a bigger wave, and you'll take your profit half of what I did, I can just close my trade at break even or hit my stop loss because the market didn't hit my target, but it hit yours. So you're a winner, I'm a loser, and we both enter the same price, the same direction, the same asset, right? So it's all about your patience, your humbleness, your awareness, about knowing what are your limits, what are your strengths. All of these elements should be learned by yourself, and that will configure the way that you actually embrace success in trading. So let's start by, I've been mapping a few elements of what it is to be trading, and this is only my opinion. Maybe just let's move on through this, and I think you'll get the concept, and you can add your own and try to analyze and how you bring this, bring more ideas to this, and try to resolve this with your own self. And okay, so first, the market puts you in an environment that has a lot of uncertainty. So to deal with uncertainty, you have first to be humble. What it means to be humble? It means that you don't say to yourself, I know where the market is going to. I'm not about, trading is not about predicting. You know, we are sometimes associating with, I think they call daily FX. They are very big and considerably one of the leaders media for our industry. And they were asking me before the beginning of 2021 to give them predictions of where will be the euro dollar, where will be the pound dollar within these quarters, and they asked me to specify rates for where the cable will be at the end of the third quarter of 2021. I told them that I'm not participating in this. I'm not about predicting. I think trading is playing tactics, is playing what you see, is playing about, is looking at what you have and looking what the charts are telling you and playing upon this. I don't know what's going on. I don't know where it's going to be because of many things. We'll cover this in just a few, but we have to be humble. We have to admit that we don't know nothing. We can only play about what we're doing, and we cannot be arrogant and saying that we can predict and stick to that position because we're thinking that the price must go in our direction. The price won't listen to us. The only thing that we can do is play tactics. And what is playing tactics? It's like when you're riding waves on the sea, you don't say, I know where the waves will be and where it's going to break. Every milliseconds that you are on that wave, it's decision making and acting with the situation that the ocean gives you. And if you're talented enough and skillful enough and experienced enough, you will know how to ride that wave all the way through. And if you're not, the wave will take you halfway. You won't get to enjoy the pipe. You know, all these things that are the the positions of the skillful and the people that we're very jealous of. So we can only play on what we're seeing. And one way to resolve this uncertainty thing is to have a scenarios action plan. I think I've covered this about 2 or 3 years ago in a webinar. I think it's part 4 on the first webinar series we've done with investing.com about supply and demand. And and we've described how we can have our trade and still get into our trade and still be very attentive to what's going on instead of just entering the market and just waiting for the market to resolve our trade to a win or to a loss. Because when we decide to enter, many things can happen. You know, the market can jump away from you toward your winning side. It can chop you always around the break even. Sometimes you're on a little plus, sometimes you're a little minus for a very long time, and then it wear you out. You'll be tired. You'll take yourself out on a break even, and then price spring to your direction. So you will ride, but you're not in the trade anymore. You know, all these things can happen. If you learn about all the scenarios that you have experienced and you write them down and you say, okay, if I enter the market and the market do this and that for me, I will do 1, 2, 3. I will have scenarios and action plan. So when the market puts me through a certain scenario, I will have a ready-made scenario, a plan to act upon. Okay, so and maybe not all of the time, and for certainty, it's not going to be all of the time that your action plan will work, but it's a plan. And if you stick to the plan and you know the plan is right because you've studied it and because you've back tested it, you should have the odds to win it by the statistics, right? So if you map your scenarios according to your understanding of what the market is doing, and then that's one resolution of how to deal with uncertainty. We've covered this. We're playing the Premier League and there's only one league. So what it means for us to resolve is that we really have to have a plan. We have to have a trading plan. We have to know how to find the best trades. We have to know how to not taking bad trades. Even if these trades turn out to be good, we should not be dazzled by this or by the result, because if we have a profile of what is a good trade, because we've reasoned this profile by backtesting, the market is always going to confuse us with bad entries that work and good entries that won't work, because taking a losses is part of the game. Taking losses is part of playing statistics with the market, because this is only the only tool that we have. We play statistics. So this is why we really have to stick to the entry and take only entries where we know that we have a very good probability, or maybe the best probability to take them, unless, I mean, this is my way of doing things, unless your probability is taking a lot of trades, and then few of these trades will work wonderfully, and you know how to make the extra, the premium from that way of trading. So I'm not very good in managing a lot of information in front of me. It's get me confused. So I prefer to cherry pick my trades, and I think with my method, I have enough opportunities for the time scale that I'm working on. So I find my comfort zone on that. But if you think that you want to experience and enter the market many times until you find your bonanza, that's good too. But that will be your way of finding your high profile trade. Okay, and you should know that that should work for you. But whatever strategy that you have for your entry, you have to have a good and solid and non-negotiable loss strategy. You should take losses with pride, and I think I've taught this also in my webinars, that if you are having hard time taking losses, try to train yourself that every time you take a loss that was pre-planned, or it's within the parameter of the loss that you are planning to, meaning let's say you're risking only 0.5% of the account, and you've taken that 0.5% and you never shift that stop loss against your agenda, and you've taken that loss, go to the mirror and celebrate with a big smile, because you've done the right thing. So every time you take a loss that it is within your parameter, it's not a fail, okay? Because the market is not predictable. So, and we're playing risk management. So you were doing a great job by taking the loss that you were pre-planning, okay? And if it's a reasoned one, and if you know why you've taken it and why you've placed that stop there, and it makes sense to your trading plan, then you should go and celebrate a loss. Train yourself to love and respect the losses that you're taking, because taking losses is a very, very hard job. It's practically, and we'll cover this in 2 topics away, it's practically a counterintuitive challenge that is unique to the market. And we'll talk about this in just 2 topics away. Next thing is that you need to be very adaptive. You know, you're playing the pros when you're on that court, and they have a lot of tools that you don't have. We'll discuss this in a second as well. But just know, be very much aware that they have tools that you don't have. And we can only look at the current and the history, and we have no way or no effective action that will actually create an impression on the market or something that that can change something in the market. We can only be responsive with the amount of money that we're trading, most of us, right? Unless we're a big fund where we can just manipulate the market. So we can, they will play a lot of tricks, and sometimes they will be aware of different methods that in the market we are all seeing the same charts, we are all seeing the same news channels, we're all seeing Bloomberg and Reuters and reading the same feeds of news, and so they know what the mass of people will think about the information that everybody's seeing, and they will play with it. Sometimes they will let you feel that you're right, so next time they can trick you. Okay, so I'm not trying to scare you, but this is, just imagine that if you had that ability to influence, you would do that too, right? Because it's a game of chess, it's a game of mind. So you really have to be adaptive. Sometimes your system won't work and you need to figure out why. Maybe it's a higher time frame point of interest for the big players. So that's why it's not working anymore. And then when it's over that zone, it will return to act normal in the terms of your strategy, and maybe not. So you really have to be adaptive. This is why robots and EAs won't work for very long, because the market is ever changing, and every time market is reaching to an interest point, different tricks are being played. And so there's nothing to compare with the human mind or the human way of processing information, faster and more efficient and more creative and more understanding than just the human brain. So we've just mentioned this. The market put us through an ever-changing condition, and we really have to manage this. So in one way, we can not always spot the right moment where the market is changing. So this is why we really have to have a very solid risk management. We should enter every trade and consider the worst can happen. The black swan will happen against our position the very next second after we've entered. How are we going to protect ourselves from devastating months or weeks or days or money of effort that we've put through? We cannot allow ourselves to invest many years and then lose everything on one trade just because we were not wearing a seatbelt. So a seatbelt is a stop loss, and lucky for us on the Forex market, stop loss is mostly respected around the prices that we've asked, unless there is a major news and there are gaps in the market. But unlike the stocks market and the futures, we have more opportunities to receive the price that we've put for our stocks than than from other markets. So just use it. And even if you say, I'm using hidden stop loss, I'm using conditional stop loss, do use a hard stop loss at a catastrophic level, way beyond where your logic would be taking you out, where you should be, because sometimes the market will be so much faster than you can operate, and so you have to have that another tire of risk management. Every time you enter the market, it's in terms of position size. Don't trade too much, be humble, take it step by step, the turtle way to grow your account, and don't be greedy. And also in terms of stop, put your catastrophic stop way beyond and let your mental stop loss or your algorithmic stop loss work for you, but do have that extra measure of risk management. And then you should have the action plan. The action plan is something we're trying to promote and educate quite a lot here with the 5ers. If you know about our risk management booklet that we've sent to all of the traders last month. If you didn't, you can go and you can have your own copy of this. We send it to your home. It's actually a physical booklet with a lot of instructions where you actually being dictated how to write your own trading agenda and plan, and it will challenge you to really deep think about your strategy. And then it has a lot of logging papers where you can just learn and analyze and summarize your activity throughout the time. And that is we got a lot of great great reviews about this booklet, and people were very happy and find it very efficient for their daily routine. And if you want to get it, just sign up for Saul risk management course. And if you complete this, then you can sign up and we will send you that booklet. So it's really valuable. So you should have a very solid action plan where you you think of all the different elements and you become aware of things. And then you and if you write down your manifest of how you're trading, this is actually become the policy of your business. Just imagine that every business has its own routine, its own way of doing things. It's knowing the system, how it works for them. Just compare this to any type of business. They have policy of how they do things, and so do you. And unfortunately, not many traders do that because it's a one-person business. So you don't have to report to anyone, and so you don't have that conversation that actually brings new ideas and ignite new ideas or challenge your thoughts, sometimes for the better, sometimes for the worse. But you don't have that environment where you can learn from the experience, or you can refine your experience by explaining to the less experienced people. You don't have that thing that an office have, because you're working just for yourself. So working on your paper and being interviewed by a paper like we've done, but you can also look up in the internet all these templates for the trading plan. That will make you smarter and more solid and more defined with your action plan. Next thing is you really need to learn new tricks. You should know what tricks are being played on the markets that you are mastering, and you should learn new tricks yourself, how to actually take advantage of what you're knowing. So always be on the side that learn new things, explore them, but there's a downside for this. Try not to get confused with this. Okay, don't try to take new ideas straight away into the real market situation. Try to demo test this, try to combine this slowly. If you have new things and even if you're really trusting them, start slow, start with very low positions, so you just can sense how it works for you, how it makes sense, because only when you're live with these ideas, you will understand what it really means. So you really need always to reinvent yourself, learn new tricks, learn new stuff, more methods, more tools to collect to your toolbox. One thing a lot of people are doing wrong is that they are putting their trust and their money on logics that they were never trying themselves. And I'm speaking of downloading all these indicators that give you signals, or EAs that you don't know really who had coded this. And even if you know the logic or the concept behind this code, you don't know what bugs are in this code and what the true limitations are in it. Don't trust all these things. I know it's a shortcut, and we are all of us are very eager to participate in this exciting market and making money and everything, but be modest, be more slowly with your learning, be more cautious, be less naive with what other people were doing. Just remember that the market is ever changing. A code that was written a year ago is not necessarily going to work good at these days. If you have a code that has too many specification, if it's a 0.1 factor versus 0.2 factor just on the pound Japanese yen, and it won't work on this, this is no good, because the pound Japanese yen will change in a week. It will change its behavior and it won't work anymore. So too many people are trusting these shortcuts, and it's just a wrong thing to do. Trust only yourself. Trust only your backtesting and understanding. If you don't know why this strategy works, don't go for it. Just learn and find out what stands behind it. So now let's go back to the counterintuitive. So this is my one of my favorite things that I talk to people that are new to the market, and I'm always surprised that people that are many years in the market are not truly understanding this in full. Just think about how much agony you are experiencing. Each one of you think, if you're 1 year or 5 years or 8 years in the market, I can tell you that I'm in the market since 2006, for me, taking a loss or seeing my trade getting into the stop loss is painful, even today. Okay, cutting loss is a counterintuitive feature of the market. It's so hard to take. I think it's one of the hardest things to that this profession puts you through. And I tell you why. Because from the very early age, we are being educated to be like Serena Williams, to be like Roger Federer, to be as good as possible. We are put into a symmetric court where we both have the same conditions, let's say on basketball. And if the team against us are winning, what are we going to do? Are we going to surrender and tell them, okay, take the game. We still have like 15 minutes for the game, but I know you're going to win, so I give up? No, the coach will tell us fight, 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 right? So this is how we are trained. If we are seeing a loss, we are trained not to give up. But in the market, it's really the other way. If the trade goes against us, it will be very hard for us to take a different mental approach and say, okay, I'm losing that trade and I need to give up. I need to cut this loss now. Why? Because I will do after the entry analysis, and I will see as much as possible, as much as clear, as much as non-conditional, and it's very hard to do so, that the trade is going against me and I really have to cut this loss. And there's another thing, that there is no coach or crowd or my father on the sideline that will tell me, cut this loss. Okay, I have to take that decision myself against the way that I was trained and cultured since I'm a child. We are being taught to fight all the way to the end, but it's not true for trading the market. If we're seeing the trade is not going our side, and we have the ability to cut all our emotions and do new analysis and see, well, this trade won't last. We have no control over what the market will do. But if we have all indicators telling us that it's going the wrong way, most people will ignore these flags and signs and alerts, and they will say, okay, I will give it another chance. I will fight for this. I will maybe shift stop loss a little bit lower, so I will let my trade breathe and come back to break even or so. Believe me, I'm doing this mistake every now and then, even today. It's so hard. It's so counterintuitive. I think it's the hardest thing to do. It's to take your own decision against your previous decision for entering, admitting that you that the trade won't go and not letting go. It's everything against what we were brought on. So cutting a loss, it's very hard. How we can resolve this, I think we've discussed this before. We really have to train ourselves to respect losses. And if the loss was cut at the right time within our trading plan parameters, we should go to the mirror, smile and celebrate and say, we've done good, because we were protecting our portfolio. It's not about one trade, it's about the whole portfolio. It's about the whole month of hard labor and time and effort and emotions that is put through. And we really have to cut this as soon as possible, as soon as we know that it's going the wrong way. It's really hard, but every time I cut a heavy loss, I just take off this heavy weight from myself and I say, okay, I cannot return this loss, but if I had to suffer this a little longer, that would be even more painful. Now I'm relieved because I can continue doing the things that I'm doing. I can continue working on my well-proven statistical way of trading, because I know I have good risk management. Few of them will lose. It was within my parameters. I'm happy, I'm celebrating, even if it's artificial. I really have to train myself to respect losses, and it's hard. So you should work on this. Fear of missing out is another aspect of a lot of people doing. It will prevent you from being, people are backtesting systems, and when you're backtesting, you would really wait for the signal to blink for you, right? But then on real market situation, if you've seen that signal and you've missed it by a few moments or by a few hours, depends on the time frame that you're working, you would jump on it because you're fearing to miss out. Maybe you get too early, maybe you get too late, but this thing happening all of the time, and that's the difference between backtesting or demo trading and in real trading. Because in real trading, we are in the real world. We say, okay, we had this opportunity, we're waiting for it. We spend the time, we spend the thoughts, we did the analysis, we talked about it, reasoned with it. Now we've missed it. I can't afford not to be in that trade. And the worst thing that can happen to you on this is if that works for you, because then you'll do it over and over again. And that's a wrong thing to do, because when you're getting in too early or when you're getting in too late, the drawdown and the risk reward ratio factor will damage you a lot. And also the time spent in drawdown will put you through so much agony, and your margin will be caught by this trade. Everything is wrong about this. Stay away from it. Be aware of it. We're also over competitive. It's part of what I've explained with the issue of cutting loss. We are trained to be competitive. If something don't work, we try harder, right? The teacher tell us if you're not good in math, try harder, work harder. It's counterintuitive on the market. In the market, you don't need to work harder. You don't need to overtrade. You don't need to spend more time or more effort or work harder. You just need to do the right thing. And the right thing will appear when it's appearing. So you cannot apply over competitiveness on this. You really need to just wait for the next true cherry-picked signal. So you can't be over competitive, but we are. If a daily or a weekly target haven't reached, should we stay more on the screen? Should we enter more reckless trades because we want to achieve that goal? So over competitive is something people are not really aware of, and it's over intuitive. If I work at I don't know, and I try to satisfy my boss, and I'm working and I'm not delivering enough, I will stay over hours to complete the task and make my boss happy, right? This is how all the movies on Hollywood works, right? But it's not right for the market. The market is always giving you the opportunities when it's right. So every time you're out and waiting for your next trade, just wait for the right time where your system blinks for you with the most probability cherry-picked profile. Confidence is also an issue. Overconfidence or lack of confidence. If we have a good strikes, then we're overconfident and we can be reckless. And if we had bad strikes, we can be unconfident, and maybe we won't get into the signals that we're seeing. We should learn how we are actually being affected by this. But this is actually not really counterintuitive to a real life situation, but it is counterintuitive to what you're feeling. Your feeling telling you that you should be aware next time you enter the market because you're uncomfortable. Your feeling telling you that you have it, and every time you click on the keyboard, you'll have a winner trade. That's what your feeling are going to tell you and signal to you, and that will make you reckless or too much careful for not taking your signals. So, and one of the things that most people are not aware of is the lack of authority. Most of us would come to trading because we want to leave our boss. We want to have our own business. We want to be responsible to our own financial future. And we want to hone that profession ourselves. And that put us into an environment where we are just myself and the computer. And every time I have a question or a doubt, I have actually nobody to talk to. Maybe I do have a mentor, maybe having a good trading pal that I can cooperate this. This is part of the solution. But for the major parts, I have to take the decision myself. And the worst thing is that so many times I will do repetitive errors that I might not be aware of that they are errors, because nobody is looking over my shoulder and sharing his experience and saying, you know, that you're doing this over and over, and that puts you through bad results, right? The overcome is because you're doing that and that. This is based on my 20 years of experience. Nobody's telling you that. You have to learn this yourself and find out this yourself. It's really something that it's almost impossible to be aware of something that you're not aware. Because it's a lonely thing, we are trying to educate ourselves, and it's much harder and much longer. And until we get the insight, maybe we gone through a lot of frustrating periods of times until we actually had this ringing bell and understanding what's going wrong. So because of we're working like this in an isolated workspace, our awareness and the blind spots that we are facing are sometimes very, very critical, and we are not very sure about this. To know how to cope with this, we really have to keep ourselves always in learning, always find mentors, always do courses, always learn broader aspects of what you're doing. Don't just spend your time on working on the analysis or working on the strategy or creating tools that help you resolve very specific issues. Learn on the broad aspect of the markets, of psychology, of yourself, even do yoga. You know, do meditation, whatever works for you in order to be more complete and whole when you come and aware of how you feel and what this profession puts you through psychologically and mentally, and how it's actually motivate you or put you through. These things really need to be learned. So always be in learning and expand your awareness to all different aspects, to knowledge, to strategies, to your own psychology, to your own behavior, to your own way of acting. Write a lot. All these things will help you to find out blind spots that you weren't aware of and find good resolutions for them. Because we are retail traders, after all, we're just small insects on this market. We have less access to information like the big players do. I think it's really obvious for me to saying this, but it's not just that we don't have the access and the subscriptions to good information. It is that we also are being exposed to too much information, noisy information, and deviated information, that it's really can be a daunting task to filter out and trust that information and what's their interest behind it. So that's one part of it. And the other part of it is that we're just a single person. And just imagine a trader that works on a big fund with another 50 traders, and he comes every morning and he sits on a round table with another 50 traders. Some of them are very, very experienced, and each one of them will say their own view on the market. Each one of them is working on a different aspect of information collecting. The amount of information that you have to reason with your decisions on the market is so much greater than you can have it your own. Even if you could have filtered all the noisy and all the deviated information in the market. So just being yourself is puts you in a very, very inferior position of access to information. So my way of doing this is playing statistics, playing probability. I will only enter key levels. I will only learn about the price action signals that tells me, okay, at this key level, I will look for this price action event. And if that works, I will enter, I will take that risk. I mean, having that plan of how to actually being tactic in the market is will help me find my probability environment, so I can extract money until I'll be big enough or talented enough to get into that big room with another 50 traders and maybe contribute and get their own contribution for my odds. But until then, I really have to be tactic. And you know, something that I always being opposed is that people calling their trading way a strategy. It's not strategy. Most of the trading systems that we are dealing as retail traders are not strategies, they are tactics. Okay, strategy is understanding the bigger picture and try to deploy a plan with different tactics to create the outcome that you want. We are just playing tactics. We just want to enter at price A and exit at price B, and that's it. That's tactic, not strategy. So it's a word too big for what most of us have. So if you want to have a strategy, then strategy is about the brain, it's about analysis, it's about a whole different understanding of what's going on in the market, and then you deploy one tactic action to actually exploit what you understand. Okay, so let's talk about what the big players are having. And again, the answer for this, I'll give you the spoiler. The answer for this is having your very solid trading plan, risk management, and mental awareness. But do know that the market is a serious court. It's where the professionals are playing. You know that the big funds, they are participating in the very same court that you are. And you know that they have a lot of power. What power do they have? They have enough deep pockets to do trial and error, or to create impressions in the market. They can invest millions just to make an impression that price is breaking a level, and that will bring so many people buying at higher price, and they will sell them this. Okay, so that's called manipulation. They will invest a lot of money for bringing price just 10 pips or 20 pips high to make an impression of something going on. They will freak out your indicators that will tell you that you have a good momentum to enter, and they will sell on you. This is manipulation that they can trick by injecting a lot of orders into the market, and they have the big enough pockets. And this is strategy, by the way. They invest. They can buy with millions just because they know they're going to sell you in 20 pips distance, because their position should be short. And this is why we see so many choppy price action so many times, because these are little manipulation playing out or being tried out by these, and they have a lot of pockets for this. And we are so desperate to win each and every trade of ours. Every time we are missing a trade and it's not working, it's devastating, right? We just enter one trade, it's not working. We say, okay, we didn't get it. We don't have a good strategy, right? But they are doing this all the time because they are playing with their deep pockets. Another thing is that they have the ability to actually feed the media with deviated information. Let's say Warren Buffett is having a full transparency with his portfolio. Everyone see his portfolio, and so a lot of people are taking his word and say, okay, if Warren Buffett is buying this, I will buy that too. But what is he doing? He already bought this, and he know his name has influence, right? And so if he say that he bought Tesla stock, everyone now will buy because the genius says so, and they are feeding his stock higher, and he can sell now. Okay, so just every time you hear somebody on the news saying something, he got an interest. So it's a tool that only people that have access to the media can deploy, and they are already positioned in a way that once their announcement will come out on the media, they will just take the fruits out of it. Okay, so that's a tool. This is what feeds Reuters and Bloomberg and CNN and CNBC Money and all these magazines. They are getting a lot of free items all of the time because these people that feed them information are just biased with their positions already. So sometimes you can ride on this, sometimes it's a trick, sometimes you can earn with it. You would never know. But the thing is, the lesson that I want to learn from it is that because we don't have these tools like they do, we have to be tactics. We have to play tactic, we have to play probability, and that's it. This is the only tool that we have. We cannot predict. We cannot justify our trade because Warren Buffett says so. We cannot justify our trade because somebody said something very, very smart and convincing. Because if it's convincing, it could be also manipulated and biased. And so don't buy any information from anyone because everything is biased. Be tactic, look at what's going on now, act, respect your losses if they come because everything can happen. We know nothing, we're just an insect on this thing and we can only play probability. And I think I've mentioned that we're just one person, we're one-man band that's doing analysis, we're entering the trade, we're managing the trade, we're spending the time, we're doing the monitoring, we're doing everything, and we're collecting information, and we're trying to make decisions. We don't have a boss, we don't have any more experienced people, somebody to teach us or to get us aware of something. All these are going against us. So we really have to be better and better all of the time. Continue learning and just be better. So I just remind you that we cannot afford being an amateur because we're playing on one league, which is the Premier League. And if we're getting there not ready, they are going to eat us alive. This is why we really have to be all of the time in control of what we're knowing, not giving out the control to other people that will tell us don't buy information from anyone, even from your friends or from your mentor. If it doesn't make sense to you, if you don't fully understand this, don't do it. Work on it until it sinks, until it makes you, until it really makes good logic for you. And so you understand and you know that you mastered this. For this, you have to practice and backtest. And this is one thing that athletes do and not, and many traders don't. How many of you are actually practice? You go, you trade live. Some of you are trading with us, with the 5ers, and you trade with us with real money. How many of you at the end of the day or during the weekend will take yourself and practice your trading and refine your trading plan and do all these mental procedures that you need to do? How many of you are doing this? But you can trust Serena Williams that when she's not on the court on a tour, she's lifting weights, she's running, she's working on her shots, she's working on her placement, she's working on tactics, she's working on mentality, she's doing massages and therapy and whatever. She is being prepared for the next time she's going to step on the court. How many of us are actually practicing and not just waking in the morning and playing on the court? Remember, trading is a profession of performance, of skill that is being collected through years and experience, through learning. So we have to practice all of the time. We have to experience and explore more ideas, right? So a good way to practice is to backtest our ideas, is to forensic ideas. We know, you can work only 6 hours a day, or 8 hours a day, or 4 hours a day. Whatever hours that you're working, you probably missed signals that were at the time that you were doing something else, or asleep, or partying, or whatever. Okay, so do go and backtest all the events that were happening that you weren't there, and see how you were reacting. Maybe you can find new scenarios that you can map and create action plans for them. Practice. Maybe you've learned, you've seen something new, and you need to and you think it's complementary to what you're doing. Maybe you want to incorporate this sometime soon. Go and practice. You can go and buy Forex Tester and try live testing. You can do it on TradingView. You can do it on MT5 with their backtesting thing. Do this occasionally. Go to the gym, go to the trading gym, because this is your profession. Go and practice. And yeah, preparation meeting opportunities is the really phrase I really like. Maybe you hear, I don't know if you brought it yourself or you heard my interview, because it's the quote that I really love. Thank you, Nirmal. Learn new stuff all of the time, because the market is constantly changing. It's constantly creating new forms, new tricks of playing, different incentives and bias, and participants are joining at different times. So everything is changing. Try to develop yourself and be more skillful all of the time, and explore. It's part of learning. Explore. It's learning and practice all together. These all together will bring you the control that you need, at least in our size. So overall, like Serena, like Jimmy, it's working hard, practicing hard, so we can perform in the money time the best way that we do. So we're working hard for making the trading easy. This is the essence of the mentality and the concept that you need to bring when you are come to trading. So thank you so much for being here. If you have any questions, I'd like to hear. If not, thank you so much. This this session will be recorded and placed on our YouTube channel, so you can review this later on. But I think it's more conceptual presentation, where you just need to intrigue you in thinking of trading as something that needs to be very much invested all around on your own qualities, and build it around your skill set, and this will also help you find the right attitude for finding your own success, because the way that I find success is not going to be yours. This is why so many people are being disappointed of mentors, because they seeing them success, but we're not, because we're not built the same in our personality. So that's the reason for it. Anyway, I hope you enjoyed this session and it intrigued you to rethink. And I remind you that if you go and do our risk management course on our website, at the end of it, if you finish it, you will be entitled to request the trading plan notebook that will be sent to your house at the end of it. So please do it. It's free for anyone who's within the 5ers. And thank you so much for being here.
When we exit the trades, we always know what we did wrong. But when the trade is actually occurring in the moment, we just lose ourselves. I don't know how many times everyone's done it as a trader where you exit a position, you go, why did I do that? That didn't make any sense. So that's why I think having a written trading plan that you can go to and a checklist that says, I am looking for this occur. And when I go through that checklist, if I can check all the boxes, then I hit the button. I think that really, really helps, because when you're in periods of drawdown, like I just was, I can take that break and I can go back and I can say, my plan works. I'm just, going through a rough period right now. Make those adjustments, lower your trading size and go from there. But the trading I did was the exact same. It was the exact same process. It was the exact same plan. It was just, again, staying alive until you get that moment where you hit it and you go from there.
So hi everyone, thank you very much for Michael, one of our funded traders, trading 2 funded high stakes accounts, for joining us today so we can pick his brain and talk about some of his success, some of his failures, and how he has got
Absolutely
to the place that he has now. So Michael, thank you very much for jumping on. How's everything going?
Things are going well. We have a new baby in the house, so that's kind of tiring, but so if I slur my words or misspeak, that's on a little bit sleepy. You'll see me probably go after my iced coffee a little bit here, but everyone's happy and healthy.
Your first child?
Second.
Okay, so you're a pro, you're a veteran already.
Yeah, I just know I knew to stock up on caffeine and Red Bull and all that stuff before I got started.
Yeah, fantastic. So give me a little bit of a breakdown of who you are, what got you into trading, and we'll take it from there.
Sure. So, again, you can see gray in the beard, so I'll try to keep the long story shorter. But I actually started day trading equities in a prop firm, a different type of prop firm, way back in 2006. And started because there was a job fair at my university, and they asked questions that had nothing to do with finance at the time. It was, do you play video games, and which ones, and all of this. And because back before then, it was in 2006, there wasn't a whole lot of computerization of the market. So we ended up doing a lot of, I would call them games around market makers and specialists and things like that in the US equity markets. And I did that for a number of years. That firm ended up shutting down because as the market got more computerized, a lot of these games stopped working, and just the scalping, not randomly, but scalping around specialists just didn't work out too well. So then I moved over and I started to work in the hedge fund space for a few years, where I worked doing kind of risk management for a bunch of different hedge funds, and kind of helping the hedge fund investors realize which funds would make sense to them. This was all around the Bernie Madoff time, for anyone who's watching and remembers that story. So they wanted a third-party company to go in and make sure what they were doing was legitimate and it was above board, and they were actually trading and they were actually generating profits from their trades. So that's a lot of what I did, which was great because it exposed me to a whole wide variety of different hedge funds and how they trade it and what they were doing. And then when that company got bought out, I started to work with a company called Trade Ideas. I actually got my CMT, which is a chartered market technician. And ever since then, I've been consulting with them and then trading my own funds. So I've been doing this for a long time. I've just stumbled into this and the Forex prop firm world actually just recently, over the last, I don't know, maybe 6 months to a year.
Interesting. because we do have a sister company that deal with mostly US equity. So it's interesting how you would decide to come over here and do some trading in Forex. What was that decision, and how come you've made that transition to start going into Forex trading?
Well, actually, I speak with Michael frequently. Actually trade ideas and trade the pool have a
Work together.
relationship.
Yeah.
So that's actually how I got started.
Nice.
Thinking about this is I am not a good day trader, and we'll go through some of my failures and struggles to get funded here. And currently, I know that the purpose of trade the pool is a little bit more on the day trading and intraday trading style with some swing aspects, and maybe that's going to change down the road, but it's just more of a personality thing. I want to hold trades for a number of days. I find the shorter the time frame that gets for me anyway, the more emotional I get and everything. So I'm always looking for ways that I can hold for many hours to days on trade. So I did that. And then it comes to strategy diversification. So I trade equities myself with my own capital, and I swing trade those, and I've been doing that for many years. But as you know, there's sometimes that the equity market's really interesting, and there's sometimes that nothing's happening, and sometimes, metals, and you guys have crypto now and all of that. So I always like to have access to as many different instruments as possible, because then it stops me from over trading something that's just not moving. I can go somewhere else and explore that when it's moving.
Interesting. Where have you got or built up your methodology around your trading, your techniques, and for better word, your playbook? How did you first develop that? And is it very different from when you started to what it is today, or do you want to talk about that?
Yeah, it's very different from when I started. As I mentioned, the original trading style I had in 2006 just can't even work anymore, right? You were literally, we were the HFT traders before there was HFT traders. There's a bunch of college age adults that would play StarCraft and then come and play in the market. So that's completely gone. As I mentioned, I took my CMT, so I'm a chartered market technician. So that's a 3-year designation on just technical analysis and quantitative analysis. It's for those who don't know, it's like the CFA, but instead of looking at the fundamental side, you're looking at the technical side. So that did a lot for having me explore different technical aspects of trading. So that did a lot of it, and then it came down to, like most things, reading books and listening to other traders and talking with other traders. I'm thankful enough that I do a lot of this speaking with traders, so I can talk to people that I respect and bounce ideas off them. So a lot of the problems, which again we'll go over, for me was adapting what I do in the equity space where markets trend way more, and then taking that and then going into the Forex space as well. So like anything, it was trial and error. It was a lot of failures. It was a lot of, getting beat up and getting mad about it, but then reporting your trades and tweaking what works till eventually you find something that works for your mentality and then also in the market that you're trading.
100%. I think going off what you just said, like I used to enjoy trading crypto, and crypto moves a little bit like equities. Whereas when you come into the Forex market, when things start to range and you've got a direction and you're expecting the direction, but you get chopped around quite a lot, it can be quite difficult if this is to adapt from a way of trading to now adapt to more of a range or intraday types of trading as well. So it's super, there's a lot of nuances as well with those types of changing and different types of techniques on different assets. So that's interesting to hear. Let's go into your accounts, because this is what people want to hear. They want to obviously understand a little bit about, what you've been able to achieve, and then you can tell us just a little bit about what it took to get here, because it wasn't all smooth riding. Nope. To be honest, you went through a couple of accounts where it was a little bit difficult just finding your feet, but let's pull this up.
Yeah, and I think that's important to show people, right? Is to say, hey, it wasn't all sunshine and puppies until I kind of got my feet under me.
Yeah. So you can see here we've got the 100K funded high stakes account. So you've actually got a high stakes account that's 150K, which is been multiplied through hitting the milestones, and also the 125k as well. So this was the first funded account which you passed to then get the extra funds added. So just a couple of these, just looking very briefly onto some of these accounts, and you're just looking at just the best profit compared to the biggest loss is kind of shows to me already that you're quick to cut a loss, and you just let your trade kind of breathe and play out, which is very different from somebody that is newer to trading, where they're quite scared to hold off onto their profits and they cut them early. And the opposite when they're losing. When they're actually losing, they tend to leave their trades just a little bit of extra time. So that points out straight away to me. Also, a win rate of 60% with that kind of risk to reward ratio is incredible, to be honest. That's really good.
As lucky, I would say. When we get to the other accounts, it's like anything. At some point, you're going to hit your stride. But no, I would say if there's something I do focus on, it is when I have a winner. I put a stop at break even, and I really try to go for the guts, knowing that every now and then, and when we get to my current account, with the 150k account, I think there'll be a good lesson there. Is my job, the way I look at it, is to stay alive until I get lucky and hit one that really makes the difference, right? So even on that P&L graph, you can see just a couple great winners, and the rest is kind of treading water until that occurs.
That's the point, isn't it? You're trying to, like you just said, surviving until you say you get the luck. Obviously, it's a little bit of luck, but it's also that experience that you've probably developed to know when you can be a little bit more luckier than usual, when you can try your luck a little bit more, which is super important. So this is a 125k account, more trades on this account. So you obviously you had it a little bit longer. Again, you've still got your best profit much higher than your biggest loss, still quite a high win rate. You've probably got a range where your strategy is probably, it's worse, maybe around about 45%, 50% to what's your higher range of your win rate on this particular strategy that you use?
I would say if I can get 60%, I'm going to be the happiest guy in the world. I'm going for 50-50, and then again, trying to hold those winners. And we'll get a little bit more into the details, I'm sure, but some of that is scalping around a core position or a core idea that I developed. So some of those win rates can be inflated a little bit just because I'm trying to just scalp around to make up for some of those losses. That's why you see a lot of flat-ish periods in the equity curve followed by a couple bumps. So I would say it's between 40 and again, if I can get to 60 and maintain 60 for any length of time, I'm very happy there.
But even those flattish periods, it's a couple of days. It's really just it's a couple of days maybe that you're not actually losing much money at all. You're not going into massive drawdowns, maybe a percent here and a percent there, but it's nothing too big. But would you call yourself an intraday trader, or would you call yourself as more of a swing trader?
I would say it's more of a swing trader. I bet you if you took out the scalping around a core position that I do, that hold time would be much longer. But so for example, if I'm bearish USD franc, which I'm in a trade right now, and I've been bearish on that, I may have half of a position that I'm holding for a period of time and then scalping in and out of the other half to try to generate income or offset losses on something like that. So I bet you that shrinks that number a little bit artificially.
So when you've got a swing position, you'd happily, if you're, let's say, short something, you'd happily get long on lower time frames just to make some money up while you're waiting for that position to work out. Is that what you're saying?
More of if I'm trying to short and I'm okay risking 0.5% of my account on a trade, I will split that into two. And one I will short and then cover, and then if it bounces, I'll short and I'll cover, holding that other position for, again, potentially, if I'm right on the direction, a longer term move. And, using that scalp around to try to offset some of the losses for when I'm wrong on a thesis on a position, right? To try to smooth out those returns a little bit. I will move stops break even relatively quickly, because what I'm trying to do, and I use, and I can show you this, but I use commitment of trader data and I use sentiment data to try to gauge an overall direction. So then for me, it's about, and we talk about taking small losses all the time, is that I need to stay alive. And this is the chart that I think is going to give a perfect example of that. I need to stay alive until I'm correct on it. So for this period of time, you can see a whole lot of chop with a drawdown that's worse. I was uncomfortable with that, and I'm actually making a change going forward where I'm cutting my position size again, because that was too much for me. And that was a lot of, you'll see, betting long the yen, or betting short USD JPY. And the idea was exactly what happened on that big spike, which ended up being a very good trade. But the amount of drawdown I had to take to get into, or to hold that position, was just way too much for me. So that's what I'm trying to do. So at the end of the day, that was roughly a $10,000 profit on a short yen trade. But you can see there's a lot of chop and a lot of mess for me to get to that position. So that's what I'm working on with my trading, is that I want those drawdowns to be less, while I figure out this position. So that's what that other scalp around position is meant to do. In this case, again, I just got a little bit too big. It was when that yen did that crazy move overnight. I got caught out a little bit on that.
How many times would you give yourself to lose on an overall trade idea before you say, okay, I'm not, this is invalidated, I'm not going to get into this trade again?
I would say during a day, maybe twice max, but I will then go back to that at some point. Because again, I'm using commitment of traders data, which shows us the positioning of speculators and large and small speculators. So you know where the boat is a little bit too loaded, and everybody on Earth was short the yen or long USD JPY. Like it's, you go, the community data just shows that everybody is in that trade. So at some point, I am very, very confident that the move that just happened overnight will happen, and that will then be a profitable move. The idea is that I have to then time these entries, and then when I get hit, take a break and move on, but knowing that I'll come back to that, it just might be in a couple days once more data has occurred.
Yeah. When it comes to taking a hit, how do you deal with taking a hit? Because I know one of the biggest things with a lot of traders is a lot of overconfidence, except for when they're making a lot of money. And if you had, passing up to these levels, 60% win rate, you were probably ecstatic. You were probably feeling absolutely fantastic. And then once things start to get a little bit more difficult, and you can see here the win rate has gone down by half, it can start making you feel a different type of way. So I just want to understand from you, how do you control your emotions when you're in a different type of mindset, and how do you get through that period?
I walk away, right? I live in the middle of the woods, so I go out in the woods. Before that really good trade that brought the accounts back into profit, and a fairly good profit on them, when that drawdown, I was down around, I think, 5% at that point, and that was too much for me. It's 10% until the account is gone. I do something where I actually will scale my risk based off the stop loss level. So as opposed to a lot of people to say, I'm going to risk 1% a trade, I look at it as I want 10 trades in a row before the account is lost, and then I will adjust that. So as you get closer to that level, I'll risk less and less. So in that scenario, I completely cleared the deck. So I sold everything. I took a day off. I walked around the woods. I rethought of my positions. I said, okay, I got to come back. I'm just going to trade a little bit smaller, and reduce my risk a little bit. And then, just lucky enough and crazy enough, the very next trade was the one that wiped out all of those losses, and then created that gain. But you're right. If I had stayed in that mode of beating my head against the wall, then that could have very easily crashed that account. So I think taking that time, which is one thing that I love about prop firms and why I talk about how I always traded with prop firms, is that kind of forced risk management. Some people hate at the time, but at the long run can really save you, because there was a point there where that daily 5% loss, I was fairly close to that. So it forced me to say, okay, I gotta shut everything down. And I just took an extra day off and rethought about things. And I just came back a little bit smaller, but was just lucky that with what happened with the yen happened the way it did.
So that's on that one side. Now, how do you react emotionally to a trade that you've just got that luck, that $10,000?
Mm-hmm.
That's also something that you've got to think about. Did you take a day off or take some time just to look at that and think, what am I going to do now? I've just made all of my profits and some back.
It's the same mentality. I think you have to reset your baseline to zero. I would argue, and again, this comes from the gray and the beard and the experience, and I'm sure you've seen it talking to a lot of traders, is that quite often your biggest loss comes right after your biggest gain. And it does, because you get a little bit of this, I figured it out, I'm immortal, I've hacked the market. And I think a lot of this just with me comes from experience of knowing that I'm in this heightened sense of, I think I'm the greatest in the world. So I did pare down. I've got a couple positions open still, but I actually took another yen position after that, but with 1.5 lots instead of 4, right? So I shrink everything down. I go, okay, trading is very much, I think, knowing yourself. So until I'm back to baseline and I understand I'm not immortal, right? I just have a strategy that sometimes, like now, it's working really well, and there'll be periods that it won't. And once I'm kind of back to that mentally, I think it will be time to, maybe take another couple shots a little bit bigger. But I think it's always just get away, return yourself back to a baseline mental state, and then come back.
Yeah, 100%. So you're floating now in some nice profits. I did have a look at your accounts before. Do you mind just opening up maybe TradingView and just showing us what made you get into some of those positions, kind of what you were thinking, what you were looking at, and see if we can extract a little bit of knowledge out of you before I let you go.
Sure. So I use 3 major tools is what I decided on. And again, as you mentioned, I struggled for a while. I blew up a handful or more than a handful of accounts while I was adapting to Forex from equities. And part of the reason for that was I noticed I expected to take what I was doing in equities and just apply it to Forex and have it work the same, and it absolutely did not. So the mentality I had to go with is I had to create a whole nother trading plan. And I have a whole lessons on my website about creating trading plans, because I think it's absolutely vital. If I'm looking from the equity side or the metal side, I use trade ideas, which we have the ability to take a look at and show the different ETFs based off what's going on in the market. You can see gold underperforming the rest of the market right now. This is all on a relative basis, in which it's showing me the sectors that are the strongest and the weakest at any given time. And with that, I want to use that relative strength. So I want to short stuff that's relatively weak and buy stuff that's relatively strong. And then the other main tool that I use is the commitment of traders report, which I talked about. So if we go to my yen idea, you'll have to flip this because we trade USD JPY as opposed to this is the yen contract. This is something that is now required by law and has been for many, many years, that shows if you are a trader over a certain size, you have to report your holdings in the futures contracts, and the futures contracts being a large market. So this particular, the green line right here, is showing the position of all of the large speculators. Everybody, that was what I was talking about, everyone in the world is short the yen and has been short the yen as much as they pretty much ever have been since 2007. That to me is a condition in which I know that they are going to have to flip. Something I do in equities is I look for stocks that are heavily shorted When those stocks start to move up, I know those shorts are going to have to cover, and that's an equity trading, a swing trading style that I use. So this was the same idea adapted to Forex, where I know that everybody is short the yen or long USD JPY, that if the Bank of Japan starts moving, and if I can start to see that in the charts, there is a whole bunch of positions that need to be unwound. And that's what gave me the confidence to hold that winner for an incredibly long period of time. So from there, it just becomes charting and technical analysis, in which I use anchored VWAP. Brian Shannon, he's a close friend of mine. We've talked a lot about the anchored VWAP tools that he uses, and basic pullbacks, right? So we had this initial push down that happened in the yen overnight, a simple Fibonacci retracement, looking for this, the regular zone, that kind of 38, and then 61, that golden zone, I think they call it, for Fibonacci retracement. As it came up in that zone, I'm either looking at the 4-hour or the 1-hour chart. The idea was that if we held this area right here, I want to short, and with a stop just over that high. So I'm risking, I believe in that case, I was risking less than $1,000 for that $10,000 profit. Again, this to me is a little bit, this is, call it luck or call it just, being
definitely
able to hold
not
the right
more
side,
normal
but
price action for something for currency to go over 1.5% in a session.
yeah,
it's not normal. So you caught a very nice move.
yes. No, I expected that hole that I was into. I was fully saying, okay, I'm going to take a good trade after a good trade, and maybe it's going to take me a couple weeks or even months to kind of dig out of it. But, pleasantly surprised when it didn't. And then the trade that I'm in right now on the yen is, we had, after that move, I covered somewhere in this area here. As we had that move back up, I have an anchored VWAP marked. So this basically, for those who don't know what anchored VWAP is, it's a moving average that incorporates volume as well, and you choose the point in which to anchor it. And there was two right here, and one was from this major high right here, and the next one was from this major high right here. And this is just showing me that the average market participant in this, if you think about, if you dollar cost averaged into something, this would be your price. So the average market participant from this point, this major high that happened overnight on the yen, and then this high that happened a couple of days ago on the yen, that was sitting around in this zone right here. So when we reversed off that level, I took a little bit of short. My initial stop was kind of up in this area. And for this trade, I'm just going to see if we can kind of threaten this low and then take this low. I believe there's more of this unwind to take place. Now, that commitment of traders report comes out every Sunday. So part of my work on the weekend is I will review that, and I will say, I will know, did anyone cover? Because if this commitment trader report, we see that a lot of these shorts covered, then I think it's time to move on from this trade and look at the next one. I'm looking at the franc. I'm looking at Bitcoin right now as well.
Yep.
But if nobody covered, then I want to try to hold this position. And this is where trade rounds might start to occur. If we start to get little bounces and bear flags and ranges for me to play off of, I may take a smaller position short and just look to kind of scalp that. And scalping for me is holding for a couple hours and trying to take a trade out around this position while I hold this core position to see if this is something that's going to reverse on a daily chart or even longer, back into some support levels on the daily chart. So that's kind of what I'm looking at. Is the commitment of traders report gives me which trades are crowded, and I'm looking for the other side of that crowded trade. And then I'm using anchored VWAP pretty much primarily, and then some Fibonacci's to try to time my entry into those crowded trades. Again, waiting for that moment where everybody needs to exit the trade, and I'm the one holding that while they're exiting. The same idea for the stock traders is a short squeeze. Think of GameStop. Everybody was short GameStop. All it took was some catalyst to get it moving, and then you had this massive pop. And if you were long GameStop, you were able to make a substantial trade there. So that's the idea.
Amazing. Any advice for anybody that is currently struggling to pass? They're in a bit of a boom and bust stage, and they're about to go and get their new challenge because they want to get back into the game and they want to you know, to see some of the profits that a lot of they see a lot of people on Twitter and a lot of people on the internet make, including yourself. You've had some nice profits off these accounts, nearly 25,000. So it's quite a big amount of profits that you've been able to withdraw from all of this.
I will say that those results won't be typical. I don't expect that to occur all the time. I'm not pushing for that, because I think the more you push for gains, the more you open yourself up to losses. If you're watching these people on Twitter, just know that they're only posting their best things. That's why I was totally open to talk about all the accounts I blew up to get here. So understand that. And then the other thing that I think is very, very important is that you have a plan. And I think that that's where everyone, and I just don't mean you have a plan of, oh, I'm going to buy here, I'm going to sell here, is that you have a plan that says something like, I am going to enter a trade when these things occur, and I'm going to exit a trade when these things occur. And this is the risk I'm willing to take. And all of that has to be written down. I mentored a trader once who was ex-military.
Yep.
And when I talked to him about this, he said, oh, our drill sergeant always used to yell at us and say, you don't get smarter when the bullets start flying. And I think that's a great analogy for trading, is that when you sit down at your desk and the P&L is flashing up and down, you're not a very smart person right there. That's why when we exit the trades, we always know what we did wrong. But when the trade is actually occurring in the moment, we just lose ourselves. So have a plan, and then understand that most of the things you see on Twitter are just, you know, people's best moments.
Perfect. So thank you very much for everybody for watching this video, and I hope you've taken something out of the conversation I had with Michael. Michael, thank you very much for spending some time with me to give a little bit of your 2 cents and to show everybody your process and, you know, your journey as well, and that it's not all sunflowers and daisies and sunlight. It is also quite difficult. And there you go. Thank you very much, and best of luck in the account. Okay.
Thank you very much. Hope to be back on soon.
Hi guys, so thank you very much for watching the video. Now make sure you like and subscribe, and most of all, go into the YouTube and check our other content that we provide here at the 5ers. We'll see you in the next one.
Good day, everyone. Thank you so much for showing up for the first webinar, our in-house webinar, and we see a lot of participants. Thank you so much for coming here. My name is Gil. I'm from the 5ers Trading Fund, and today we're going to talk about supply and demand. This is the method of trading and market analysis that I mastered in the past decade or so, even more. And I truly believe that the whole concept of supply and demand is very, very valuable for anyone to understand. Well, let's start dive in, and just give me your write me on the chat how much you are familiar with supply and demand, and so we know how to run with this with the content and how much we can go in depth. Okay, so supply and demand is actually a way of reading charts and understanding the market forces. What it means is that, hold on a sec. Okay, so today what we're going to cover in terms of supply and demand is, first we're going to discuss the theory and how we can really understand and clear out all the noise and all the misunderstanding of looking at or glazing at charts that don't tell us anything. I promise you that by supply and demand theory, you will be very much understanding why price is acting the way it is, why it's moving in a zigzag way, why are the zigzags are, why the turning points are where they are. A lot of information can be told just by understanding the very core concept of supply and demand. So we'll cover this. That will going to give us a lot of understanding about price action, like I said, and then we'll see how we can take this understanding and create trades, actually build a trade structure with a stop loss, with the entry, with the profit target. And if we'll have enough time, we will dive into more advanced concepts of supply and demand, because it's really, it goes from the very core basic into a very complex understanding and methods that you can apply. One thing that you should know about supply and demand, it is mainly made for a working for very liquidate markets like the forex, the main commodities, the indexes, the top stocks that are very highly liquidated. So supply and demand really works on these assets. If there's the thin liquidity assets that are very exposed to manipulation, it will not work. So just bear in mind that supply and demand theory works where there are masses, huge amounts of liquidity. So these are the markets that it's going to work. It's a timeless method, and we'll talk about this. So now let's just take a look at this chart. There are no indicators in it. There's nothing. For most people, before they actually get familiarized with supply and demand, this kind of charts look like a noise, look like very much like a random. I really hope that within this very seminar, within just 1 hour, we will be able to create a lot of logic into what happened in this chart in terms of the micro moves, all these little spikes. They all have a reason that can be explained by the theory of supply and demand. And the breaking points, the respecting or the turning point, the where price is breaking levels, everything can be explained with a very simple understanding of what is supply and demand. So I really hope that this got you intrigued, because once you can take a look at a naked chart with no extras mathematics applied on it as indicators or different black box solutions, once you will have this understanding, this will be a priceless add-on to whatever you already understand about the market. So the first thing to understand, and people tend to forget, that the market is a presentation. It reflects a real living, a real life behind the matrix. It's not just prices moving. It's not just about manipulations. Everything is being reflected by true events that are behind the market. The market is just presenting to us whatever happening in the globe. So just remember that every tick that you're seeing in the chart, every new price coming into your platform is actually a trade made somewhere on this globe between two sides. One is a seller, one is a buyer. They both agree upon price and quantity. and then there is a match. Then the central exchange will be matching these two incentives into one deal, and that will be broadcasted to our platform as a tick, as a new quote that comes in the market, and it will be added to our candlesticks or whatever we are looking at in terms of graphics. So just remember, every piece of information that comes in, it's a real trade, okay? And what we are actually trying to figure out in the market every time is, what is the balance? Right, we have a trade made by a seller and a buyer. And just imagine, try to illustrate this image that we're looking at. One side is a buyer, one side is a seller. If they agree on price and quantity, they would be shaking hands and not trying to push each other to the other side. Now, just try to imagine what happened in terms of the masses that coming with different intentions into the market. One side are wanting to buy the market, one side is wanting to sell. The very person from the last slide, from this slide, one of them bought the asset and now he wants to push the market up, and once saw the market, he expects the price to go down. Okay, so the supply and demand is the actual balance between buyers and sellers. As long as the buyers and sellers having the same force pressed on each other, we will see that equilibrium situation like we're seeing now. Both hands at the same place, nobody is out winning the other. But if somebody presses harder than the other and one side become weaker or more tired, the other side will win. This is exactly what happened in terms of supply and demand. It's called order flow. And once one side will win the other side, price will move the very same way that the hands will move to one side or another. So there are more ways to illustrate this, but just think of what is actually happening at the exchange, and I will refer to your question, Edwin, in a moment, that the forex market is not centralized one, but what happened in the market, in every market, is that at the same very price, we have many participants with different goals. Some want to buy, some want to sell. So imagine at a very certain price, they are broadcasting their orders, their desires to what they want to do in the market. They are sending their orders. So they would send a buy order or a sell order for the same asset at a specific price. With this illustration, we're seeing a situation where so many participants will be sending sell orders, and slightly more people will ask to buy the asset. So what will happen now is that I'm sorry, is that the market, the exchange will start matching from bottom to top all these files, and imagine that each file is the same quantity request. A buyer and a seller are matched, a buyer and a seller matched, a buyer and a seller match, and every time there is a match, another two files are disappearing from the table. Eventually, at one point, we will have the last buyer meeting the last sellers, and there are going to be no longer sellers while there are leftovers of buyers in the market with no sellers to fulfill their request. Okay, so this is the time where price is going to move somewhere, because if now we don't have any sellers at specific price, what do you think will happen to price? The exchange will drive price a little bit higher until they will find new willing sellers to sell at higher price, right? At higher bid. Okay, so every time we have this situation where we have more buyers than sellers, price will move up. If the opposite would happen, if there are going to be more sellers than buyers, the exchange will drive price down until they find more buyers willing to buy at cheaper price. Okay, so this is the very core mechanism of how the market works. And if you think about this, it's every market. It's not just the very high-tech markets of the financial markets. It can also be the tomato markets. It can also be real estate market. It's just about what's happening in people's mind. If you know, if you're about to buy a house in a certain neighborhood, in a certain street, and you know that the last deal on this street was at specific price, you would not be willing to buy it at higher rate, or and the seller would not be willing to sell you at less price, right? So everything is derived from the last events. But if at some reason somebody will say, you know, and on this neighborhood, somebody very, let's say a big celebrity bought the house, now everybody wants to buy, not depending on the market price. They are willing to bid more for the houses, then price will rise. Everything is derived by the balance of supply and demand. How much people are demanding to buy versus how much people are willing to sell the asset. So this is the order flow, which is equivalent phrase for supply and demand. Okay, so now when we look at the market, we are trying to read a story of the market and try to understand what happened. Where is that situation where a leftover orders were not fulfilled? Because we know that when price will come back to this price, there are certain amount of orders with high probability laying down there to be executed. So we want to know where was that situation where we have these leftover orders, because if we are going to sell where we know there are buyers in it, we will definitely get our execution, right? So when we going to look at the market, we are going, it's very easy to take this image and figure out where was that place, where was that line on the chart, and where was that? Right where price origin a drop or a rise. We see that price is ranging at a certain zone, and then suddenly price pushing upward. What happened here is there are more buyers exceeding the sellers. There are no sellers anymore, and therefore price will rise up. Okay, so that point is for sure where we know there are buyers willing to buy, and there were no longer sellers to give them orders. This is why the market had made price going to higher places.
Okay, it's only when new sellers came into the market where price will start ranging. And then when price was coming back to this area of the decision to break higher, we have seen reaction and another balance situation between buyers and sellers. So what we're going to be trying to look at is the story of where buyers and sellers were agreeing, meaning range, or in terms of the supply and demand, we call it base, and where buyers and sellers didn't agree on price and didn't find fulfillment, and one side won the other. So that will be wherever we see price drop or price rise. Okay, so it's that easy. This is why we don't need any indicators to tell us what is happening in the market. And while we're looking at the history, we will make some illustration of what happened in the history, and we will see how we can forecast with a bigger probability for the outcome in the future. So we will use historical charts to try to prove that, and then we can do this in live. So we are looking to find the decision points. The decision of the decision are where price, where one side had won the other. Okay, so how we do it? First, we are going to look for the impulses in the market. Every time we see price dropping or rallying up, this is, we know for sure that there was a decision. One side won the other, very simple to spot, right? So here we saw the sellers won the buyers over and over, and therefore price is dropping. Okay, so we see a very strong impulse down. We know there are more sellers than buyers around here, but where would that be the very accurate place for them to time our best and accurate entry? We'll discuss this in a second, but let's see more impulses. Every time we see price dropping and after a price basing, this is where we can look up for the second stage to decide where is the decision point. Okay, so every time we see an impulse, a base and an impulse, that is where we are going to drill in and look for a decision point. So see how many impulses we have, and that's the only thing that matters in terms of charts. Okay, so now drilling in, and we see price was climbing up, basing for a while, and then dropping. Okay, where will be the decision point that we're looking for? Where will be this situation where there are no longer sellers, but there are buyers, or in the chart that we're seeing now, where will be the sellers that didn't have enough buyers, therefore price went down. So we see price basing, and then from this bar and on, we see price is dropping and never coming back to this area. So the first breakout that we can see, it's right about below this pin bar candle. So that will be, here will be our decision point, and we will mark the supply zone, the full range on top. So everything and above the highest price would be the zone that we call supply. Okay, and that is the decision point. Okay, then we stretch that line all the way to the future, and we're going to look what is the outcome for when price at the first time approach and hit this this decision point price. Remember that illustration again. At this situation, we had more sellers' files on the desk of the exchange more than the buyers. That means that some of the sellers' files were not fulfilled. They are waiting there because they didn't have any fulfillment. They are waiting to be executed. So next time price is coming, a reaction is happening here in a very accurate way. Okay, now we're looking at copper commodity. So when a decision point is hit only for the first time, we have the highest probability for price to have a reaction at this very price, and see how accurate it is. Marco is asking, they wait for a week? Yes, they wait for a week. They can wait for a year, for years. It doesn't really matter, because this decision is not just orders that are there at the table on left. There are also mental pricing that institutions are considering. It's there are a lot of reasons why this this decision point would be active. But yes, they are waiting for endless amount of time. It can be very quick, and I will show you that, and it can be very late in the future. But bear with me on that. Don't consider time. Just consider if the decision level was never being tested before, it will provide a high probability reaction, not yet a reversal, but a reaction. If you see all these different wicks and turning points while price is progressing to some direction, they are all have reasons in terms of supply and demand in order flow. These are reactions that occurs upon order flow waiting to be fulfilled. Okay, so that explains everything. So in order to explain these, we will have to drill down into different time frames. Now we're seeing H4, but we can go all the way to to 1 minute or tick chart to really understand why this price is actually reacting. And you see price is reacting to this decision. We have here a decision for price to go up, and if we'll mark this price, I hope it's horizontal, we see that price had made a reaction in this. It wasn't a reversal, but the very first time it hit a fresh demand zone, a fresh order flow of demand orders, a reaction was occurring on the market, and then price continue, and the next time price is testing the very same level, it crushes in, and then it finds a lower level where demand could be found. Probably we could see the decision. We will probably be able to see the decision on a lower time frame, not H4 like we're seeing now, but this explains would explain, if you drill down, you will see the reasoning for why price is reacting. So every spike you see on the market is a reaction for something, for order flow, okay? Okay, let's continue. Okay, same thing for demand. We see that demand is was created here, and then when price was moving up and then returning to this demand very, very quick, it made a reaction. Okay, so this is also explained if you're familiar with support become resistance and resistance become support after a breakout. This is exactly what explains it. Okay, we have a decision point for price to go higher, and then price immediately turn and touch the very first time, and then a reaction and continuation. Okay, at this specific situation, price was visiting the third time and made a reaction, and then at the fourth time it created a reaction, but not because of this zone, but because it was there was a new zone created on top of this one, and this first time visit is a reaction for the new zone just created and moved up. Okay, and another thing to observe and to understand is that after we were hitting a fresh supply, like in this situation, just imagine these files being now consumed by these sellers. Okay, we have a buyers, we have sell orders waiting at the desk, and more buyers are coming, and now the sellers create a reaction, but the pile on the desk there is getting lower now. So now with more force of buyers coming up, price was managed to push further inside the zone and find a new resistance at higher place, probably because we see H4. If we will drill down to lower time frame, we will probably see the decision point made on a lower time frame that was actually creating this reaction, okay, on the very top. So few things to understand about supply and demand. First, we are looking for the impulses, then we're looking for the decision from where price was originating that impulse. That will tell us where is the decision point and where are those order flow packets waiting to be executed in the future. Then in our trade plan, what we're looking for is only to take the very initial and first time that zone was tested, whether it was a very long time after, like a week or a month or a year, or at the very instant after price made that decision. So that will deviolate the zone for good once it was tested, no matter what the time is. Okay, so if we are looking for our trading plan checklist in terms of supply and demand, we know only for sure that not for sure, nothing is for sure in the markets, but we will know with high probability that the very first test of a decision point will give us high probability reaction. That's it, just a reaction. We don't know more than that. Okay, we don't know if it's going to be a reversal or not. A reaction will happen. Okay, another thing about reversal, a lot of traders are trying to anticipate and forecast reversals. Even if we have a reversal at some point, usually the price will struggle for a while at that level before it will turn out to a true reversal. So at first we'll see a reaction, and then more push into that zone and more retesting before the reversal evolve and actually going to be accomplished. So, so even if you are looking for reversals in terms of supply and demand, you don't really have to take the very first initiative on the fresh zone, because we will have more price action um, formats to tell us if we have a confirmation for reversal once we were hitting a fresh zone at the extremes. So don't expect to take a reversal from the very first test of a zone. A reversal require price action confirmation, and that also can be derived by the order flow supply and demand theory. Okay, so how can we build a trade? So we are going to buy the decision point, and our risk will be just below the lower swing of that zone. Okay, so that will dictate us the risk unit that we're willing to take. So just mind that if you're on a higher time frame, the zones will be much wider. So you will be risking more pips, but you would probably going to look for higher swings range. Edwin asking, does confirmation provide higher probability then? Yes, confirmation will provide higher probability, but with higher probability, you will also get less entries, because if you're waiting to confirmation, not always the confirmation will come in the formation that you're looking for. So therefore, you will be missing some trades. But I advise everyone that coming with solid discipline to be able to afford yourself to miss out opportunities by sticking to your plan and not be tempted. So whether you use confirmation, you will have less entries. But if you don't use confirmation, you probably will have less win rate. So you will have to compensate that with a better risk management or a better entry profile. So that's these are things to consider. It really depends on your personality or how you are approaching your trading in general. Okay, so just look at what happened when price had created a demand, and then demand was executed, and we have our risk unit that had created us 3-to-1 potential. Okay, I'm not saying that we know how to take the full 3-to-1 for sure, but just to show you that as much as we buy the dips and sell the peaks, as much as we do this, we will naturally going to improve our risk reward ratio. Okay, so eventually, remember that new demand that was created here, it's probably more or less the same risk. Now the full swing had provided us a potential of 5-to-1. Again, we can't really be sure that price will go there, but since it's a fresh supply there, that would be a very wise place to end a buy order right there. So that had provided us 5-to-1 risk reward ratio. Okay, so that's only the potential. That's all I want to show you. For the sell order, we have a decision for price to go lower, so that would be a sell. Okay, the entry will be at the decision level. The stop loss will be just above the swing high. That will be the whole zone, and the whole zone will be the risk unit. Okay, and that risk unit, that is one risk unit, and let's see what was the potential reaction on this. Okay, so we have 3-to-1 risk reward ratio that had happened there. Okay, so now I'm not sure I understand the question, Edwin, but I really resonance by your willing to understand the why. This is exactly the reason I like supply and demand, because supply and demand really provides why price is doing such and such. Okay, so diving into the supply and demand order flow theory will give you a lot of explanation for why price is doing whatever it's doing, why it's spiking, why it's breaking levels, why it's not. So with just the things that we've just learned today, we would know that once a fresh level was touched for the very first time, we can expect a reaction. Okay, so we can scalp this reaction or take a few pips from that reaction. We can also expect that if a price was already testing a zone, that it's no longer a valid zone, and therefore there's a higher probability for this zone to be broken. So that gives us another new information about this zone. So there's and we see this example for price pushing up into the zone, and maybe later on, if price was testing again, it will penetrate more inside. Okay, so now we have like 20 minutes, and let's just hop into charts and see how we can actually analyze more supply and demand situation and try to learn a few more concepts on top of this. Let me switch to the charts. Okay. Everyone is seeing the charts now? Richard is asking a question about 6-to-1 leverage. It's not relevant to supply and demand because the leverage, you say you use 200-to-1, but I bet you never use actual 100-to-1 trades. If you did with just one slight percent against you, you'll be wiping your account. So that's not really a good risk management. But anyway, 6-to-1 leverage is not, it's not risk reward ratio what we're discussing here. I'll be happy to explain to you the leverage issue if you contact us on support, and we can also set up a call, and I can explain to you in specific regarding to that. Okay. Okay, so we're seeing a chart now. We're looking at euro, dollar, yen. Okay, and now we're looking at a naked chart, and what we want to do here is try to read the narrative, read the story of what happened on this chart based on the hourly candles. And you see that I'm usually using a very condensed charts, because I don't really care for the candle formation, if it's harami or pin bar or whatever. What I'm really care is about the extremes and what was the effort versus the results of these extremes. So all I care are just horizontal lines, okay? So we see here price coming from the top, and we see price is flagging. We see it's a pole and flag, and this flag is actually what we call a base, right? Okay, so that creates, so that is a demand of its own. And when price was turning, going back, it was actually reacted to this supply. Okay, next we have, let me just see if we can, okay. Now price is basing and creating a decision right about here, okay? So that's create another supply right here on this here, and this is the swing. And then next time price was testing this supply, we see a reaction. So we got the reaction already. So now, once we got the reaction, this one is no longer valid. Let me see, I have this. Never mind, I don't have that X, this thing. I wanted to, this one, okay? We have no longer have this zone. So this zone is already being taken, okay? So it's no longer exists. Now let's continue. So we see price is dropping and another base and a decision made right here. Okay, so let's take our, so decision was made right here. Okay, now price was penetrating very strongly into the zone, but it was not really violating this. And it did create a reaction, not a great reaction, but it did. But it also didn't take our stop after it was making our reaction, okay? And then when price was coming back to this zone, it's no longer a valid supply zone, therefore price can break it up, okay? So just see how much information it gave us, so we can take for a high probability this reaction to scalp. Maybe it didn't made it to a mature trade, but it did give us a reaction of some way. And next time price is testing this, we know this zone is no longer valid. So we know to stay back from selling this again, okay? Because price was pinching very, very deep inside, okay? Next thing, price was dropping. We have another decision right here. Okay, and then when price was breaking down, it was touching here, and then it disqualified this zone for good. So we have this reaction back down, and it's no longer exists. Same thing on this decision right here, and then a very fast reaction, and it's no longer exists as supply. Okay, so next time price coming in to this zone, it's no longer valid, so we know to stay away and we're not going to take a sell from these levels any longer because we had our first touch. Let me just read questions. Some price action gurus teaching fake out stop loss hunting strategy, and it seems to be valid theory. My question is, do you think it's compatible to trade supply and demand like you do and trade the fake outs? Okay. Well, the funny thing about stop loss hunting is that when you are being taught about these fake outs, is that they're not actually giving you a reliable price to say, let's sell from it. If you going to learn supply and demand in more depth, you would understand that when price is faking out, let's say it's faking out this level, it will fake out until it has a good reason to bounce from. So if you go always to the left, you will see there's another low time frame decision point up here, and that would be explaining why price was actually pushing through, breaking out, and reacting at a slightly higher level on this instance. So if you want to add more reasoning to the stop loss hunting so-called strategy, just look further to the left and see what more levels of hidden waiting packets of orders up there, and you will understand why price is faking out a specific level and then dropping. It's not just because they hunt stops. It's because the ignorant traders would put stops right here, so that would be also stopping this their trades, but and creating another packets of resistance on top of the swing. But also because there is historical waiting packets of orders waiting up there. So there is always a reasoning why price will be turning, whether it's a fake out or not. So so supply and demand will help you to understand where was that exact reason and price for the turning point. Hope I gave you a good answer, Nathan. Richard. Edwin is a bit confused. So if it hits the second time, it creates a new base again at the same spot. I guess you need a trailing stop loss then beside the 3-to-1 target. Two things I must correct you, Edwin. First, 3-to-1 target is not a definite. It's price action will tell you what is the potential range that you can ask from your trade. So there's sometimes it's going to be 2-to-1, sometimes it's going to be 10-to-1. It really depends on what price action is providing you, on what is the approach range that it's coming from. So that's one misunderstanding, and I hope you will fix this. The second thing is we will discuss this in a moment, or if you will attend my trading rooms, I really discuss this a lot, where I try to analyze the effort versus the result, and that also will show us where we have a valid supply and demand that we can play upon, and if we see a fresh supply or a fresh demand that we can play with. So so that's a few rules that will help us to leave out misleading zones that can be seen visually, but with adding more logic into it, that would be helping us to avoid risky trades. Richard is asking, what do I recommend if we see stacking zones on top, one on top of each other? So there is a very simple rule to that. If we have, like we see here, supply and then another supply really stacked one on top of each other, I would tend to take whenever I see a fresh one, okay, a fresh zone. So if we see that price was hitting this supply, this supply is no longer valid as from this test, okay? So I don't consider this as a supply. And now I just eliminated one supply from the equation, and I don't have to really debate which one give me better probability. Then the simple rule is if it's a fresh, never tested zone, therefore I can take it. So even if it's in a lower position, a lower price, it's still fresh, so I can expect a reaction, so I get the reaction from it. So that's the only thumb rule I can tell you. In terms of Quasimodo level and patterns, we'll discuss this in more depth in our trading room. I think it's too much for this session. We already an hour inside this this webinar. Anyway, so continuing with the supply, we have another price. Let's okay, got this. Okay, so we have price ranging down, and now we have another decision. Now the decision is to come up. Okay, so the decision is right here. We're going to stretch the whole swing right here, and the decision here, and stretching it for the very initial approach. So we got this retest on this test on this demand, and therefore this demand is no longer exist after this price. So we see in that sense, here is another, I'll get to the point in a second. So we have another range right here, full range, prices ranging, and a decision made about here. Okay, so we stretch this. So now price was almost touching my decision point line, and there's two lessons to be discussed here. One, we can ignore this attempt and the fact that it didn't touch, and just stretch it wider, and it will provide somewhat, but it will be wrong to do so, because now we have different views of price action, and we don't really know where is that precision decision made. Okay, so if we have this decision point on H1, maybe on M15, we will see a lower decision that was made this effect. And we also see that price in terms of lower time frame, price was going down, flagging up, and continue. So we have this whole structure of pole and flag right here. So that's the one, and this is the reaction for this. And you see that it's within the decision of that flag that it was already reacted. So the lesson to be learned here is that, and I know it's a little bit confusing, but I'm sorry, that's a fact about the living daily of the supply and demand. If that's, we can draw supply and demand by the decision point like I'm drawing, but we can also be more conservative and taking the whole range from the lowest swing, the up, and the breaking of the lowest swing. So this is what I did with the pole and the flag formation. And that was the reaction for this. So in that sense, this decision point is the same structure of this pole and flag. It is actually the same packet already being consumed. So yet we didn't get this as a trade, but it did this valid that supply right here. Okay, so we didn't get a trade because we were looking for a higher entry for our short sell, but it's still taken the orders out there. I mean, the price action had shown us that the packet was waiting a little bit lower. So that's a miss of a trade, but still the logic is there, and it tells us to avoid taking that trade at the other attempt. Eventually, if we did ignore it, we would get a reaction and a bailout opportunity from a bad trade. And even if we were holding this, price went only halfway into the zone, into our risk zone, and that was okay. And we would get a reaction. So we wouldn't been busted on this trade, but this is the logic behind this thing. So it's another lesson to be learned from this situation. Okay, so now we have this demand, reaction to demand, and then price is trying to push up and breaking this formation, this supply. Okay, let's just leave it out so it's going to be easier to be seen. And now price is pushing back. So now we're looking at a situation where I call it effort versus result. We see that price was not able to break higher by finding support on demand. And so we see a demand respected, but not being able to break supply. So, and then price was going to lower places. So we still, so this is the forces that we're going to be looking at all of the time. We want to see that price is being held by one side, the supply side or the demand side, and we want to see that price manage to break the opposite side. Okay, if it can't, it tells us something. Okay, at this situation, price was making a deeper push that is eventually turned out to be a fake out of some reason. If we want to understand why it is so, we usually take a full horizontal line and put it on the swing extreme high or low, and then we go to the left and see what was the reaction for. And we see we have here a fresh demand, right? A fresh demand, that price was actually reacting from here. So every time we go left, we have a way to understand why price had decided to stop here. I'm not saying that every time we would know how to forecast ourselves into buying this or to have this as a trade, but having this in mind all of the time and having the ongoing practice of always trying to explain yourself, why is this swing high just stopped here, and why this happened, why the turn that happened here, and go to the left and see why it was like that. This is the practical, the routine practice that will help you truly understand price in the naked form of supply and demand. So I see a lot of people are losing patience. So I suppose we will have to schedule another meeting with more, with discussing more advanced stuff. So thank you so much for being here today. And yeah, we'll set more webinars like this, so we can discuss more in-depth stuff on supply and demand. Remember, supply and demand is something that you have to practice yourself. It's a reading concept, and it's complementary to any other strategy, whether you're using any indicators on your charts. It doesn't conflict anything. It just gives you another view for understanding the price, and maybe to keep you out of trouble, or to have more confluence to your decision making with your other strategies. So that's on the tip of the fork, the supply and demand theory. And the same way we've discussed supply, and we've discussed in some cases no supply, no demand zones after violation. There are more theories derived from this very core understanding. So we'll set up, schedule more events like this, so we can dive deep inside. Meanwhile, we've covered these topics in few different occasions, so you can hop into our video area on our website or on our YouTube channel and learn more about this. And there are also a lot of information about supply and demand with different approaches from mine on the internet. So I hope that intrigued your imagination and the things that you can apply from it. And thank you for showing up today. And we'll see you next time, next Thursday. We have another webinar by Sneer or by Saul. I forgot the schedule, but make sure to come along and learn some more different views on the markets. Okay, thank you guys. Have a good week ahead, and we'll see you next Thursday, and next Monday we'll have another trading room. Take care, guys. Bye-bye.
Hello, everybody. Thanks for joining to the webinar today. I hope you see me through the camera here. Thanks for joining. Okay, I see some of you that are already answering. Thanks to all of you to assist to this webinar. First of all, I want to thank you also to The5ers team that made this possible for me to be here to show to all of you my experience on algorithmic trading. And I hope you, after this webinar, you can go home with something new, no? New information about algorithmic trading. I don't know how much information do you have about this topic or automated trading, but I hope this will be simple for you so that everybody can understand. Okay, I see people from Netherlands. Nice to be here. People also with experience about automated trading. Okay, so let's start. After that, just a few minutes, let me introduce myself a little bit for probably a lot of you that don't know me. My name is Ramon Ruiz. I born in Spain, in Mallorca, the island. I am also living here since the beginning. I am an entrepreneur, okay, an individual entrepreneur. For the moment, I have several business, or I started several business. One of them, since 2014, as you can see here, I started on trading, manual trading, normal trading that everybody knows. Opening my first account in them, also buying the first strategy from somebody from the internet, and trying to do my first stuff. Obviously, I was losing a lot of, or some of accounts, or the first account were lost by myself. But then a few years after, I realized about trading algorithmic trading. Actually, I studied computer science in 2010. I was studying for 5 years in university here in my country, in Mallorca, for 5 years, computer science. So I know about algorithms and programming from the beginning. But in 2017, I was able to join what is trading and also computer science, right? So I was trying to do the mix, and this happened to me. So starting on trading, algorithmic trading, since 2017. My manner, well, I'm friendly with all the people. I am trying to be honest, not also with my closest people or friends, also with in my social media, also with my community, because I am also, you will see if you follow me, so you will see that I am always showing the results, showing when things are going good, showing when things are going bad, because nothing can go good forever. So there are also waves, no, in the progress, and also for sure in the financial markets. I am a shy person also, and of course I am responsible, and well, it's not aligned with the honestly that I'm trying to show in social media and also webinars like this one. So after that, you already know me just a little bit. Probably you will know me more at the end of the webinar. I will show you the index of this webinar. This will take 1 hour, more or less. That's the idea. First of all, I will show you from my experience what is algorithmic trading, so that you can have an idea about it. I will tell you about programming, because a lot of people, when sees algorithmic trading, they think, okay, programming, I am not going to enter here. Is it necessary? It's a good question that I will answer you in this webinar. The alternative of programming is using automated generation. Okay, I am already answered the question, but I will show you what's the alternative. I will show you a demo of how I am generating algorithms and trading robots. Okay, we will talk about warranties that trading robots offers, the importance of a portfolio of systems. I'm not working, I'm telling you in advance, I'm not working with 1 or 2 automated systems. I am working with more than 2 and 3 and 4 and 5. You will see why. I will show you also, because, okay, I can come here and explain everything that I want, but I will show you results. That's the important thing, where people can trust on you, where people, not on you, but also on the methodology, on the manner that we are doing the things. And I will also, at the end, before the Q&A section, I will say you some tips in order to start on this world. Okay, so let's start with what is algorithmic trading. And the first slide you will love a little bit, but I will explain you a little bit right now. So here you have a manual trader and an algorithmic trader, and you will see what is saying this guy. What I am trying to explain on this picture or on this slide is that the manual trader at, well, this is European time, here in Spain time. It's 3:30 Wall Street opening, but for people in USA, I don't know how many countries there are here on this webinar, but Wall Street opening, most of the traders or manual traders are in front of, I don't know, 10 screens, 1 screen, 2 screens, 3 screens, depending on the opening, on how the movement on the price in the next hour and a half or 2 hours, because maybe they are scalpers, or also you are a swing trader that you check the market 1 hour per day. Okay, but you need to stay in front of the screens every day. Meanwhile, an algorithmic trader, when an algorithmic trader have done all their work, so creating this, generating the system, create them, backtest them, creating the portfolio, doing all the tests that is necessary, when they are working on real account, we don't do anything else rather than monitoring them. Okay, and in order to monitoring them, we don't need to stay every day checking the screens for sure. So I wanted to do this comparison in advance. I'm telling you, don't take this personally. I am not in favor of algorithmic traders. So both of them are traders, are different traders, different types to do trading. But there is something that I want to remark, is that algorithmic traders doesn't, psychotrading doesn't affect us. Okay, psychotrading, I am referring on emotions. So when you open a trade, when the trade is going to your stop loss and you don't want to lose that trade, most of the initial manual traders, they change the stop loss a little bit lower because I think the price will go up now in the next 5 minutes. This is the worst error that you can make in trading. You need to follow your rules. You cannot change the rule meanwhile you are operating. So that's the thing. Well, that's the most important reason why a lot of traders, manual traders, are not a success trader in financial markets, because of the emotions, the psychotrading, I call it. I think in English it's called the same. So that's the main reason, and that's why I put the two pictures, okay? The definition to me of algorithmic trading is the automation of defined task in order to be executed by a machine, okay? By a machine, I'm referring my computer, my laptop, my VPS, whatever that is a computer, okay? Doesn't matter if you have a lot of computation or RAM and CPU. In order to execute trading robots, I can tell you that you don't need a lot of computing hardware in order to run them. You just need with a laptop. Of course, a laptop at your home, you can have a cut of electricity, and there are some risks. I always recommend to have them on VPS, but you don't need a lot of machine in order to execute algorithms or trading robot. Okay, it doesn't affect your psychotrading, algorithmic trading. They don't have fatigue. So, for example, if you go to the beach in the morning and then you have to operate in the afternoon, maybe you have some headaches because of the sun and so on. So you are operating in front of your screens a little bit tired. So machines are not tired, never. They are never tired. So they don't have a fatigue. They operate, you do other stuff. Okay. Sorry. They can operate multi-strategy at the same time, multi-assets at the same time. Have you tried someday to have several charts, not screens, but charts, maybe euro dollar, GBP USD, and 2 or more of them in Forex, and you try to follow the same strategy in all of the charts? So, I mean, you cannot look at 4 charts at the same time with the same attention in parallel, because you can have your attention just in one chart. So you have be running several robots in your machine, and they are 100% attention to every chart, also with multi-assets, and also of course better precision. When they get the signals, they enter in market. Our perception when we see the signals, maybe we say, okay, this is right, this is cross the line, no, yes, no, then okay, yes, you click the button, and then some seconds are happening here in the middle. There is a gap of seconds when you get the signal and you execute. So we have better precision on trading robots. Okay. But okay, Ramon, this is very good, this is very funny, this is very beautiful, but what is algorithmic trading? What is a trading robot? Is this what you see in the screen? These are programming, this is code. Whatever it programmed by you, is programmed by another developer. Is you buy a robot already done. I don't know, you generate, that's something that we will talk a lot on this webinar. We generate trading systems. What the software is doing is generating coding. Trading, algorithmic trading is coding. Okay, so this is how it looks like. This is one screenshot of one of my coded robots. Some of you are asking if it is Python. No, this is MetaTrader. I don't know if you have experience on MetaTrader. Well, if you work with the 5ers, probably you work with MetaTrader 5. Actually, this is code coming from MetaTrader 5. So it's MQL5, actually, the language. Okay, it's similar to MetaTrader 4. So basically, everything, all that we will talk today, at the end, it generates a piece of code, okay, of programming. How we structure, or how I structure the components in order this is for the initial people that doesn't understand how algorithmic trading is connected behind, okay, how I can connect, how I can start, what I need to have in consideration in order to be in algorithmic trading. So there are three things. Your broker, that is is the intermediate between you and the financial market, so that you can place the order. Okay, you need a broker. In this case, for example, the 5ers. Okay, well, the 5ers is the supplier of the funded accounts, but they have brokers. So actually, it's a broker. So you have the broker, you open an account in your broker, they give you credentials, okay, an ID and also a password. Then you need something in order to press a button and say, okay, I want to buy this, I want to sell this, I want to put in a stop loss this. Some of the brokers, they provide you their own tools on the website of the same broker, but the majority of them has compatibility on several trading platforms, okay? One MetaTrader 4, MetaTrader 5, NinjaTrader, TradeStation, ProRealTime, there are a lot of them, okay? Here in the 5ers, actually I didn't say that before, but I have an account, of course, with the 5ers, funded account, and I'm working with algorithmic systems in MetaTrader 5, okay? So here you can play MetaTrader 5 here in the middle. And if you are a manual trader, you just need the middle column and the right side, the right column, okay? You just need a platform and a broker so that you can, with the platform, enter your trades. But now, in order to generate the robots, you need something else. First of all, on the left side, we have on the top side, the programmers. I am a programmer. I am a programmer, actually. So if some of you are programmers, so you don't need anything else. You can take your laptop and writing code, okay? And this code is run in each of these platforms. Obviously, each platform has a different language. So you need to search information about MetaTrader. Okay, MetaTrader 5, which language is? MQL4. NinjaTrader is C++, etc., etc., etc. Okay, so programmers is the simple, I mean, you don't need anything else. You just need knowledge of programming. That is not, this is a lot, okay? And then you have the generators, okay? Generators, there are the Strategic One, there are the Expert Advisor Studio, Build Alpha, and there are a lot of them that I don't know. I tried these three, okay? Actually, I'm working actively with the Strategic One. These are other softwares that you configure the behaviors that you want to include in your trading strategy. You will see a demo, a quick demo that I will do today with the Strategic One in order to you to have an idea of how they are working. So you configure them, and it's not easy to configure them, but with the right with the right steps, you can be able to configure them. They are searching strategy, searching. You can leave them in a machine 1 day, 2 days, 3 days, and they're searching millions and millions and millions of strategy. And then you pass a filter and they created the robot. Okay, there are a lot of things in the middle between you start searching, not generating, until you have already the robot coded with the coded in order to place in MetaTrader 5. But these are the generators. Okay, you have these two things. Okay, programming, is it necessary? Actually, is not necessary that you have programming or computer science knowledge. Okay, what are the options? There are 3 options. Okay, one is purchasing a robot. The second option is program yourself or paying somebody else to program your strategy. Okay, and the third option is to use tools that generates trading systems. Okay, my recommendation, and this is up to you. Okay, I don't recommend you to purchase robots in the internet. There are a lot of free robots that offers you 100% monthly with just a drawdown of 1%. This is crazy. This does not exist. There is, in my experience and all the things that I have studied, I have seen on the internet, I have tried myself and so on, there is not exist the fixed rentability. Somebody tells you, I can provide you 20% monthly every month. This is not true. It's impossible to have the same, exactly the same every month, the same profitability. Okay, so I don't recommend you to purchase robots through internet. I recommend you to program if you have a strategy in advance in your mind. We'll talk about program and generate right now, okay? And also generate. Let's go deeply on the 2 of them. So I started as an algorithmic trader programming by myself. I didn't start generating. Generating, actually, I started beginning of 2020, so last year, at the beginning of last year. But in 2017, I was starting programming my own robots, okay? They were robots at the beginning, very aggressive robots on profit, but also on risky. Okay, so actually, I have done a lot of robots. Actually, what's the point that you need to have in consideration if you want to program instead of choosing generating robots? You need to have a strategy in advance. Okay. In order to program, or you or some developer, somebody needs to tell you the rules of the strategy or one strategy, because otherwise what you are going to program, nothing. So you need a strategy in advance. Okay, then the strategy is not sufficient to say, okay, I want to program supports. I want to buy on supports. Yes, but what is a support for you? Support for me, it's that the price goes down and then go up suddenly, no? And this is a support. Okay, but you need to program that. You need to translate this sentence to logical sentence. For example, in order to translate, I want to buy on supports, one of the answers of logical sentences is say, okay, I'm going to check every 7 or 8 candles, okay, and I will take the minimum of these 7 candles. You can say 7, you can say 14, you can say 20, but if you say more bigger candles, you will have just one minimum with long period. And if you analyze only 7 candles, you will have more minimums. Okay, so this is the thing that the programs or the programmers, we need to take in consideration with somebody that wants to program mainly price action strategy. Okay, because if the strategy is working with indicators, is it easier. Then you need to have programming knowledge or paying for somebody that has it. And it can take days or weeks in order to know the results. So you have a strategy, you know that the strategy is working. In trading manual, of course, imagine that it's working in manual trading. It doesn't mean that it's going to work with algorithmic trading, because we need to translate with to sentence logic sentences. After that, after programming, maybe the developer or yourself can take several days, 1 week, maybe some days, 1 week, in order to have it programmed and run a back test. A back test if you have the data that there are free data, mainly for CFDs, okay? There are free data. You can know the results in 2 minutes when you run a back test, less than 2 minutes, yes, more or less. So at the end, when you start to program and you do the first back test, maybe it can take 5 days. Okay, so this is time consuming that you need to take in consideration. What happens if you generate? You don't need to have a strategy. Actually, if you have a strategy in mind and you want to have the robot, you cannot generate, because generate also is for people that don't have a strategy. They don't care about the strategy. Actually, I am working with both, but mainly in generate, I don't care about the strategy if they use RSI, moving average, volume, whatever indicator, I don't care. What I'm going to select is some of the configurations, some of the indicators that they can mix, and the software meets indicators, behaviors, and have some strategy that pass my acceptance criteria. Okay, so I don't care about the strategy. If you care about the strategy, go to the program. If you don't have a strategy and neither doesn't know programming knowledge, maybe generate is the best option for you. Okay, in less than 1 minute, it is able to program and backtest more than 10,000 strategy. This is true. So when you will see the results, you will see. Now I will show you a demo. When it starts searching, it depends on the machine that you have. I have a Ryzen CPU, Ryzen AMD Ryzen 9. Okay, it's 5950. This is 16 cores, and it's generating more or less 1 million strategy per hour. So it's more or less 10,000 strategies per minute. This is a lot. Imagine that you have to generate yourself or program 10,000 strategies in a minute. Of course, this is impossible for a human being. Okay, but you need to have an analytical profile. Okay, we analyze a lot if in the generating software, and it requires higher computation, as I said before. Okay, in order to run this type of tools, I recommend a medium computing power. Okay, it's not with the minimum. So summarizing both options, maybe you can have programming 20 days in order to program one strategy that you don't know if it is profitable. Okay, and generating, you can have 7 days in order to have 30 profitable systems and robot strategies, because you started with 50 million strategy, then they passed the certain criteria 1,000, then some robust test passed also only 200 strategy, and then the optimizer section, because I will tell you about the phases. Only 30 of them are very profitable and also robust strategy. But at the end of the 7 days, you already know that these 30 are tested, are pushed to the limit, and are robust strategy. Okay, so here's the difference. In my experience, I always recommend to go for the programming strategy if you have a strategy in your mind and you are highly % sure that the strategy will be profitable also on algorithmic trading. Okay, otherwise go to generate. The alternate automated generation, and I will talk about generation because at the end, programming, that's all. I mean, this is the coding. I show you a piece of coding. You go to the program editor and go programming and backtest and so on. Okay, let's talk about the automated generation, because this is, I saw in my community that 90% of the people, 95% of the people are interested on this point. So that's why I want to do emphasis on this webinar on this point. Okay, first of all, we don't have any strategy. Okay, we use a tool. In my case, is Strategy Quant, and you will see it after this section. And this is separated in 3 modules. Okay, more or less all the tools are separated, the generation in these same three. Okay, so first is building, or searching strategy. Second one, those strategies that were searched or built that pass that set criteria of the build section, they go to some test, to robustness test, okay? And there is another acceptance criteria. The one that goes or pass that syntax criteria of retest goes to optimize, okay? And optimize, there is also another acceptance criteria. Build, define the entry and exit behaviors. For instance, I want to look for strategy that only enters at market, or a strategy that only enters at operations at limit, by limit or sell limit. Okay, you can define this. You can define which indicators wants to use. I mean, not indicators of the strategy, the bunch of indicators where the system, the software can take in order to build one strategy. Okay, so you can select 200 behavior, and if you configure that your strategy in order to enter only at maximum 3 rules is necessary, so it will take 1, 2, and 3 of these 200 possibilities, okay? And it will search and it will mix behaviors, and some of them are profitable and are passing your acceptance criteria, okay? This is the building, okay? The building phase. The retest, we are retesting again the strategy, but pushing to its boundaries, okay? For instance, I don't know if some of you heard about Monte Carlo test. Monte Carlo test is like, you know, the spread, right? Spread of a lot of brokers. I think all of them have spread. Some of them are floating, some of them are fixed. But if you operate CFDs, mainly CFDs also, they have a lot of floating or dynamic spreads, okay? So Monte Carlo test, one of the tests of Monte Carlo is increasing the, well, I think you can put a probability, 10%, 20% of the trades of the whole strategy. Just to break here, I usually generate strategies of time frame of 1 hour, okay, and 8 years back in history, okay, in order you to have an idea of what I am talking about. 8 years with candles of 1 hour. So Monte Carlo test, 10% of the trades increase the spread, I don't know, 300% or 200%. So the double or the triple of the spread, or the normal spread. And you see all of these simulations, because it does 2000 simulations, you see how profitable it turns your strategy, your original strategy. And with this graph, you can see if you increase a little bit the spread and the strategy becomes not profitable, maybe you don't want this strategy because it's, how can I say it? It's not robust. I mean, if you change a little bit what is happening in the past, it will destroy your numbers, your profitability, what you expect from this strategy. So if this happens on the past, imagine if you put that strategy in your trading account. So probably in the future, you don't have a lot of probability to success on that strategy. That's why we pass, this is one of the tests, we pass 3, 4, or 5 tests, okay? We push the strategy to the limits. And when we push the strategy to the limits, we put a minimum acceptance criteria. Obviously, it's not so high as maybe in build, but we put a minimum of acceptance criteria. For those that pass this test, this retest, we optimize. And optimization, most of you have heard about over-optimization. Be careful, because you don't need to, you cannot fall on over-optimization. We have some techniques in order to don't fall in over-optimization. But we are working on this section with walk forward technique. You will see a little bit now when I do the demo what is walk forward. I can take 2 hours to explain about walk forward optimization, what is, but I will try to explain you with some sentences now in the demo, okay? And once all the strategies that pass the optimize, that is usually less than 100, then I choose, well, I create some portfolios that I will explain you how I do it in the next sections, okay? Before that, I will do a generation demo, okay? Sorry. So I will change my screen. I will connect to my, it's not an VPS, it's a machine that I already mentioned to you that I have a AMD Ryzen here in my room, close to this one, okay, connected to the electricity and with a Wi-Fi pen, and that's all. So is this one I'm connected with AnyDesk, but I think I need to change the sharing. Okay, let me stop, and then now. Okay, can you confirm now? Can you say in the chat if you see my screen now? Okay. So you see strategic one, right? Okay, I see people saying yes. Okay, perfect. So, okay, perfect. So this is strategic one. It's small. Do you see it good, or it's small, or this is on pause? I see. Not showing, wait. Now yes, right? Okay, it's because I tried to put a full screen and it seems that full screen is not working, okay? I will do with a small screen because it's also working like this. I hope you see very good everything, okay? Okay, as you can see here on the left panel, we have built, retest, optimize. Do you remember the slide that I showed to you, the 3 phases that we start generating here, the strategies, we go through the retester, and we finish on optimizer, okay? The look like is similar in all of them, okay? And they also have 3 tabs here. It's the progress, how they are generating, how they are, because you configure and then you press start and you go to do other stuff. It's searching, searching, searching. It's retesting, retesting, retesting. It's optimizing, 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 and you do other stuff, okay? Meanwhile, this is creating. So here, what we have, look at this one, okay? This one, well, before looking at this, look at this in the middle. I am trying to generate Chow USD. It's the gold, okay? I'm thinking on Spanish. This is gold against the dollar, okay? The gold asset. 1 hour, and if you can see, it's from January 2013 until February 2020. And also I am putting some space, if you see here, some space of auto sample and in sample. I'm trying to generate strategies in sample so that I left some period of time at the end in order to test the strategy generated in the period before. Okay, so I'm generating the strategy based on this data, and then I see its behavior on this next period, okay? And you will ask me, Ramon, okay, why your end of period is 31st of December 2020 if we are in the middle of 2021? Because then when I choose, I do all the things, all the steps, I choose the strategy that I want for my trading account. I do a test, a future test in MetaTrader 5. Okay, MetaTrader 5, I download the data and I do a backtest there of 2021. Okay, this is another step that me and the people that are working, we are doing in order to put another assurance on top of this to have the robots more consistent. Okay. So we are building here. First of all, here you can see an example. Last weekend, I generate for just 1 day and 2 hours. You can see here running time so far, 1 day, 2 hours. I generated, the strategy generated 25 million of strategy of gold against dollar for time frame 1 hour. Okay. This is very, very quickly. You can see strategy per hours is almost 1 million. This is a lot. This is a good machine. I mean, I started on this generating per hour, I think 80,000. Okay, so less than 10 times less than the machine that I have right now. Okay, so you don't need these machines. You can just starting with some BPS of 6 cores or 8 cores, and maybe, I don't know, 12 of RAM and so on. I think that's good to start. Actually, my first account was generating with the strategic one with this specification. So you don't need so much machine, but this is my number right now. Okay, I'm very happy actually. And okay, you can see 25 millions, but only 1,400 were accepted. So you can see that the percentage acceptance, it's 0.01%. It's very low, but this is correct. This is a correct percentage, because as you can see, when a machine it's mixing things, okay, you can see that majority of them will not make sense. Probably most of them, they are not going to do any trade. You can see here, rejected detail. You see the reason why it is being rejected. You can see 30% of them, it's because of there are no trades. So I have an automatic filter activated that if there is no trade, you can discard me. This is one of my filters, okay, initial population, that the net profit is higher in 8 years, is higher than 10,000, because my initial capital is 10,000 also, okay. Okay, I'm looking for more than 100% in 8 years. Okay, less than 2,050 trades in 8 years. I think 2,050 trades should be the minimum on this configuration, etc., etc., etc. You can see the reasons, no, why it's rejecting you. And these are the acceptance one and the acceptance one are here, okay? I want to just mention that strategic one is a tool that is working on genetic generation, not random generation. Random is, like I explained to you, pick this, pick this, pick this, and make a strategy. Stacks like this, what it does, it gets, for example, 100 strategy picked randomly, and then with this 100 strategy that pass a previously acceptance criteria, it joins part of the strategy. It makes like sons and daughters, okay, of this, like this were parents, right? So do the generations about things that has their parents, and they join things that are going well, and it generates better strategy than its parents. That's the idea, okay? So this is the genetic generation. This is how this is working. Strategic one also can work fully randomly, okay? You can configure that. So this is my bunch of strategy that were passed all the filters of the section builder, okay? Drawdown, return, divided, drawdown ratio. This is the main ratio for me. So this is the #1 ratio, because with this you can upgrade the how it's called, the contracts, okay, or you can lower. If you see drawdown higher than that you want, so you can lower the contracts. If you see drawdown smaller, you can increase the contract. So this is things that you can play afterwards. And in order to configure this, I will just show you 1 minute. Okay, this is some filters. I can take you hours to explain this. Okay, filters, data, you can specify in sample, out of sample. And this is the thing that is important. So these are the signals. For instance, I can select ADX, change direction downwards, ADH, change direction upwards, ADH cross above level. This one I don't select, this one I don't, this one I don't, this one yes. Usually I select the behaviors that I understand. And also, for instance, now I am looking for a strategy, for trend strategy, and also changing the direction strategy. Okay, so as you can see, I will have selected the downwards direction, change the direction, cross the level, because the trend continues, but I'm not going to use oscillators. Okay, then sometimes I use oscillators and so on. I am changing these indicators and so on. Okay, things or levels where you put stop limit entry blocks, order type. I don't work with market order type. I work with the stop limit or limit. And then exit types, you can choose exit after bar, move, and so on and so on. Okay. Then money management, the capital, and the ranking. So the filters that I put here in order to that acceptance criteria. Okay. Retest, how is it going? Is the same. Okay. You can see the same. These are an example of NASDAQ Q, USA Tech Index. Is not the gold. The gold is something that I was doing last weekend. Okay. This is an example of NASDAQ Q. We do the retest. Here we pass some Monte Carlo test. As you can see here, if you remember about, this is retest methods, trade manipulation. Here we change the order of the trades, and also we remove 10% of the trades, because I want to remove all the strategy that does not depend on a few trades on the whole period. I want to have the profitability spread during all the time. So this is why I remove 10% of the trades, or I change also the order of the trades in order to see how the drawdown is its behavior, no, on these simulations. So these are the Monte Carlo trades, or also this is the spread. Okay, the line below, the last line, is the worst scenario. So even the worst scenario in this strategy is winning me some money. It's profitable at the end of the period, at the end of the trades. Okay, so well, these are a lot of trades we can test. There are what if simulations, Monte Carlo, higher bad test, additional markets, another Monte Carlo, sequential, and these ones, the last ones, it's the same that optimization we are doing there. Okay. And here we have also results and other acceptance criteria. After this, we go to optimizer, and I have the wall forward matrix. For instance, I will show you one of them. Okay, wall forward matrix. Well, we put 25. This will take me a lot of hours to explain to you, but basically what we are doing here, okay, the strategy, the original strategy maybe works with moving average, maybe work with I don't know, MACD, but moving average has a parameter that is called period. MACD also has a parameter called period, and also other parameters, D and the K letter, right? So this parameter is specified at the beginning in the builder, okay? So what if instead of using 14 period, I use 15 period or 13 period? Maybe it's better, maybe it's worse, the strategy, maybe it's stable. What I'm trying to get on the optimizer is that not getting the best combination of parameters. Be careful, we are not changing the strategy, we are not changing the indicator, neither the behavior, only the parameters, the value of the parameters. So what I'm trying to do is not to get the best combination of parameters, but I'm trying to get the combinations, no, the parameters that are in the middle of instability. So that if I am using 20 period of moving average and I'm using 21 or 19, the result does not change a lot, okay? This is what I'm trying to do. And this is why we use this graph, no? Because this is, for instance, return divided drawdown ratio, okay? Profit risk. And I want to look for some strategy that are, let's say, like this, you see? This is very, very smooth, right? So this is the variability of the variable is not a lot, it's very stable. So I want to choose one of these configurations, okay? Runs and out of sample, well, this is something very more deeply. Okay, maybe I can explain you another webinar. I will consume all the time. So this is some of the techniques in the optimizer that we are doing in order to I mean, not to win for sure in the future, but to be as much as successful possible, or to increase the probability of success. Okay, so I will come back now to the presentation, and I need to change. Okay. Okay, you see the presentation right again? I guess so. You see, right? The study. There are a lot of questions. Sorry, I will ask you. I will answer it at the end of the webinar, right? Generation demo. What guarantees does it offer? I told you already. It doesn't guarantee anything, but not strategy quant, nor MetaTrader 5, nor anything. Any strategy can guarantee you anything in the future, because the market has an how can I call it? It's not predictable. The market is not 100% predictable. If it was predictable, everybody will win money, or nobody will win money. I think it's nobody will win money. But non-strategy, neither automated strategy, neither manual trading can offer 100% warranties in the future. The market is changing, things new can happen, new things that never happened in the past. So whenever you do a study of the historical data, they don't take in consideration this data of what can happen new in the future. So it does not guarantee anything. What we're trying to do, or what I'm trying to do, is to increase my probability of success. Okay, all these tests, the objective that passing all these phases is in order to increase my probability of success. Obviously, I can fail, obviously, but if I, for instance, work with 10 different systems, maybe I fail with 2 or 3, but not with 7, not with 10, not with 9. I'm going to increase more than 50% of probability of success of these systems in order to take some profit in the future in the market, financial market. Okay, I will show you some of the results. These results are, as you can see, okay, don't say yourself, okay, 20% of year it's too low, 100% per year of profit is too low. Maybe it's too low, 100 for sure, it's too low. Okay, what you need to check is the average. Okay, a trader, an algorithmic trader or a manual trader, we are looking for a positive profit at the end of the year, not at the month. Obviously, there are months. These are the best traders in a platform, in a social platform, okay, called Darwinet, because there is social trading. These are the best traders, the best numbers, but look at the drawdown. I mean, see the one below, since 2015, okay, 1, 2, 3, 4, 5, 6, 7 years being profitable year after year and having a maximum drawdown of 30%. This is a very, very good risk management. Here, the good traders, they don't look for a big profits. We are looking for the best risk management possible, because this attracts investors. This attracts, for instance, a very good risk management can help you on passing some levels of funded accounts like the 5ers is offering to you. So this is how also I'm working in one of the accounts in the 5ers, that you will see my results, or how is it going right now in 5 minutes. Okay, so I want to remind you that these strategies, these methodologies doesn't guarantee you to win all the months. You can see this guy, there are 2, 3, 4, 5 months in a row that is failing, but at the end of the year is profitable. At the end of the period, on long term, is profitable. That's what we are looking for. And actually, by my experience, these are the good traders, not the one that show you in a screenshot of I won 1,000 euros or dollars in one day. You can do the same the rest of your life. Okay, if you are able to do this, you are richer than Jeff Bezos or Elon Musk, you know, and they are not in the Forbes, so forget about that. As I say, we look for being as close as possible for the positive statistics. We look for diversifying as much as possible. We'll talk now about the diversifying, and we prioritize good risk management. And always, algorithmic trading, we monitor the systems and change them when it's necessary, or reconfigure them. Because when we change the parameters that I told you on optimize, the same tool, the same strategic one says you, okay, this parameter is valid until maybe it gives you 8 months, or it gives you 10 months. Actually, I have Darwin also in Darwinet, and I changed last month my systems completely. I changed for a new one, okay, instead of reconfigure them. So, but it is after 8 months. So in 8 months, I just did monitoring my systems, okay. The importance of a system portfolio, and after that I will show you the results that I am having right now, and afterwards the Q&A, okay? Importance of a system portfolio. This is a tool called Quant Analyzer, okay, also the strategic one. As you can see below the lines that are very close between them, these are a different strategy. You can see below in the legends, you see WF matrix. This is a trading robot. All of the lines is a single trading robot, but together is the blue line, okay? As you can see, together is much than separate, okay? Not in net profit, okay? Not in profit, because profit is the sum of all of them, and that's all. But also in other things in order to increase the risk management, okay? You can see here, the portfolio, net profit is the sum of all of them, okay? There is nothing to check more here. Check the drawdown, not drawdown, the percentage of match drawdown, you can see is 5%. 5%, none of them are 5 nor 6, are more than 7. So this is because when, for instance, these are 10 systems, I think. Actually, these are the systems that I have in my current Darwin, okay? These systems, maybe 2 of them or 3 of them are in drawdown or maximum drawdown at the same time. But what happened that the rest of 7 are going up. So when 1 or 2 or 3 are going down, the rest are going up, and they are compensating each other. Okay, that's why the drawdown, the percentage drawdown, is always much lower rather than one single strategy. Okay, and that makes that the return divided drawdown ratio is higher than any of them. And that's the diversification, because these systems, actually in this example, all of these systems operate to the same asset, Nasdaq Q. Okay, so you say, okay, this has a lot of correlation, they can go draw down at the same time. No, but they have different strategies. Okay, and having different strategies, I did also a study in order to have these 10 strategies not correlated. Okay, correlated based on profitability individually per day, per hour, open positions at the same time, etc., etc. Okay, that's why the drawdown is less than each one individually. That's what I told. Diversification, reduce the drawdown, increase the success probability, and increase the benefit risk ratio. My real and audited results. Okay, we are going to the end of the webinar already, and let me show you now this. You can see my browser, Chrome. Can you confirm in the chat if you can see the browser? Okay, my FX book. Yes, perfect. So my FX book, I connected the 2 accounts. Okay, I connected my account in Darwinets, okay, the real one, and also my account for the 5ers. Okay, so the one that I have my funded account. Okay, I will show you first of all the one that I have in Darwinets. Okay, it's track verified and so on. And this is how it's going. So this one I opened it in March of this year. Okay, at the beginning of March, I started on that platform, and well, I have a 22% in 6 months. I think it's 5 months and something, more or less. Okay, with a drawdown of 8%. Actually, this ratio is amazing. I mean, for me, I can stay here all my life. Okay, with this ratio, for me, it's very, very good. Okay, actually, I wrote a book that it's algorithmic trading, written by some guy, Spanish also, that he says per year a good portfolio system strategy. I mean, the profit in absolute values divided by the drawdown in absolute value per year, 0.8 factor, the ratio. Okay, so this ratio is amazing. And I think this ratio right now, for me, it's profit sits, well, we can do, it's 621 euro divided by the drawdown in absolute. I don't think there is drawdown here, but I don't know, maybe the ratio is 2 or something like this. Or something like this. It's amazing. For me, the ratio for now, it's amazing. Let's see in the future how it's going and so on. But this is a very good future. Okay, you can see all the stats and so on. Nasdaq Q, every month except April, and now, right now in September, today is the 2nd day, I'm 100 below 0%. But I am very happy on this system. Let's go now in my the 5ers account. that I am very, very happy also with this one. Okay, in this one, I had to build a strategy on Forex, okay, on Forex market. And I built 4-5 assets. Okay, I put 3 or 4 systems in euro dollar. I put 2 systems on, I don't know in English, Neozelandese dollar, sorry for my English. Well, you can see here. Okay, August. You can see here Euro USD. Most of the trades are here because there are some of systems working on Euro USD, Euro GBP, USD Yen, New Zealandese dollar, and GBP USD. Okay, this is the percentage. I am operating on 5 different assets in Forex, and I think I put 10 systems or 11 systems. I think it's 11 systems, different systems. Okay. Actually, I started on June, 1st on June. It was going down, going down, going down. Remember, this is a count of $10,000. I can go down until 9,600, okay, minus $400. I did a minimum of $9,854. So I had some margin still in order to get until the 9,000.6 dollars. And then at the end of July, more or less, I started on June down, on June down. At the end of July, it went up, and then the systems went up and up and up all the August. And I am very happy because right now I am in positive 400. I am up to 600. Okay, to go to the next stage, I need 200 more in order to get there. I'm very happy. The systems are answering very, very well, are performing in the statistic that I have analyzed. So none of them has gone out of the boundaries. I am monitoring them once per week or once every three days. Everything goes well. So for the moment, I am very, very happy. These are the stats. This is not verified, the track, because the broker is not in the listed in my FX book. That's a pity, but these are trusted numbers. Otherwise, the 5ers can confirm that because they have also my account monitoring. Okay. So these are my 2 audited results this year. Okay. I hope everybody wanted to see this one, or maybe you were expecting more. You need to be careful also to pay attention on the risk management. That's the most important thing. And all the funded accounts providers, the 5ers, they want people that do a very good risk management, because these are the good traders. The good trader is not somebody that gets 100% one month and the next month it does minus 70% of your account. It will burn your account, you know. So these are the good traders, the good risk management. Okay. So I'm going again for the last stint to the presentation, and this is already the last step. Okay, how do I start? I just say one recommendation. Okay, by learning. Okay, I know that all the information, and I can assure you that all the information that you can find not a book, because there are a lot of information in books. I like a lot of reading. Information that you can have a course, you can have a university. All this information is on internet for free. Obviously, you need to spend time to look for this information, to discard the one that are not good information, to be able to understand which information is real and which information is not. And this is time consuming, of course. That's why there are universities, and that's why there are courses, and there are academies and so on. But I recommend you that learning. Choose if you want to learn programming or if you want to learn these tools that generates a trading system. But any of the 2 ways, you need to learn something. Trading is a job. Algorithmic trading is another job. So take it in consideration that You are not learning on, I don't know, to do something simple. This is very complicated. Majority of traders are failing, and are failing because some reasons. Okay, so my recommendation is that learn about it. Meanwhile, you are practicing also. Okay, and question and answers. Until here, my explanation. I say thank you to everybody, to all the people that stay here. I want to say thank you at the end of the webinar and say some words. So I will pass to the questions right now. We are 8 people right now. I'm trying to. Okay, there are a lot of questions that you have done since the beginning. Let me go at the beginning. If I am skipping some of them, please ask me again below, okay? Are pro real-time ES allowed by 5ers? I think no. The team can answer to you. There is no EA that you can put on and leave alone and make money. That's right. There is no trading system, neither trading strategy, manual strategy. You can need to change them, to reconfigure them. Nothing works forever. If everyone is generating strategies, they want many people be running pretty much identical strategies. There is only so much you can generate that is unique. No, there are a lot, billions and trillions of combinations of strategies. There are many possibilities that I don't think anybody will end up to the same strategy. Okay. How much RAM do you need to? I think you were asking for strategic one. The RAM is highly consumed in the retest and also optimize phase. I recommend 12 is enough, okay? With 12 is enough. Minimum 8, okay? Who developed all the database strategy? What is the quality of most of it in terms of profitability? This depends on the test that you pass. This depends on the configuration. It's very there are a lot of configuration of strategic one, a lot. And this probability that you are asking for, it depends on what you have configured the tool and the test that you have passed and all the analysis that you have performed. Okay. It will be great to know if 5ers accept ES from non-MT45 sources per real time. That's something that I cannot ask. Are this combination of money strategy in one? This combination of money strategies in one? No, these are different systems. Where what I'm doing with the portfolio is that I am connecting the 10 strategies in the same MetaTrader 5, but in different charts, okay? But connected to the same account, trading account. Very informative, thanks. How are these strategies generated by the system available for us to trade in the real market? How are these strategies generated by the system available for us to trade? I don't understand this question, Mohammed. No, so how are these strategies? Can you ask me again or reformulate again? Yeah, yes. Are saying multi-strategies in one EA for better to increase profitability? Multi-strategy is not to increase profitability. The main reason is to increase the better risk management, to reduce the drawdown, okay? How much time will you need to learn and build a profitable strategy? To learn and build, if you are using generator, you don't need to learn any strategy. They make a strategy for you. So as I said, I am taking right now more or less an average of 5 days, in order to have a bunch of strategy, robust strategy, pass all the tests, optimize it, and so on, for one asset, okay? please get to the point. How can we use the generator? It has a license, okay? It's not for free. There are some days for free, but it has a license, okay? You need to download in a computer and work with it. So thanks for the presentation. Thanks to you to being here. What experience on programming I need? If you use the generator, non-programming experience. If you want to program by yourself, you need to know coding. It doesn't need to be an expert for sure, because you just need to know the simple sentences like if conditions, while, for, loops, variables, objects, functions, and so on. The simple thing. Thank you, excellent webinar. Thanks to you. Do you use simple strategy for forage on SQA, or also which time frame do you use? Finally, what filters do you use? Simple strategies I am using for forage on SQA. Which timeframes I normally, for the 5ers, all the systems were generated under 30 minutes time frame, okay? And what filters I use? Usually I use the return divided drawdown ratio. This is for sure. I use also the net profit. Obviously, it needs to be profitable. I am not very strict for the net profit, because I am, as I said, my priority is the return divided drawdown ratio. Also, I put a minimum of trades, okay, and also a minimum of bars duration, candles duration of the trade. How do I get started with you? How to trade all the time? I will tell you now at the end of the webinar where you can find me, okay? Strategies you have generated, you demo test them first or put them live straight away? I put the demo first, okay? 1 month or whenever they do some maybe 50 trades, then I can go to live, okay? With the strategic one, what do you start with as far as giving the system inputs? Do you select the single time frames or you use multiple time frames? Do you provide a list of indicators to use? I provide, well, in my academy, I provide some configurations for the people that are in there, okay? I usually one single time frame, depending on the account. For instance, I mean, in Forex, I am using 3 minutes. It depends on the spread also. If your assets, I mean, in the 5ers, Forex has fewer spread. So with fewer spread, I can lower a little bit. The time frame, because the data, in order to do the back test, I download it from Ducascopy. It's CFDs also data. And I know that this data is not equal that the data that has the 5ers. I know that there is a percentage of difference. So what I am trying to do is, if you put higher time frames, it reduces the difference of the data. If you operate at 1 minute, there will be in percentage of the price more difference between your broker data and Ducascopy. And that's why I recommend always using more than 1 hour time frame. But when you use lower spreads like the 5ers, I used 30 minutes, okay? Or maybe if you operate futures that there is a fits, I mean, there is a fits spread, you can generate strategies at 1 minute, and they are very, very good. Okay. Do you need to have 5 computers to run 5 different MT5 strategies, or do you use virtual machines? I use virtual machines. No, but I use just 1 computer. Okay, 1 virtual machines. Listen this. 1 virtual machines, I have 1 MetaTrader 5 installed, and inside 1 MetaTrader 5 installed, I have 10 systems. Okay. Then I have another MetaTrader 5, another instance, but in the same machine, another MetaTrader 5 or MetaTrader 4, and I have another account with other 10 systems. So you can do everything in one computer machine. Can you provide some predefined config that we can start with? I am not providing that for you that are not in the academy. That's something that it's a plus if you are in the academy. In no experience in programming, how much time do you think to use a strategic quant? It depends. It depends on the time that you spend on practicing, on getting knowledge. Where do you study? There are videos. You can look for videos. You can It depends. Maybe I don't, less than 1 month, you should be able to learn how strategic quant works. What is the max risk you are using for a portfolio? I don't like to be more than 15% of drawdown, 15, 20. Could you expand more on a generator? I didn't quite understand you. How does it work? I can take you hours and hours and hours, Kenneth, to answer you. Sorry. What is the generator name and how can we get it? This is well, a strategic one. It has licenses on his platform. Okay. Do your system combine strategies in one IA to improve profitability? Every system is a different strategy. So yes, I am combining different strategy under the same trading account, not in the same IA. Did you do a course to generate a strategy? Yes, I have academy courses and so on in my website. Thanks for presentation. How do you get the working strategy from strategic quant into trading platforms such as MT5? Does it generate MQ5? Exactly. It generates a MQ5 for each strategy, and then you copy paste and put it on MetaTrader 5. How we contact you for your academy? I will tell you everything now at the end of this webinar. Is strategic quant the software? Yes. Can you run one strategy on multiple time frame for the same pair? Yes. What is configuration of your computer? Do MetaTrader's low is down? In order to run MetaTrader 5, you don't need a lot of machine. You just need maybe, actually I am running right now 2 or 3 strategic quants in a computer that has 4 CPUs. I know, 2 CPUs, okay? So you don't need a lot. Can you tell me how to improve consistency? It's a very big explanation, Atticus. Which VPS do you recommend? I use Contaba actually. What stop loss settings do you use for Forex? I use a range of pips, okay, always, in order to look for a strategy. You also use VPS for MQL5 too? Yes. No, not from MQL5, but from another provider of VPS. Okay. So I think I answered all the questions. I think we can close the webinar right now. I want to say thank you to everybody that stayed here until the end. 70 people here hearing us. You can find me on Hobby Code. My name is Hobby Code. My name is Ramon, but my social network name is Hobby Code. You can find me on Instagram, on YouTube, videos every day. Instagram, I am sharing content every day. Sorry, YouTube videos every week. On Twitch, sometimes I do some lives, also on Instagram, and a new podcast in Spotify. My content is in Spanish. Sorry for all of you that don't understand Spanish. For the moment in Spanish, I know English, so you can contact me directly, direct message in Instagram, or also direct message in Telegram, @hobbycode. You can tag me there, @hobbycode, and you will find me there. Okay. So thanks everybody to stay here. I hope you will see each other in the future with the 5ers. Thanks to the 5ers team to make this possible. And have a nice day and have a good trading. Bye-bye.
And very interesting. I enjoyed it a lot. And I've been trading since 2008, Forex, futures, stocks, day trading, also swing trading, scalping occasionally. So all of it together. This presentation today, I've been invited by the 5%ers to give this webinar, and I'm very happy to share it with their traders and with everyone else here. So thanks to the 5%ers for giving me the stage today. The 5%ers, by the way, for those who don't know it, is a funded trading and growth program that provides unique career enhancers for worldwide Forex traders, including an accelerated growth plan to boost capital levels and earn higher profits. So this webinar today will be composed of 4 parts. First of all, how to read and trade naked charts, supply and demand zones, price action. I'm sure most of you have heard about it. I'm just going to put an emphasis about what I'm looking at and the formations or the setups I'm looking at or paying attention to. Then we'll put on a shirt on the chart in the form of moving averages to look for better entry points. Then the chart will wear on pants as well to in the form of an oscillator to show you again more, even a higher probability entry setup, but also signs of weakness and exits. And then I'll discuss shortly your helmet, your risk management, your mentality rules. I think it's the most important part, trading mentality and risk management, but obviously we're here for trading strategies, so I'll keep it short. Technical analysis is a windsock, not a crystal ball. This is important to say. Like Wally, I very much believe in technical analysis. I love it, but you need to remember, and everything I'm going to show you, I've selected the best examples, but it's never like a 100% predictor. It's just an indicator. It's just giving you, like a windsock, it's giving you the direction. It's giving you a sense of where the market might be going. It's giving you an edge to increase your chances and make you or give you a higher probability for profit. It doesn't make you, you will never know for sure where the market is going. It's not a crystal ball. So remember that all the time. Let's start with reading and trading naked charts to identify where the buyers and sellers are waiting, how to draw the significant supply and demand zones, and to use price action. First, I'll talk about how to read or what to look for on the charts. So obviously, we're going always from the higher time frames to the lower time frames. And if you're swing traders, you should be looking at the highest time frames, in this case, like the monthly, the weekly, the daily charts. Some may even look maybe on the yearly charts, but these are less relevant. And monthly charts are more than enough. If you're day trading on the daily charts, then of course you should look at the monthly and the weekly. If you're trading the 4-hour charts, you should look at the daily and the weekly. You can use the monthly as well. Look for zones from which big moves were initiated. These are the zones that are where the price reacts most strongly. So look for, it's very easy to see where the prices started their big moves up or down. These are the big places where the buyers and sellers are waiting, and then draw these zones on the charts to see when the price is coming back to these zones on various time frames to look for the price action and to see how the price behaves around these zones. So price action, mostly candles such as engulfing, bullish or bearish, the Morobozu, or the doji candles, spinning tops, pin bars, these price action candles, how the price compresses or approaches these zones and compresses into the zones. It's sort of a distribution or accumulation because these big zones are used by the institutionals, by big investors and big traders. So they cannot initiate their trade immediately. They have to approach this zone by selling or buying gradually into the area of interest. Of course, once you marked or drawn all these supply and demand zones, also don't forget to mark major support and resistance areas. These can be horizontal trend lines or diagonal trend lines around highs and lows. So let's take a look at this monthly chart. In this case, the Russell 2000. It was actually, since this index is of 2,000 stocks and it's not tilted towards like very big stocks, as in the case of the Nasdaq or the S&P, where you have like the big five, Microsoft, Google, Amazon, etc. This is less. I would say it's more accurate or presenting more accurately the real economy. So you can see how the move, the big move of the coronavirus around the first few months of the year initiated from a huge supply zone on the monthly chart. This is where the supply zone was formed late in 2018, where we had the first drop during September, October, November, December. And then this supply zone was retested at the beginning of the year, and the big drop happened. The NASDAQ, of course, formed higher highs at the time, but the Russell 2000 was very technical here. You can see demand zones coming from in 2012, in 2016. So it's very easy to see where the big moves initiated, and from these entry points or start points, these demand zones were formed and later on retested. In between, like inside these big legs or big moves, you have obviously minor demand or supply zones. So for example, I gave just one example of this minor demand zone that was tested at the end of 2018. Okay, but it's not a very I mean, it's a big zone, but it's not a very strong one because it was in the middle of a move. So obviously there were other demand zones during this move also here. This demand zone, for example, didn't hold during the drop of 2018. This one did, but not this year. So this one was consumed. Who knows, if we experience another big leg down, who knows, maybe we'll retest the lows of 2012, or the demand zone of that, this lower demand zone. We'll have to wait and see. So far, the demand zone of 2016 held on, and it was a nice signal for buyers. And if we look at the weekly chart, now we start going down to the lower time frames, we can see how I marked the monthly supply zone here in blue. You can see on the weekly chart how the price started behaving around the supply zone or on lower time frames. Okay, so you can see that here it formed sort of a double top. Here it went up, retested the demand zone, again here in blue rectangle, and then went up. So, and here you can see, like I mentioned before, supply and support and resistance. In this case, it was a channel. So the top of the channel was resistance. It was retested here as support and then broke, almost retested here and retested again here. So again, a very technical index. And then if we go to the daily chart, where you can start looking for entry signals and start trading for swing traders who trade the daily charts, you can look for entries around the supplier demand zones with daily candles and price action. So for example, here, again, the monthly and the weekly supply zones are marked. So you can see here the price action in the form of doji candles or shooting stars or whatever, and the double top around the supply zone. Here, if you enter around these areas, put your stop loss above this entry point and go below, you have plenty of room to go down, but we'll discuss entry points in a minute. I'm still showing you just how to read the charts. So again, going down to the supply zone, going up, going back, retesting, sorry, the demand zone, going up and down, retesting the demand zone from the monthly chart, and then going up. Now these dashed blue rectangles, I'll show you on the 4-hour chart, these formed the minor supply and demand zones. So those of you who are not trading the daily charts, maybe are looking for smaller entries or shorter entries, not trading for weeks but trading for days, you can always trade the 4-hour chart. So you can see here on the 4-hour chart price action coming from the demand zone that we've discussed earlier, and here these supply and demand zones on the 4-hour chart are marked, so you can see the 4-hour chart forming a demand zone, coming up again from this demand zone on the daily chart, the red dashed area. Here, an area of price action, a big bullish candle, retesting and coming up. Again, minor demand zone within the 4-hour chart with price action, reversal for continuation. Here, there was head and shoulders within the daily supply zone. These two candles on the daily chart are actually head and shoulders inside the supply zone. So a reversal pattern, price action here again coming from demand. So what I'm saying, look for the supply and demand zones, go to the level, to the time frame where you're comfortable, but look at the higher time frames and look for price action on the higher time frame as well as on the time frame you're trading to give a higher probability. By the way, today you can see this is from an hour ago. So the Russell 2000 was going more than 3% up. It didn't even reach the demand zone, but it kind of met this this connection point around here. You can see a very strong bullish candle coming up on the 4-hour chart. So lots of buyers are waiting around this area. And on the Dow Jones, it actually tested the demand zone on the 4-hour chart and came up a beautiful price action engulfing candle. So again, a great example of coming from where the buyers are waiting. Go always with the buyers or the sellers. Just look left and see where, where they're telling you that they're waiting for you to enter, and just be patient and wait for them. So money is made by sitting, not trading. That means you have to wait and wait for the price to reach these zones, wait for the price action to be completed, wait for the chart or the market to tell you, okay, I'm ready now to initiate the move. I'm ready now. The trend is forming, or the price action is validated, etc. Most of the time, as traders, we're sitting, waiting for the setup. And once we enter, we're sitting again, waiting for either the target to be met or for contradicting signs to tell us this is time to exit. All right, so how do you trade it? Find an established move or a trend that's been initiated on higher time frames. Then look for price action on the time frame you're trading or the time frame above. For example, if you're trading the 4 hours, look for the 4 hours or daily. And if you're trading the daily, then look at the weekly as well. For continuation, wait for an established trend that you see on the higher time frame, and then enter at minor supply or demand zones on your lower time frame. We'll see in a minute. For reversal, open the trade once the price action has been confirmed. Okay, it's usually like the price is moving to the area of supply or demand, forming price action, and then reversing, turning around. And of course, you have to take into account risk management. So always set a technical stop loss. Don't set a stop loss too close because you're afraid of taking the risk, or too far because you don't want it to be hit. Set it where you think the chart will tell you that, this is the place where you think the price is not going your way. And in this case, if you're using price action or supply and demand, you can always set the stop loss across the price action area or across the supply and demand, and see if the target is good enough with your risk reward ratio at the next zone, the supply or demand or the support and resistance, to make sure that you have enough room for the target to be hit relatively to your risk, the risk you're taking. Obviously, and I'll talk about it at the end, make sure you're comfortable with the risk you're taking. I'll explain later on. So let's talk about continuation, see some examples. So here, for example, I see that the trend on the daily chart is very clear. I see a demand zone forming. I see here another demand zone and the price testing the demand zone. So I know, okay, I have a clear trend of overall. Seems for now that the trend is going up. Then I'm looking for areas like minor supply and demand areas to go in after at least so far the chart is telling me that the trend is up. Again, you never, I mean, you can assume where the trend is weakening, but as long as it's not showing signs of weakness, you can always look for the minor supply and demand zones to enter with the trend. So here I'm looking for the minor demand zones because I'm going long with a long trend. I'm looking for demand zones on the 4-hour chart. So you can see already here a demand zone forming, a big candle up on the left side, going up and then coming down to the demand zone. Now, if I'm looking to go long, I say, okay, if I set my stop loss below the demand zone and I'm going long, how much room do I have? At least I can assume that at least towards this supply zone. And you can see, by the way, that it's been retested, the supply zone. So if I have a risk reward ratio which is sufficient, let's say 1 to 1.5, 1 to 2, I can take the trade. Again, it's all a game of probabilities. And here you can see a good risk reward ratio. Then the price is coming back, retesting this demand zone. Again, price action here, sort of a pin bar coming up. And also here, a bullish candle, an engulfing candle. But if you feel like it's too far away from the bottom of the demand zone or from your stop loss, you can either you take a smaller trade or you wait for it to give you, in this case it did, to give you another chance to go and set a smaller stop loss or a tighter stop loss. It goes up again, it crosses the previous high and retests it. So resistance turns to support, forming around here another demand zone, testing it, going up again. And so you can see how demand zones were formed along the trend. And if you're swing trading, you can always leave your trades running for a few hours, a few days. It's up to you to decide where you want to take the target, how much risk you're taking. But if the trend is strong on the daily chart, you can let it run and until you see signs of weakness and you say, or let's say you reach the weekend and you don't want to leave your trade over the weekend, you can always close it there. But you can see how like the very like smooth moves coming out of the demand zones, and the risk reward ratio is very, very nice. Again, I drew here some trend lines that show also potential support or resistance lines, in this case diagonal, that also served as support. But I'm focusing here on the minor demand zones. So this is an example of how really naked charts, no indicators, nothing, just looking for the price to come back to the demand zones, give you price action, and let you calculate what the risk-reward ratio is and enter if all parameters are met. Then for reversal, like I said, you can look for areas where the price came back to strong demand, supply or demand zones, look for reversal patterns, and then start looking for places to go in. This is a monthly chart on the euro yen. So obviously I'm not saying you could have taken this huge monthly candle or this entire move, but once you see that a price has been initiated from a strong supply zone in this case, and you can see what a big move came out of this zone. Obviously there are sellers waiting here. So now you're starting to look on lower time frames for short entries and for swing trading down. So on the weekly chart, again, not for trading, just for unless you're very, very patient and you have you can stand long moves and counter moves and long stops. But basically, again, the weekly chart is just giving you signs of what to look for on the lower time frames. And you can see here reversal candles just below. This is the turquoise rectangle is this spinning top. So this is what I marked here. And right below here, this candle, you can see I marked this line sort of as as a support line turning to resistance. And here, from this area where this big move initiated, there another supply zone has been formed right below the monthly supply zone. So we have a monthly supply zone, we have a weekly supply zone, we have reversal candles, and now on the daily chart, you can start looking for entry areas or entry points and entry signals, an evening star, a bearish engulfing candle. Again, the stop loss can be above these patterns, and your take profit, you can see the first target can be set around the demand zone that was formed across. So I can assume that coming out from a weekly, a monthly supply zone, it will at least make a significant move to meet the demand zone across on a daily chart. And you can see it made even much bigger moves, and there are other demand zones or supply zones, sorry, forming here. But I just gave an example of the area of the reversal signals on the weekly chart. So this is swing trading from the daily chart, nice moves. Again, there are plenty of opportunities and signs here also for long from demand zones, but this is counter trending, or I usually avoid these trades, even though it's completely valid. Again, patience, patience, patience. The market is a device for transferring money from the impatient to the patient. Let the market come to you. Let the market give you the best setups. Don't chase the market. Just wait patiently for the market to give you the best setups, and you will be rewarded. So this was naked charts, simply demand, supply and demand, no indicators, no big magic on the charts, simply the charts, price action, some candle patterns, candlestick patterns. But now let's put a shirt on the chart in the form of moving averages that mostly serve as dynamic support or resistance, especially when the momentum is strong and when you see a clear trend. Okay, obviously when there's no trend, the moving averages are just noise on the chart. So I usually use the exponential moving averages 9 and 21 when I trade or intraday trading. When I do intraday trading on futures or stocks, I use VWAP. Sometimes I put the EMA 50 as well on higher time frames. But again, 9 and 21 for strong trends are more than enough. My two favorite continuation setups. So first of all, to enter around the moving averages, just above or below them, depending on the trend, with a pin bar or a doji candle bouncing off the moving averages. And the second setup is entering at a breakout adjacent to the exponential moving average from the moving averages after the flag or pennant has been breached. So again, the stop loss, very simple to set. You set it across either the pin bar or the moving average. If you want to be on the safe side, you can set it across the longer moving average, in this case, the 21 EMA. If I'm taking reversal pattern, then I'm first waiting for the moving averages to, of course, cross each other, and also for the price to cross them and retest them, which then sort of turns into a continuation pattern. And I'll show you the two setups for reversal, how the candles form around the moving averages for reversal. Let's start with continuation. First of all, with moving averages, no other special confluence of a price supported demand or supply. Candles that show me that the price is about to reverse and continue the momentum or the trend from the moving averages. Here is an example of a flag formation, and upon the flag breakout, there is a potential entry. Here again, it's a potential entry just because of the previous high, and it's sort of a resistance area. I'm not sure I would take it because it's already showing some sort of signs of weakness, but it's also a potential entry, just you know, closing below the EMA, the longer EMA, the 21. But obviously, the stronger the trend, the more moves you will get from the shorter moving average. Now, you can always add support and resistance lines or supply and demand, we'll see in a minute, to give you higher confidence in the confluence or the combination of supply and demand or support and resistance with moving averages and these candle formations or this price action gives you higher probability. Okay. By the way, always take into account, like I said, the risk-reward ratio. So for example, here, let's say you want to go in and you want to place your stop loss here, but you see there's support here. So obviously around this area, the support and the risk-reward ratio is not good enough. And therefore, where the dashed lines, if the risk-reward ratio is not good enough, just skip the trade. Even though it looks like a valid setup, I would usually avoid it. More examples with moving averages in supply and demand or support and resistance can be found here. Lots of areas where the trend is very strong. You can see here on the left, there is nothing, at least in the near history. So support turning to resistance, flag breakout, flag, support and resistance, support turning to resistance here. Obviously, this is not a good place to enter because we see support. I wouldn't enter here just because of the support. The risk-reward ratio is not good, but I'm showing you how the price is compressing and then eventually breaking down this support area. At the end, this candle, this pin bar is coming all the way up. I would, if I were in a trade here, I would probably just close it. And you can see that a demand zone is forming, and then the buyers come in, test this demand zone, and start actually turning or reversing the trend into a long trend. And now we can see continuation with the demand zone, just like we said, but on the long side here, a pin bar. And again, strong buyers coming in, forming a demand zone. The demand zone is retested, and then again, shooting up from demand with the moving average, in this case, the 21 moving average. So confluence of signals gives you higher probability, more confidence in your trade. You can set your stop loss very clearly, and it's really, I like these setups, and they actually work not only for 4 hours or daily charts, but also for 15-minute and 1 hour, and even the 2-minute charts that I trade very often. For reversal, 2 setups, like I mentioned earlier. One, when the candle crosses both moving averages, and then the moving averages reverse and the price retests the moving averages, and then it sort of turns into the continuation setups we saw earlier, because now the trend has reversed. The second setup is when the price is starting to form like demand zones or supply zones above. You start seeing pressure of buyers, and then they first test the first moving average, like cross it, go sit on it or retest it, and then cross the second moving average, then the moving averages cross, and then you have a continuation of the counter trend. So let's see a few examples. For example, here, this is the second setup where we have another example of a demand zone forming, retesting. You can see here that even though the price crossed the moving averages, they didn't cross. And then when the price revisited the demand zone and crossed, retested the first moving average, crossed it, retested the second moving average, and then when the moving averages have already crossed, and around here you can go in. Here is an example of a pennant. Like I said earlier, I showed you flags. Here it's a pennant. Again, it's adjacent to the moving averages. Crossing, you can, since it's on the moving averages, you can take the breakout. You don't have to wait for the completion, because the completion can be very, very violent, very strong. Usually I just take the breakout just because I know there's already a trend. If I'm trading futures or anything that has volume, stocks, futures, then usually the volume here goes down and then continues going up as the trend continues. So this is a great example of continuation after the price had reversed. Here, another example, but here the reversal of the first, well, it's actually the first and the second types, because it's going up, going down again, but retesting and then crossing both moving averages with a big candle, retesting. And even if you didn't see the moving averages crossing or here, or didn't take this move, you can take it when the price revisits the moving averages. And you can see here also a demand zone around here. So you have another opportunity to go in. Now, everything I've showed you so far, everything I've shown you is you know, examples of setups that worked. Obviously, there are sometimes setups don't work, or you have you know, spikes that take you out. But remember, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10, and it's okay. If you have a good risk reward ratio, you don't need to be right 9 times out of 10. It's more than enough to be 55% right, 60% right. It makes you a profitable and a consistent trader. So don't look for the holy grail. It doesn't exist. Putting on pants, let's talk about the lower or the bottom part of the chart. In this case, I'm using the stochastic oscillator. I'll show you why. RSI and MACD are great as well, maybe CCI, other indicators. There are tons of oscillators that you can add. I'm using sometimes the stochastic because it's pretty fast and it gives lots of nice signals. But for longer like time frames, or for longer highs and lows that are far apart, usually it's less adequate. Usually for highs and lows that are far apart, RSI and MACD are better. Still, stochastic is doing a great job at giving us signals of continuation and reversal. I'm using the 853, but you can use whatever is comfortable for you. So you can use divergences for continuation or reversal patterns for the entries to give you higher probability. Again, I'm not trading it only according to the oscillator. I'm looking for supply and demand, or for support and resistance, and for price action. So the stochastic is just an auxiliary indicator. It's just helping me to take a decision and see higher probability. Hidden divergences appear before continuation when the oscillator is overbought or oversold. For example, on the left here, you can see we have lower highs, but the oscillator is forming higher highs or going above 80, which is overbought. So higher highs on the higher highs on the oscillator, even though the price is forming lower highs. In this case, it's a downtrend. So when the oscillator is overbought, and you see usually the price reaching some supply or resistance area, it gives you a better signal for continuation, in this case down, because it's a downtrend. Okay, so here sort of a resistance area, but not a perfect one, just this maybe small candle. Here it's a very clear supply area or resistance area. The price is coming. You see hesitation here. The oscillator is overbought above 80, and then it goes down. So you can always set like sort of an area where you enter below this consolidation zone. For entries, you can also use reversal or divergences, regular divergences that appear either bullish divergences or bearish divergences. In this case, I'm showing you bullish divergences, so lower lows, and then the price is forming higher lows on the oscillator again and again and again. But in this case, I'm not sure I would enter. Okay, actually, it's forming here a demand zone, and you can see the price going up from this demand zone, and it actually formed a hidden divergence because we have higher lows and an oversold area. So this is for continuation. But here, for example, the price is going down, forming this doji, going up. And even if you don't enter here, because still the trend looks very bearish, once you cross, you have a divergence, you see, okay, the momentum is weakening, then you have buyers coming in, crossing this resistance, and then testing this support, which was resistance before. You can enter around here, stop below this candle, and then taking all the way up towards this previous supply zone from this area. And again, coming down to the support, hidden, a regular divergence, bullish divergence, forming here sort of price action in this with this spinning top and going up. So this is for entries. More examples of continuation, in this case, Facebook. So you can see around this area, which was support and resistance and support, whatever. And you can see this morning star, a reversal pattern. The price, even though it was higher than previous lows, it went oversold. Maybe not the best example, but again, if you see here an area of support and then reversal pattern, morning star, and oversold, it can give you an indication or a better sign or a signal to go in. You can see that the trend is up. It went down, retested this resistance, turning to support, retested it, forming this small candle sort of price action. The oscillator is oversold again, going up. This time, notice how when it went up to this previous resistance, okay, which turned to support, turning to resistance, okay, forming an evening star in a way, and it's already overbought, okay, even though the price didn't form a higher high, it formed a very high overbought area on the oscillator. And again, with the combination of sort of support turning to resistance, it can give you an opportunity to go short. Apple, here is an example of continuation. Again, support, retested, overbought, even though the price didn't form a lower low here, a much higher low than previous, but it's already oversold, going up. Even if you don't go up or don't go long below the moving averages, you see how the moving averages are crossed. You can go above the moving averages when the price consolidates into the moving averages. You see here, by the way, that the price, even though it went below the moving averages, this area of demand held the price, and it went back up again. Resistance turning to support. Again, the price went oversold here. And again, resistance turning to support. The price is sitting on the moving averages, almost oversold. But even if it's not oversold, look how, even though the low here is much higher than previous lows, it went much lower on the stochastic. So a hidden divergence for continuation in this case up. And again, going up, sitting on the moving averages. And you see here this buyer's pressure here and going low, forming hidden divergence again and continuing up. So this setup is very nice. Confluence of moving averages, support resistance, stochastic, all together, just giving good signs without much analysis. Okay, simple things. Just be aware of, look left and see the support and resistance areas. Even without having stochastic, even without having moving averages, pure support resistance or demand and supply and demand gives you awesome signals. The moving averages just give you more confirmation and better confidence in the trade. And also you can use the moving average as a trailing stop, especially when the trend is strong. So for reversal, we saw some bullish or bearish divergence. Again, you can see here the trend weakening. So it's giving you, if you're short, it's giving you an indication of, okay, I better start covering my short, maybe even looking for long. And you can see here divergence, bullish divergence on top of a demand zone already forming, and then crossing, retesting the moving averages, the same setup we discussed earlier, and then the reversal turning into continuation and continues upward. So an indication from the oscillator about reversal on top of the demand zone, moving average reversal, and then retest for continuation, a perfect setup. Same here, reversal, testing, continuing up, and see here how the price formed a small divergence, but on top of this support area. So again, if you're going short, at least it's telling you, be careful, something is happening here. Look left, look down, okay? And you can see that the price made a significant move up. Twitter, just as an example, on the daily chart for both continuation and reversal. So in this case, continuation, when it retested the supply zone and formed a much higher high, went overbought actually on the oscillator before going down. This is the weekly chart, and the daily chart is showing you where it happened, okay, around this resistance, previous resistance. These candles, these two weekly candles here, are these daily candles here on the left, and then it revisited the resistance. And here actually you can see a nice thing, how we have a bearish divergence between these two peaks. So coming into supply, coming into resistance, forming a bullish, bearish engulfing candle, forming bearish divergence. So this is a nice setup for reversal. The target can be previous demand. You can see that this demand was broken. And even if you took your trade here and went long for this small price action, your stop loss is just below the zone. So it's not a big deal. Like I said, it's not a crystal ball, but many times, more than not, it will work for you. And with a proper risk-reward ratio and risk management, you will be profitable over time. A very nice example of continuation. So you can see that the weekly chart is showing sort of reversal here with this bearish, with this bullish divergence. And then on the daily chart, it's forming a demand zone. Again, wait, you don't need to take the move right away. Wait for the price to give you the confirmation. In this case, it's coming, revisiting the demand zone, price action in the form of a morning star, a doji candle. The price is oversold and going up. Okay, again, almost revisiting this demand zone. And even if not, it's fine. I mean, whatever you take, you take. You don't have to guess. You don't have to chase the market. Take the best signals you can. So just a couple of more examples of fully dressed charts, moving averages, demand, stochastic, support, resistance, whatever. So you can see here a demand zone, the price is sitting on it, and then crossing the moving averages, retesting, going very strongly up, very nice. And even if you didn't take it, it's giving you a chance to take the price right above the moving average and the previous resistance, and continues up. Obviously here we see weakening of the price, and then it's breaking down again. And like we said earlier, taking these candles just close to the moving averages and below, in this case below support. Okay, it was resistance, support, support again, broken, retested, and going down. Perfect setups. Really, just wait for these setups to tell you, take me. Okay. I see here there are, wait, I can't see the chat for some reason, so I don't know why, but I'll answer the questions, or maybe Gil can reply to you, because for some reason I can't see the chat as I'm sharing the screen. Again, another example here of reversal. In this case, the moving averages again didn't cross. There was a demand zone. This is crude oil for our chart. The demand zone is forming, going above the moving averages, retesting. And even if you didn't take this area, see how it's retesting this resistance, just sitting on the moving averages before going up. And you see how the price formed here a hidden divergence by forming a lower low on the oscillator, going oversold. Another example, I won't go over it, lots of examples. You can just review the recording and pause on this slide, because it has tons of examples of demand zones, coming back to demand, going oversold, going overbought, divergences, hidden and regular divergences. It's just and this is a weekly chart, by the way, on the DAX. So you have plenty of opportunities, and you don't need to chase the charts. Just let the markets give you the best opportunities. Remember, and this is the last part I'm going to discuss about risk management and trading mentality. Being wrong is acceptable. It's totally fine. You'll be wrong 3, 4, maybe even 5 times out of 10. But as long as your risk-reward ratio is good, as long as you have a good trading mentality and discipline, you will be profitable. Just test your edge, log in your trades. Being wrong is acceptable. Staying wrong by not setting a stop loss, by trying to, I don't know, wait for the market to turn around and let you out at break even, whatever. Staying wrong is totally unacceptable. This will be the part where you will never be consistent if you stay wrong. And if you don't use a stop loss, if you don't cut your losses, or cut your losses short, then you know, like they say, traders who let their losses run eat like a bird and shit like an elephant. So you eat a little every time, and then comes the trade that takes out all your profits. Don't do it. So always use a stop loss. I've given you all the information on how to set your stop loss here across the price action candles, or price action zones, or demand and supply zones, or the moving averages. You have no reason to not set a stop loss, because these setups have high probability, and whenever it's not working, it's not working. Take the loss, move on to the next trade. Use technical levels, like I said, and then set your position size accordingly, according to the risk you're willing to take. Be sure you're completely comfortable with the risk. If you're comfortable with the risk, you will let the trade run. You will not move your stop loss. You will not avoid setting a stop loss because you're aware of the risk. You're accepting the risk. You're comfortable with the risk. Make sure before you enter the trade that you're comfortable with the risk. Think on a series of trades basis. Some trades work, some trades don't work. It's fine. Use a trading journal, and then you will see how, if your edge is working and what's working better and what's working less good. And then think on a series of trades basis. Don't put too much significance on any one trade. Remember to look left. Look where the buyers and the sellers are waiting. The big candles, especially supplier demand zones that are formed with engulfing candles, are the strongest zones. Use them for your benefit and wait for the price to retest them and then take the trade from them. Be patient. Don't chase the market. The good trades reveal themselves all the time. Just wait for them. Be patient. And once you enter and you've set your stop and your limit, your target, be patient. Let the trade move. Don't move your stop loss too fast. You've already accepted the risk. Now let the profit come to you. And when you leave trades overnight or over the weekend, take into account geopolitical events, economic events, company earnings, whatever. You saw what happened with crude oil. Over a weekend, it dropped 30%, and from there all the way to minus $40. You saw what happened with some currencies, or what happened with earnings just recently with Wirecard dropping to dropping from 100 euros to around €1 in a week, okay, filing bankruptcy. So earnings, if the trend is not in your favor, if the stock or whatever is showing overall weakness, don't try to be a gambler. Don't say, okay, I'm leaving it for the earnings because maybe from 100 it'll jump to 120 or 130. In this case, it went from 100 to 1. So a 99% loss, it's not worth it. Log your trades, use a trading journal. There are good at trading journals out there, but use even a simple one. Just put on all your trades and even your emotions, your feelings, your reasons. Take screenshots when you enter the trade, when you exit the trade, a few hours or day after the trade, and then analyze it. On the weekends, make an assessment of how you're doing, what can be improved, what not, but don't jump from one system to another. Don't look for the Holy Grail. Be consistent. Your goal is to improve over time and to become consistent, not especially when you don't have an edge yet that you can trust. Your goal is to become more consistent and to trust your edge, and then over time increase the position size and become profitable. But first, aim to improve, aim to become consistent, focus on the process. The money will follow. Don't look at the results. The professional traders don't look at the results, especially not during the trading day. They enjoy the process. They focus on the process. They look at the market. They read the market. They live the market. At the end of the day, they can look at their P&L. At the end of the week, they can look at their total P&L or their log, but focus on the process. Basically, this is it. If you have any questions, you can always go to the 5%ers website, the5ers.com. You can contact us via the contact us form. You can send an email to help@the5ers.com. If you want to set a short Zoom meeting with me, I don't know, 20 minutes. If you need help with your trading, with your setups, with your technical analysis, with your methodology, with your trading mentality, with your trading log, with your risk management. If you need help, you can always set a free 20-minute call with me. And if you need more than that, we can take it from there. So that's it. I hope you enjoyed it. Thank you very much for joining me today, and good luck. Enjoy the rest of the webinars. David and Anka, thank you very much for having me, and I always enjoy being here, and keep up the good work. So thank you very much, everyone.
Okay, hi everyone, and welcome to the 5ers YouTube channel. My name is Snir, and in this short video, I will explain about the difference between support resistance and supply demand, which is two different levels. Many traders confused between support resistance and supply demands. Many traders don't even know about supply demands, and there are some that know and consider a support resistance and supply and demand is the same. So in this video, I will explain and show you exactly what is the difference between supply demand and support resistance. And okay, so let's start. First, I would like to explain a short explanation about supply and demand, how supply demand created and how it looks on the charts. Okay, so actually, supply and demand levels are a level in the price that had an imbalance, a huge imbalance between sell orders and buy orders. Okay, after this huge imbalance is filled, the price run away from that levels. Okay, I'll give you an explanation and I'll show you on the charts what I mean. Usually, supply and demand defines but by a few small candles, as you can see here. It's not the classic example, but we will see more. A few small candles that usually move aside on the same range, very tight range, and then we will see the price run away from that level. Okay, as you can see here. This is how it looks on the chart when the price create a supply level. Okay, so in that sample, I would like to explain and tell you what happened behind the scene. In that situation, when supply and demand occur, usually the large institutional banks, private banks, public banks, or federal banks, central banks, big fund institutional, usually they have the large amount of money to create those levels. Okay, it's not the trader that create these levels. We don't have this power. We are not even we don't have any impact on the price. Actually, the traders, just the normal traders like us, even if we do the same position, all of us together at the same minute, it won't affect the price. Okay, so a big institutional like a central bank or public bank had a huge amount of sell order at this level. Then all the buy orders are gone, and many sell orders, which called unfilled orders, left at this level with no buy orders to fill them. Then when the imbalance, the difference between the sell orders and the buy orders are huge, we will see this reaction usually. We will see the price run away from that levels in a very aggressive and fast way. So that's how supply and demand created behind the scene on the bank system. And this is how it looks on the chart. A few small candles that moving aside on this very tight range, and then the price run away from that level. After this level created, okay, usually a trader that trades supply and demand, the safest way is to trade on the first touch when the price came back to visit this level. In this case, it's here. As you can see, I just mark the line that put the borders on this level, and this is the fair touch. Okay, the first touch is the safest touch to open at this situation, to open a sell position just when the price touch this level. And the reaction here that you can see, it's because of this supply on the left. So originally, this is how it looks. This is supply level, okay? And then we can see how the price touched this level on the first time, and then the second time, and now we can consider this level as a resistance level. Okay, so what I'm trying to say is that originally it was supply level when the price just created and ran away. After the price touched this level 1 and 2, it became a resistance zone. Okay, which means now it's too risky to sell if the price will go back again to check this level. It became too risky because actually what we are doing when we're using supply and demand, we are just counting on the unfilled orders that left here behind. So when the price just reach on the first time visit this level, we are counting on these unfilled orders to be filled, and then we will see the price reaction. Because there are unfilled orders that left here, we don't know exactly how much. We can never know that. So the first time is the safest time. Then the second time, we don't know if there are any more unfilled orders. But what for sure, that there are less than it was before. Of course, we can see sometimes the price touch the same level 5, 6, 7 times, and still we will see the reaction. But from time to time, it became more and more risky. So the first time is the safest way to trade supply and demand. Then what we consider now as a resistance here originally was supply, which we can see here on the left. Above, we have another supply that the price didn't visit since created it. All right, this level, you can see. Behind this supply, here on the left, we can see a level that was kind of resistance, but it was before the price created this supply, not after. So this supply created after all this resistance was here, and therefore this one is counted an valid supply to sell on the first touch. Probably what we will see when the price reaches this supply, we will see, most likely, not for sure of course, but we will see reaction, and then maybe another one if the price will go back again to check this level, and then what was originally supply will turn into resistance level. Okay, this is how a fresh supply looks. Okay, this is how supply that the price already touched twice looks. It became a resistance level. Okay, any resistance and support on the chart, if you take a good look on the left, you'll see that in the originally it was a supply or demand. For resistance, you will find probably supply on the left, and for support, you will find probably a demand on the left. Okay, let's try to find another one. This is the AUD Euro against the Aussie. Okay, so if we take a look down, we will see that we have this demand. I'll put this shape here. Okay, you can see very clear the few small candles on this very tight range. Okay, and then the price run away from that level. So this demand is a valid one. Since the price created this one, we didn't visit there. So it's a great level to buy on the first touch. But most likely what we will see, again, not 100%, but if we will see the price holding on this level, 1 and then 2 and then 3, then what was originally demand might become a support level. But for now, it's a fresh demand, it's not support, and it's a good demand to buy on the first touch. Okay, I'll show you another example. Take the US dollar against the Japanese yen, and we can see same situation here. What was originally supply, which you can see it here, all right, this cube, what was originally a supply level, then the price dropped from that level, became after a while a resistance zone, all this zone. Okay, the price visit on the first time, I believe this one was the first touch, then again and again and again and again, and actually collect, probably in some way collect all the sell orders that the price left here. So after a while, the sell orders, the unfilled orders at this supply ended, and then we can see that the price may be on his way to break out this supply and go through the next available supply on the left, which is probably this one on the top here. Okay, so what was originally supply after a while became a support, or if you see this support, just take a look on the left and see the supply that created this support. Okay, and if we take a look on this daily chart, we will see here above this one, a supply. It's a fresh one. The price didn't touch yet, as you can see here, and we are still waiting for the price to reach that level. Once the price reach that level, we can sell on the first touch. All right, so this is supply level and it's a fresh one. Okay, you can find this situation at any time frame. As you can see here, we have a resistance, this one and this one. If you take a look on the left, you'll see here this supply. Okay, that's the reason that we'll see this resistance here. If the price reach that level again, it's risky to sell after the price already touched this level twice. All right, I always preferred the first touch. So you can see it at any time frame you want, and of course the situation and the conclusion will be the same. If you take a look on the short time frames, the conclusion will be for the short terms. Okay, and I'll try to find another sample for this. Let's take a look on this. Well, this one is not a perfect one, but okay. As you can see, the support here below, because till now you saw only resistance. So you can see this support here below. Now it's better. All these levels. The reason for that is a demand here on the left. Let's zoom out, and it's this one. Okay. So demand that became support after the price touched this demand 1, 2, 3, 4, 4.5 times. Okay, so what was demand? After a while, after the price visit and test this level few times, became a support level. It's not demand anymore, and therefore, if the price reached that level again, it's too risky to buy again at this level, since we really don't know if there are any more left unfilled orders here. Okay, so that's the difference between supply demand and support resistance. Okay, supply demand is the original level that the price created after a large amount of money orders get inside the bank system and create huge imbalance, and therefore that situation created the supply and demand levels. And after the price tests these levels again and again, they turn off to be resistance or support. Okay, I'm not saying that support resistance is not a critical level on the chart. There are critical levels that the price find it hard to break out sometimes, but it's not a level, it's not the ideal level, at least for me, from my opinion and from my experience. It's not the ideal level to buy or sell, to open a position. It's a good level to manage the position, which means maybe close position, or maybe close part of the position, and maybe roll the stop loss if the price reaches support and resistance. And for example, before we finish, if we are in a sell position now and the price reach that level here, the support here, and we are in a nice profit at this time, all right, I will definitely consider to close the sell position since we just reached a support level. Okay, but I won't buy, I'm not going to buy, I won't open a buy position at this level, but I'll definitely manage the sell position. I'll close the position, I'll close part of the position, and I roll my stop loss and things like that. Okay, so there are critical levels, but more critical levels are the supply and demand levels. Those are the great and the ideal levels to sell, to open, sell, or buy position. All right, that's all for now. I hope you'll find it good and interesting and and find the benefit from it. And I hope it will improve your results. Thank you for listening, and see you the next time. Bye bye.
Okay, hi everyone. Thank you for joining me today for this relatively short webinar about the wonders of the spinning top. Just a quick disclaimer, this webinar is for educational purposes only. I'm not going to give any advice, any trading advice or signals, and everything here is only for education. And let's start. So just 1 or 2 words about myself. I joined the 5ers last month. I've been trading since 2008. Started with Forex, but trading also other financial instruments and markets, mostly technically. And in today's webinar, we'll review what I think is a very nice setup or signal for that gives, let's say, a hint about what the market is going to do, and it's mostly in the long term or high time frames, but it doesn't mean that you can't find it in lower time frames as well. We'll see some examples, including some very recent and amazing examples. So for short parts of this webinar, we'll discuss the spinning top candle itself. We'll talk about references to see where the spinning top candle is found, because it's not relevant just anywhere. It's mostly relevant when the deviation is large, or where it's adjacent to moving averages, or around supply, demand, or support and resistance zones. We'll talk a little bit about how to trade it, and we'll see an example, a recent example with the pound dollar. And of course, we'll talk a little bit about risk management and trading mentality at the end. So let's start. And again, as I've mentioned, this is not like a magic entry signal. When you spot it, you immediately enter. And most of the examples you'll see here are on the daily, weekly, and monthly charts, but it's definitely applicable for any time frame. It's just that on the higher time frame, it works really, really nicely. It's applicable to all markets, so I'll show you some examples also from commodities and cryptocurrencies. As I said, we will add some reference points which will increase the validity of the pattern of the signal or the candle, and it really gives you the opportunity to recognize ahead of time where the market could be going. Mostly for reversals, like major reversals after a long trend, but sometimes it's like a minor reversal within a trend. So like after a correction, it can signal trend continuation. It definitely gives you an edge over the market, which means it can tell you, if you're in a position, it can tell you, listen, maybe you should close a position, or at least move your stop loss closer to protect your profits. It can give you a hint to enter the other way, and of course to take the other direction of the market after some confirmations or in lower time frames. But again, it requires patience, because definitely we're not going to trade the weekly or the monthly charts, maybe not even the daily, but in lower time frames, you can start looking for places to enter. Patience is a virtue, especially in trading. And with the spinning top, you will need patience, but it pays, and it pays big time. I will give you maybe also an example, or talk about some things I've seen in the last week or two from our traders that eventually, managed to take very, very big gains, but because they weren't patient, they had some losses before these big gains, and with patience, they could have avoided these losses. So let's start with the candle, the pattern itself. The spinning top candle, definition from Investopedia. It's a candlestick pattern that has a short real body. Okay, it's short. It's not a line. It's not like a doji candle with a long-legged doji candle. It has some sort of a body. Okay, that's why it's called the spinning top and not just a simple doji. And the body is vertically centered between long upper and lower shadows. And the keywords here are centered, so it's not at the bottom, it's not at the top, it's in the middle of like in between the wicks, and the wicks are pretty much the same size, and they're usually long. Okay, we're not talking about short wicks, we're talking about long wicks. The candlestick pattern represents indecision about the future direction of the asset. It means that neither buyers nor sellers could gain the upper hand. But again, as we'll see, usually when it comes in with specific setups, it definitely shows you or can tell you where the market is headed or who's going to have the upper hand, the buyers or the sellers. And we'll see plenty of examples, including examples from this week. The spinning top candle can appear anywhere on the chart and on any time frame, as I've mentioned, but the pattern is mostly meaningful when it appears as part of long trends. And I said at their potential end, because when the trend is there, we don't know that it has ended or it's about to end. But when you see a very long trend, usually at the end also with big candles, like there's strong momentum, and then this candle appears, usually this candle has a very significant meaning. So don't look at this candle anywhere, but usually after long trends, we'll see examples, and of course around supply and demand zones or support and resistance lines. And I've also added here examples of other reference points, such as moving averages. Maybe it can also be Bollinger Bands, but in this case, I'm using moving averages, either when the spinning top candle appears far away from the moving averages or adjacent, like on top of the moving averages. If it's not too far away and not adjacent, then probably doesn't mean anything, or it doesn't necessarily mean something, again, unless it's in a supply or demand zone. But if it's very far from the moving average, which means that there's a big divergence or a big that the price has gone way too far with its sorry, I forgot the word now, then it usually means that we're expecting some retracement. It was standard deviation, that was what I was looking for. So if we have, like, I don't know, 1, 2, or 3 standard deviations away from the price, then usually it means a retracement is due. And if the spinning top is deviated a long way from the price, then it is stronger. And again, the longer the wicks, the stronger the candle and its following reaction. So don't look at small bodies with small wicks, but long wicks, and the longer, the better. Let's look at a few examples. So you can see here, let me just turn on the mouse. Okay, you can see here this spinning top after a long run. You see this is a weekly chart. Okay, this is from a long time ago. As I've mentioned, I started trading in 2008, and I've noticed this pattern already back then in 2008, just before the end of 2008. Look at this spinning top on the weekly chart and look at this huge candle right after it. The trend didn't go straight down afterwards, but it definitely went down quite a lot in the following weeks. But this was the initial signal after a very long run with big bullish candles. Here too, you can see the spinning top, not so long wicks, but again, it's the weekly candle, so it's still not too small, and it's within or right below a supply zone. So this is another significant thing. Here too, you can see hesitation candles above the demand zone, but these are not classic spinning top candles. Here too, you can see sort of small spinning top candles, but again, relatively small. This one is definitely, and I show you this because I always kept this pattern in mind with the specific example of the euro pound. So this is classic. Another example, huge wicks. Look at this small body and this huge wicks right at the bottom of a very long move. This one is a monthly chart. Okay, huge move down, very strong, and then very, very big wicks and a confirmation candle. It doesn't, we had a move up, okay, of about, I don't know, 3,000 points or pips afterwards, but then again, it continued going down and went up again. So it was already a hint for what's to come next. And you can see that at the bottom of this spinning top, the bottom of the candle was the area of demand, after which the buyers came when the price condensed or compressed into the bottom of the demand zone that the spinning top candle formed. So again, as I said, it gives you an edge. It doesn't mean you trade it. Obviously, you don't trade the monthly candles, but it gives you an edge. It tells you where the market could move in the following days, weeks, or months, sometimes even years. Here's another example of the euro-dollar monthly chart. Again, strong moves, spinning top candle here after long moves. Another move here. This one is not a very long move, but again, it gives you some hint about where where it could go, and you see the strong candle, confirmation candle afterwards. And again, we'll talk about how to trade these patterns from the lower time frames afterwards with a specific example. So this is just a quick overview of the spinning top pattern or candle. Now let's talk about the second part, is about references. As I've mentioned, two possible references: moving averages, and of course supply and demand or support and resistance zones. Let's start with a moving average. Moving averages. So moving averages can serve as context for the spinning top to have a potential meaning or a potential reaction, because not every spinning candle or spinning top candle is relevant when you identify it on the chart. What I'm using usually on my charts, and I've mentioned it in my previous webinar, is moving averages, three moving averages, mostly exponential, the 9, 29, 21, and 50. Some use 10 and 20, or 9 and 20 and 50. Some even add 100. And when the spinning top appears after a long, strong trend and runs away from the moving averages, which usually serve as dynamic support or dynamic resistance, and we have a strong divergence or a strong runaway from the price, then a deviation, then we usually expect a mean reversion, that the price will come back to its mean, to its average. And then with the spinning top, it's even stronger. So when the spinning top appears far away from the moving averages, it usually signals the end of the trend, and we'll see some examples in a minute. When the spinning top appears in adjacency to the moving averages after what appears to be a corrective move, then it usually signals a reversal for continuation. Here's a relatively recent example. This is the gold futures. It's the same on the XAU dollar. A spinning top after a strong move up. Okay, the monthly chart, a strong, very strong bullish move up that's been going on for almost 2 years on gold. And then the spinning top, see how far away it is from the moving averages. The first moving average is the 9 EMA. Okay, you can see how the 9 EMA serves as sort of support, but then the price runs away from it and forms a spinning top, I can tell you that when I saw this spinning top, I started shorting in the futures market. I started shorting gold, but I also sold my gold stocks, the gold mining stocks that I had, because I realized that after such a big spinning top candle, far away from the moving averages, gold was going down, and I had some gold mining stocks that I was holding in my portfolio, my long-term portfolio, my investment portfolio, and I just sold them. And yeah, I've made some money. I didn't, I didn't trade it a lot. I was working at investing.com at the time, very busy there, but still took some shorts on the futures in the futures market, and just got rid of my gold stocks and gold mining stocks. And that's what I said about having an edge over the market. Even if you don't trade it, but avoid buying there or entering at this bad point, or even selling your gold mining stocks just before they go down, because you see this pattern. Even this is a nice edge. Edward is asking, would you say the spinning tops only have significance on the higher time frames? So yes, as I've mentioned at the beginning of the webinar, I'm mostly focusing on the long time frames, because that's where the spinning tops are the most significant. They have time to give long moves, but they're relevant also with these patterns, with the long runs and the spinning top at the end. They're also relevant on short time frames. It's just that for some reason, maybe I've missed, maybe I didn't notice the right setups, but for some reason I see these spinning top patterns mostly on long time frames, and I love short time frames as well. The H4, H1, even 2-minute charts. When I traded futures, I used to use the 2-minute charts. I didn't notice this pattern so much, but again, maybe I just wasn't aware of it on the shorter time frames. And you say 5 candles prior. Okay, yes. Okay, so the question that Hartmut is asking is about this candle, the green one, which is sort of a spinning top, somewhere in between a spinning top and a doji candle, because the body is very small. As I said, if it's adjacent to the moving averages, I will refer to it only if it comes after a corrective move. So I will show you an example with Bitcoin in a minute, but here it doesn't have much significance, because there was no correction and it's not far away from the moving averages. So I didn't give much significance to this specific candle here. On the third wick after the reversal, where it went back up and rejected the open, you would enter stop slightly above the high. So here again, I don't know if you're referring, Chris, to this chart, but here it's a monthly chart. I don't trade the monthly chart. I just start looking for the opportunities on the lower time frames, and I will show you an example, an elaborate example on how to trade this pattern, or how to start looking for entries and exit after you. And that's the great thing about this this technique or this pattern, that it gives you a lot of time to get ready, but it requires patience. But patience definitely pays with this pattern. Look at the Bitcoin. When you look at it from a log chart, logarithmic chart, it doesn't look this imminent or this impressive, but on a regular chart, it definitely looks impressive. Look at the spinning top, and I told my colleagues at the time that with such a huge spinning top, it's definitely the Bitcoin is going to go down, and it went down immediately. I mean, it didn't even wait for a few more months. This is again a monthly chart, It's amazing how it dropped from 65 at the top to 30 at the bottom within a month and a bit. It dropped from its peak by more than 50%. Okay, so yeah, this chart, I mean, watching the cryptocurrency charts is always mind-blowing. But after it went down, also look, before it went down, here's another nice example of the spinning top here at as a continuation pattern. And this is what I mentioned earlier. If you see a move and then a retracement, and then you get the spinning top adjacent to the moving average, which serves as a dynamic support in this case, then it can give you a hint as to the reversal or the trend continuation. Okay, so this is like a minor reversal after you have a retracement back to the moving averages, and the spinning top is sitting on top of the moving average. If you want to wait, you can still wait for a confirmation candle. But again, this is a weekly chart, so anyways, you have to go down to the lower time frames and start looking for the entry. But it gives you an indication of what to start looking for. In this case, start looking for a long move up. Another question from Benjamin, referring to the spinning top in the previous question. Would it be wise to trade it for continuation? If you're referring, so again, if you're referring to this one, I wouldn't say it's a continuation candle so much, because it's because there was no real retracement here. I mean, it's on a monthly, yes, there was maybe some retracement, but I would look for a real retracement here. It doesn't look like a corrective move, not really. Here, by the way, maybe I should have circled it. This sort of spinning top, it's a small one because you see the wicks are not very big, but it's still a small spinning top. This one is more of a continuation pattern. You have a corrective move, the spinning top, a small one on the moving average, in this case the 21 moving average, and then even a confirmation candle, and you have a move up. Again, this is the monthly chart, so you have plenty of time to start looking for buy positions after this candle. Another example here, the pound dollar on the weekly chart again. So you can see a long move on the left side, a long move, a spinning top, and a move down. The trend doesn't immediately go down, and you can see that it was sort of a hint before forming a double top and then moving dramatically down. You can see an example on the very most left of a sort of a spinning top after a corrective move, but again, it's not a classic one. A few more spinning tops here, or indecision candles. So you have a move down, a corrective move to the moving averages, a spinning top here, and continuation down. You have here some sort of a spinning top. The ones that I've circled with the dashed circles are the ones that are not so strong or not the classical ones. But again, you can see here a spinning top coming back to a small supply zone. Here, a spinning top on top of the demand zone. Okay, here some indecision candles, but not in the middle of anything really. Okay, maybe a small corrective move and a move up, but not. Again, that's why I'm looking for the really classical ones after a long move or within big supply and demand zones. Here, by the way, you have a spinning top which is relatively far away from the moving averages. It comes after a long move. Again, this is the weekly chart. And it's also within this supply zone. Okay, you have here a supply zone. Let me just draw it here. You have this supply zone, something like that. Okay, so this is a supply zone, and you have this spinning top within the supply zone, which brings after it a corrective move, but it, you know, it found support around here, the moving averages and the previous resistance, which was broken up, so it didn't continue much longer. Okay, so that was the first reference. Either after a long run, a long move up or down, and far away from the moving averages, this means usually a reversal, or if you have a corrective move back to the moving averages, and then it finds support or resistance there before continuing to with the trend. The second option, if you don't like moving averages, or you want to have something on top of moving averages, but obviously this is even a stronger reference, is of course the supply and demand zones, or if you have a local support or resistance area or support or resistance lines. So what we're looking for here is for the spinning top to appear inside or next to or on top of or below the supply and demand zones. And the spinning top itself serves as price action for the supply and demand. Of course, the bigger or the wider the zone and the higher time frame the zone is, the longer it may take for the price action or the price to turn, and of course for the pattern to complete. And also sometimes it will take a longer time, you know, for accumulation or distribution in these zones before the move to the other side. But again, these are very strong and very rewarding. Does the market create the patterns so traders can push the price, or is it just a case of buyers and sellers fighting until the candle closes? So that's always, you know, Chris, that's a good question. And I've always wondered if these technical patterns that work so beautifully, if it's like, I mean, do people somehow create it to signal everyone this is what's going to happen, or that, you know, it's, or is it just because somehow it happens and then everyone sees it and then the price moves? I think basically when buyers and sellers are, we call it fighting, but yeah, and also obviously algorithms see patterns and levels and act accordingly. But I think it's not just about buyers and sellers fighting. It's, I remind you, like I said, if it comes within the zone or next to the zone, it's usually around areas of accumulation or distribution. So it's not really fighting, maybe even cooperating. Some are buying, some are selling, buying, selling, buying, selling. And eventually what happens is you have an indecision area, but it's, maybe you can call it indecision, but maybe you can call it a decision to accumulate or a decision to distribute in these zones. And eventually once the big, you know, institutionals and the big traders finish distributing or finish accumulating, then the price moves in the direction they want. For example, let's look at the ASEAN monthly chart. You can see this huge supply zone. And when the price went back to the supply zone and formed this spinning top, it's somewhere between spinning top and doji. Look at this huge move down. It's, absolutely amazing. This is during the 2008 crisis. Okay, everything went down, commodity prices and housing prices, of course, and the dollar became very strong. And look at this huge move down after this signal from the market. You can actually see even before this red spinning top or red doji, you can see already some sort of another spinning top, the green one. And I wouldn't say doji is significantly less indicative than a spinning top, but you know, it's just I think they're pretty much similar, but I think the spinning top, you know what, in places like this with a huge supply or huge demand, and with on a monthly or a weekly chart, I would give importance, or I would notice either the doji or the spinning top the same, but the spinning top is very strong. So this is why I'm referring specifically to the spinning top, even more than the doji. You can see here this demand zone, which was respected several times. And again, a spinning top, even a few of them. This is accumulation, okay, the monthly chart. So you can see how the price came back to the demand zone, accumulation for several weeks, okay, three months or so, accumulation, and then continued up. You can see here, by the way, a small, not a classic spinning top, but again, an indecision candle on top of a reversal area that was previously resistance, and then came back to test it as support with this candle, sort of a spinning top. And yes, and the webinar is recorded and will go live on or go online on our YouTube channel. Another example from crude oil. This one is H1. Okay, so hourly chart. It doesn't necessarily have to be monthly or weekly, but again, obviously the moves here are much shorter. But again, for day traders or scalpers, whatever, it can be good enough. So you can see here a nice move up, a spinning top or a doji candle, and then a move down. You can see here a very nice move back to the demand zone, okay, and spinning top in a few in pin bars, and you can see all the candle wicks showing how the buyers are coming in, and it's on top of the demand zone, so it gives you a nice opportunity to take, and even a double bottom gives you an opportunity to go long. The moving averages I was using were 9, 21, and 50 exponential. Satish, can you please explain how to draw supply and demand zone? Yes. So very quickly, how do I draw, or how do I decide where to draw the supply and demand zone? So if I have two candles, let's look, for example, at these two candles here. I look at the, okay, I look at the price, the place where the two candles have the same price, and I look at this, the place, the closing bodies, and I take the place where they meet. So in this case, it's here. Okay, the closing body of the green candle meets the body of the red candle, and this is for me the base of the supply here. Okay, so sorry, so this is the supply zone. Let me show you another example. Let's move to the next chart, and I'll show you another example. So here, for example, you can see I take the connection, the place where the two bodies meet, okay, and then the opposite point. In this case, it's the higher point. If I took, for example, here these bodies, okay, I would. This is where they meet here, and this is the opposite point. So that would be the demand zone here. In this case, the demand zone is something like this. Okay, and supply here, for example, this is the supply zone of these candles. Okay, so I always look for the place where the bodies meet, and the opposite high or low is the other side of the supply or demand zone. I hope this is clear. I hope it makes sense. And the spinning top doesn't have to be a candle of the opposite direction. It's obviously stronger, but it doesn't have to be. I mean, for example, if we have a move up, the spinning top can be green or can be positive or bullish as well. It doesn't have to be red or negative or bearish. Okay, if we have a move down, the spinning top doesn't necessarily have to be bullish, but obviously it's a stronger indication if it's of the opposite direction. Okay, so here we have the pound dollar, and we are talking about right now. This was taken today, and this candle here, the spinning top candle here, is from 2 weeks ago. Okay, and you can see the demand. Sorry, the supply zone. First of all, you can see on the left side of the chart, you can see a spinning top candle after a long move, and then a move down again. We saw another example how it doesn't necessarily create the move immediately, but in this case it went down and then up again before a double top, and then the big move came. But the second move created this big supply zone, and we came back to the supply zone in the recent weeks. And 2 weeks ago we had a nice spinning top, not a very big one, but still a nice spinning top, and we saw the moves in the last day, a very strong move, but the move down started even earlier. As for Santosh, as for your remark about the second spinning top that should have been avoided, as the trend was broken from 2 previous highs. I'm not sure what you mean. The trend was broken from previous 2 highs. You mean maybe? Okay, I'm not sure what you're referring to. If you're referring to this spinning top candle, again, it's after a long move. Okay, right, coming right into the supply zone around here. So it's still valid. And if I draw a trend line from 2018 to 2020, yeah, so if I draw a trend line, obviously, if you're referring to, I don't know, something like this, then yes, it went up, but maybe the trend line is not accurate. But yeah, we have some sort of, maybe the trend line came here and then it broke. But you see, it still broke. It still broke into the trend line again. So even if you don't trade the spinning top, even if you don't go short here and sell, you still say, okay, I have to be careful. I'm not going long here because I have the spinning top. Maybe I should wait for at least, look for lower time frames and look for a better entry, or wait for the price to revisit the trend line and see if I have a good entry at the broken trend line that could continue up. In this case, it didn't happen, but still, it gives you a warning signal. And like I said, we're not going to trade the higher time frames anyway. We're looking for lower time frames, and we'll see that in a few minutes with an example. Euro dollar also. This is this is an updated chart. So you can see here also supply zone from the monthly chart or from the weekly chart. Supply, you can see here distribution, a very strong move down, a very long move down, coming back to the supply zone. This is more of a shooting star candle, and here one or even two spinning top candles right at this supply zone, even another supply zone, a recent one. We can say we have some sort of a supply zone here, something like that. And then the spinning top candles give us a hint of what is to happen, a double top here and a very strong move down. So let's see how we can trade, the pattern. So first of all, once you identify this pattern in a high time frame, you don't take the trade there, you don't trade the monthly or the weekly chart, you switch to the lower time frames and start looking for the signals in the lower time frames. That's why I said you have to be patient. You wait patiently for low risk areas to enter, where you can place your stop loss more tightly, where you can take the stop loss or set the stop loss without violating any risk management rules, without risking too much of your account, and without placing the stop loss too far away or too close, just because the risk is too big. Of course, the spinning top candle gives you direction. Okay, if it's at the end of a long run up or in a supply zone, then you're looking to go short, to go to sell. If it's at the end of a very long move down or in a demand zone, you're going to look for entries to buy. So this is the direction. And then you set your stop loss in the lower time frames. It can be an hourly time frame, a 4-hour time frame, or even a daily time frame for those of you who trade longer time frames. But your take profit can be even longer, because we are talking about long moves. And if you have patience, then while your stop loss is relatively short, relatively small, your take profit can be much longer, which gives you a great risk reward ratio. As for fundamentals, I usually trade the technical charts, but if we are talking about fundamentals, then yeah, everyone knew that inflation was very strong. We saw the PPI, the purchase or production price index, and how everything, like the manufacturing prices are going up, inflation is going up. Obviously, the Fed cannot ignore the rising inflation for much longer, and people are expecting that either QE or the purchasing program will start being tapered at a certain point, or even interest rates rising, and then the dollar will go up. So you can look at the fundamentals, and you can see that the euro dollar is within a supply zone, that the pound dollar is in a supply zone, that the Aussie dollar has been moving sideways inside a supply zone on the monthly chart. So you can add the fundamentals to the technicals. And I agree that you can also look for divergences even on the higher time frames, and definitely on the shorter time frames. So pound dollar, the daily chart, here you can see, okay, again, the weekly chart is this chart. Okay, we saw the weekly chart of the British pound versus the US dollar. This is the very big supply zone, and now we can see this is where we're at on the weekly chart, and this is the daily chart. I can tell you that I've been tracking several traders of the 5ers, and they weren't patient, unfortunately, and they were trying to go long and short on the pound dollar, even though it's been going sideways for about 3 weeks. And unfortunately, people were losing money just because they didn't wait patiently for the price to show some decision rather than just moving sideways. And well, at least one of the traders that unfortunately was losing money, sometimes making money, sometimes losing money. Finally, the pound broke down, and this trader made a lot of money. Currently, this trader has on both accounts a profit of about I think $10,000 or $11,000 on each of his accounts just from the pound dollar, which is very, very nice. Yeah, he opened a position of 6.7 lots on the pound dollar on each account, and the accounts now have a floating equity of around $10,000 on the pound dollar. But unfortunately, he was losing money all the way, well, sometimes making, sometimes losing, just because this pound was moving sideways, and it could have been avoided, or at least managed better. And what we see here in the dashed rectangle is the doji itself. This doji candle, the weekly candle, this is how it looks on the daily charts. It goes up, up and down, up and down, up. Eventually, it closes as a spinning, as a spinning top candle, not a doji, a spinning top candle. And now we go down to the 4-hour chart. Again, this rectangle is how the spinning top candle looks in a lower time frames. You see the indecision, but once this is complete, once this spinning top candle has been formed, and you say, okay, I have a long move up, I'm inside the supply zone, I have a spinning top candle, I should start looking for a short position. Now maybe you can start looking for short, but where are you going to look for a short position or short entry? You're not going to look for a short entry inside a demand zone. You're not going to look for a short entry somewhere in the middle. Look and wait for places where you can have higher chances of success. For example, at the top, okay? You have here sellers coming around here. You have sellers coming around here, coming around here. Here, very strong engulfing candle. So sellers are waiting around this area of around 142, 140, 190. This is the zone where you can start looking to go short. If you want to wait a little bit longer, then wait for the price to start moving down. It has demand here, okay? The demand from this area, the blue line below the demand zone is this blue line is the weekly demand zone. Okay, so we have a weekly demand zone, we have a daily or a 4-hour demand zone. So if you feel uncomfortable taking short just above the demand zone, wait for it to break. It broke, it retested again, and now it gives you an opportunity to go short. Okay, and it went even lower after taking the screenshot earlier today. So this is the 4-hour chart, which is obviously a much lower time frame than the weekly chart. Already a good place to enter, and you can go down to the hourly chart. So you have the resistance area, you have supply zone around here, you have supply zone here, you have even a lower, you have resistance here, you have supply, so you have plenty of places to go short. Here, actually, I wouldn't go short because it's right above the demand zone. Okay, but once the demand zone is broken and consumed and the price is retesting, this is a classic place with a very small risk, but look at the reward, the potential reward. So this is amazing, and you have the hint coming here after breaking or consuming this demand zone. So this is what I mean by looking for the opportunities and waiting patiently. Okay, again, the doji, the spinning top candle, you see the edge of the spinning top candle here, this red rectangle, this is the end. This is on the hourly chart. Okay, this is the 4-hour chart. This is where the spinning top candle was formed. This is the daily chart, and this is the weekly chart. This is the spinning top candle. So after it's been formed, we have 1 and 2 weeks, almost 2 full weeks, or to really give you a very nice profit. But even after, even right after the candle has been formed, you already have opportunities to go short. If you go short here, remember the price doesn't move immediately. So, if you take short here and the price goes all the way down and all the way up, it can be very frustrating. So remember that the price, especially coming from big time frames, from big demand zones or supply zones on higher time frames, it takes time for the price to move. It's a big ship. Okay, the weekly, the monthly chart, it doesn't turn around immediately. So give it time. And if you already have some profit, don't hesitate to take it. Okay, start with like starter positions, take profits on the way until eventually it gives you the long-awaited move. And as for 1 million account traders, no, we unfortunately still don't have 1 million account traders, but some are showing very, very nice trading skills, and I hope we will have someone trading a 1 million account in the coming months. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Definitely not 10 times out of 10, unless maybe you're using a martingale. But in this case, eventually you could blow up your account. So, so really don't expect to be right all the time. Take your losses when they come, and take your profits, of course, when they come. Think on a series of trades basis. Don't forget, and I will, Pascalis, I will answer that shortly. Don't forget, always use a stop loss. Okay, use the technical levels, see where the price has support or resistance or supply and demand, and set the stop loss beyond these levels. Be sure to be comfortable with the risk. If you don't feel comfortable with the risk when you open the trade, don't open the trade or close it immediately, because if you're not comfortable with the risk, you'll start and the market moves against you, you'll start doing things that are bad for your account. You will remove the stop loss, you will move the stop loss eventually, and I'm talking from bitter experience, you will eventually lose a lot more than you've planned to lose or wanted to lose. So so just be comfortable with the risk. Comfortable enough so you can sleep tight at night, or that you can turn off your computer and not watch the chart. This is what I mean by comfortable. That you don't care if the market hits your stop loss, you're good, whatever happens. Remember to think on a series of trades basis. Don't think that each and every trade is the most important trade, because like I said, or like Peter Lynch said, 6 out of 10 times is good enough. Remember to look left, look for the supply and demand zones, look for where the buyers and sellers are waiting. This is your edge. The price is everything. It tells you where to look for long or short. Be patient. Don't chase the market. There are always opportunities. Just wait for these opportunities. And if you have a spinning top on your weekly or monthly chart, be patient. Let it, evolve. Let the price on the lower time frames give you the signals. I've just shown you on the pound dollar from this week how you had plenty of places to go in. When you leave trades overnight or over the weekend, take into account that everything can happen. So again, if you're not comfortable with the risk, just close the trade so you can sleep tight or enjoy your weekend. Use a trading journal, aim to improve, to become consistent. Don't try to become rich immediately. It doesn't work this way. and focus on the process, the money will follow. Let me just stop sharing and share the live chart so I can maybe reply, give you some answers. So let me share the chart. And of course, if you have any other questions, feel free to ask. So basically, a question about the pound dollar, if it's still good to enter short. So again, if you're looking to enter short on the pound dollar, look for places where you can enter safely. For example, you have here a temporary supply zone. So wait for the chart to, or for the price to come back to this zone. Okay, you have supply, or you have even another supply here, or if the price comes even higher, you can look for places like this. So it's always definitely possible for the price to continue down. And like I said, the this is a weekly chart. So, and we might see here a double top. So it can definitely go all the way down to this area first. Okay, we have here the first demand on the weekly chart, and we have another demand here. Okay, here on the weekly chart as well. So we have two very adjacent demands. So it can go, from 139.50 or so to it can go down at least maybe 100 more pips. But don't just enter here. Okay, look for entry places like intermediate demand or supply zones. This is a nice place maybe to take after a temporary support, and then a strong move. So maybe this is a potential resistance. If you're using moving averages, then you can see how the 9 EMA served as a moving average dynamic resistance. If the price comes back up here, you have the 21 or the 20 moving average that can serve as resistance in addition to this area. So this is a pullback towards here can be an interesting entry point again, but wait for the price to stop here. Don't just enter, because it could move a little bit higher and just take your stop out or your stop loss. But basically, yeah, the pound dollar could move even much lower, especially if it's a double top, but obviously not immediately. By the way, you can see here that the 20 EMA or 21 EMA, which is sort of, let's just clear these. You can see a very nice area around here. This is a nice area. You have resistance, you have support, you have potential support from this 21 EMA around here, which is also, like I mentioned, demand. So this is a first place or an initial target for short. And this is an initial target maybe, or a nice place maybe to look for long. How much do I risk per trade? People normally say 1 to 2%, but I watch these financial movies. They usually make. So when you watch. Yeah, so usually I don't think risking more than 1% per trade from your entire portfolio is smart. I think it's 1% is already a lot. But yeah, 1 to 2%, so that even if you lose, let's say, 5 trades in a row, which is definitely possible, you don't lose more than 5 to 10% of your portfolio. You still have plenty of money to continue without affecting your psychology.
you try to risk 0.2% per trade and 0.5 when very confident. Lately been trying to flip accounts. That's always okay. Yeah, Chris, so definitely learning from your mistake is smart, but sounds like you know how to manage your risk. And again, don't haste, don't try to make a killing out of 1 or 2 trades. Maybe you can do it once or twice. In the long run, it doesn't work this way, and your goal is to become consistent so that you can really survive in this market for a long time and know how to make money in this market over and over again, and not just, you know, once or twice. If I can suggest a trading journal, well, actually, a very nice trading journal, which is not for free, but it's not too expensive, and it's just a one-time payment, I think, of around 100 or 100 something dollars, is the Edgewonk trading journal by Trade Society or something like that. Edgewonk. So that's a nice trading journal with lots of features, and it can show you like your psychology progress and things like that. Yeah, and let me just write it down for you. So the name is Edgewonk, something like that, or Edgewonk. Yeah, so I think, well, yeah, just look for Edgewonk. If I'm not mistaken, this is the how you spell it. Yeah, great. So basically, this is it. Thank you very much for attending. And again, trade patiently, trade well, manage your risk. Always, you have plenty of opportunities, plenty of trading methods, but your edge is your mentality, and you should really just be patient and focus on the process, not on the money. Pascalis, you would like to ask how often you can expect a reliable setup in the majors and crosses. When you're talking about, but a setup according to what? According to the spinning top, because spinning top doesn't appear too often. So, and again, it depends where you see the spinning top. If it's on the weekly chart, then obviously not sure you will see it every month or so. On the daily chart, maybe you can see it. And on the, on lower time frames, obviously you can see it much more frequently. As for other setups, I mean, you have other great setups all the time. I gave a webinar like a month ago on, you know, setups with supply and demand and with moving averages that appears all the time on all time frames. But yeah, spinning top is relatively rare. It doesn't happen a lot, but when it happens, it gives you, you know, it gives you great opportunities to ride the market. All right, guys, thank you very much. Trade well. May the God of pips be with you. And I'm happy you learn from these streams, from these webinars. So good luck to all of you. Thank you for joining me today. And you're always welcome to try the free program, the summer plan, and, you know, see how you're doing with this challenge. So this webinar will go live. Will go on online on our YouTube channel. And glad to hear you pass one, Lucien. So yeah, see you next time. Thank you very much, guys. Take care. Good luck.
Okay, guys, welcome. Thank you for being here. What I'm going to do is I'm going to send through a link into the chat. This is a Google Drive folder that has, first and foremost, the presentation from today. Now, I'm going to go through and give as much value as I can in an hour presentation. You guys may choose to take notes on that. Let me just send this in the chat. Now, you may choose to take notes from the presentation. I encourage you to. And then that way you also have the notes from the presentation as well. But I'm going to be going on slight tangents throughout the presentation. So I think it'll be wise to also take notes, pen and paper. And the other thing you have in that Google Drive is a toolkit that we're actually going to be running through today. So to just give you an idea of the next hour, we're going to do about 30 minutes of theory. I'm going to blitz through some theory, give you guys some ideas to think, really pass on some transformative ideas. We're going to spend about 15 minutes working through a tool and exercise together so you guys get actual practical value to your trading and your lives in the next hour. And then for the last 15 minutes, I'm going to answer questions from you guys on all things trading related. Any questions on, you know, how to help gain consistency in funding or deal with emotions and that type of stuff. So have a look through that Google Drive, get that open, get the tool out. But for now, I'm going to get started on the presentation and we'll bring that up very, very shortly. And we do have time for questions at the end, but if you have questions throughout, be sure to fire them through. I'm just not 100% sure I'll see them immediately, but I'll eventually get them. I'll eventually get to them. Okay. So let's get started. Okay, good. So I'm assuming you guys can see this. I don't really have confirmation. Okay, excellent. Great. So welcome to today's presentation. We're going to be talking about how to thrive in uncertain times. Now, this presentation will be related to trading specifically, but I'm going to be branching into the other 7 areas of your life as well, and passing on a presentation that won't only help you improve in your trading, your consistency and bottom line in your trading, but it's also going to help improve all areas of your life. My name is Pat Baylooney, by the way, and it's great to have you guys here today. So thank you for being part of this presentation. Now, really quickly, I wanted to go into a little bit of detail about who I am and I guess why I'm here today and what value I'm going to be sharing with you. I've been trading for the last 5+ years now, nearly at my 6th year of trading. I'm going to trade a range of markets, but predominantly FX markets. And I have experienced the ups and downs in my trading. What I mean by that is I've had good results. I've also had very poor results in my trading. I've gotten funded. I've also lost funding. And I've seen both positive and negative repercussions of being a trader in society. So I think I'm in a good position to give you guys an objective overview and objective insights in how to improve your trading and what it's really about. Now, it was early on in my journey, probably year 1 or year 2, where I really recognized that after I knew my strategy, after I knew where to put my entry point, my exit point, and my take profits, the one thing that would stop me from executing on that strategy flawlessly and gaining consistency, getting funding, all that type of stuff would be myself. I would be the only thing stopping me from going off and doing that flawlessly. So it was about year 2 of my trading career that I went off and I put a big focus on studying psychology and human behavior. And there's one particular, I guess we call a mentor or a teacher that I gravitated towards and I learned a lot from, and that's Dr. John Demartini. Some of you guys may or may not be familiar with him, but I pretty much took a lot of his principles, his Demartini method and Demartini values, and I implemented those things into my trading to, at the end of the day, just improve as a trader. And it very naturally moved on to me helping people here and there. And then it very naturally moved more into a coaching role where I started to coach other traders. And that also naturally moved into me consulting for trading education companies and doing things like this, helping guys and girls to improve their trading results. So from my own trading experience to my own learnings of psychology and human behavior, to then consulting and coaching. And I really am, I guess my mission as a consultant is to progress serious traders. I really want to work with traders like, I know a lot of you guys and girls in here are very serious about your trading goals. I want to work with you and pass these insights on to you to help you achieve your goals and overcome the challenges. And I know today's presentation is really going to be the start to help you guys think a little bit differently and achieve your trading goals. Now, very quickly, I'm sure a lot of you guys recognize this is why you're here today, but I also want to give my overview of why I believe trading mindset is so important. Your psychology will take you from a good to great trader. And what I mean by that, like I mentioned before, once you know your entry points and your exit points, the one thing that stops you from executing on that flawlessly is yourself. It's the emotions, it's the fear and greed, it's the procrastination and lacking of discipline. It's all the psychological components that stop you from executing flawlessly on what it is you know you need to execute on. So going in and mastering your mindset, so to speak, which is I'm going to show you some principles today, will take you from a good trader to a great trader, one that consistently and persistently executes on their setups, and as a result has great results. Now, mastering your mindset is also going to help you lower your stress and emotional volatilities in the market. And every single trader knows that trading can be stressful. It can really take and be extremely draining. And as a result, if you're stressed and emotional in the markets, you're going to have poor decision making and be making a lot of mistakes. So mastering your mindset and lowering your stress and emotional volatilities is also going to help improve your decision making and lower the mistakes you make in the market. And as a result, it's going to help you maintain consistency in results. It's all about bottom line and funding. I know a lot of you guys are either funded or looking to get funded. I assure you, if you don't already pay attention to or work on your mindset, implementing that principle into your trading is what's going to take you to the next level, either to help you get funded or to help you maintain the funding you have and continue to grow that. Now, every trader also recognizes that when you have a poor trading day or a poor trading week or a poor trading month or year, that can really influence and impact the way you view yourself, the way you view your life, the way you view the other 7 areas of your life as well. So mastering your trading mindset, having tools and principles in place, is also going to help you increase the appreciation for yourself and your own life. And as a result, because every trader knows that when they have poor trading results, that can impact relationships, it can impact health and fitness goals, it can impact business and work, it can impact your learning, it can impact all areas of your life. Being able to master your trading mindset and take on principles and have those in your life is going to help you improve in all areas of your life. Because if you don't put those things in place, trading is going to impact them negatively. So this is why I believe trading mindset is so important, and why I'm really glad that you guys have come here today so I can pass on some principles to help you empower that part of your life. Okay, good. And good to see more people have jumped on. So welcome, guys, those of you just jumped on. Now, today's presentation is all about thriving.